My plan today is to start giving you an intense training, and I really want this to be something you can keep forever. My goal is to have an intense training on how to trade, right? If I'm not trading anything, I want to make sure that I give you the best content possible. I'm not talking politics, but talking about trading. And so what I'm planning on doing is going through the entire trading strategy, start to finish, 1 week at a time. So there's no rush to get through everything. It's not going to be an hour long each day. We're going to talk about why we do certain things, you know, in the strategy, where I learned it from, why does it matter, why not do it a different way, right? I'm not saying my way is perfect, but what I am saying is I want to give you the knowledge that I was able to capture by losing literally hundreds of thousands of dollars before I figured things out, spending time directly with 5 of the market wizards, and teaching you everything that I possibly could. Now, all of this is predicated on having the outlier data, right? Because the signals that come through here are unbelievable. And I'm so stoked to be a part of this. So before we even get into all of the strategy, why it matters, where it comes from, I want to tell you all about Outlier. I want to tell you exactly everything inside of each of the different categories. And I want to hear from you questions that you have about anything. And then I also want to hear from you feedback of how you're using it or how you think we can improve upon it. Because as you know, we take feedback from our customers extremely serious. And we want to make sure that Outlier is the very best program you've ever come across. Not just in signals, but we want to give you a full rounded package so that you can trade efficiently. So I hope that sounds good to you. And so here's the trades that I've put on this year, right? They've not all been great, right? Everything in orange right here was before the master key was figured out, right? And so that's one thing that I wanted to just make sure that we're all on the same page about. And these are the trades that we have put on in the last week. From Walmart down to IBN. And you can see the long strikes, the credit debit where we got out, and these are the return on capitals, right? So we've got a 43% win, a 9% win, 27% win, 23% win, 34% win, 26% win, a 1% loss, a 7% win, a 7% loss, 22% win, 9% win, 21 and 22% win. So that was 13 trades, and we lost on regions, which was by 1 penny. I was fighting on that one. And then on Infi. So, needless to say, we have come up with something incredible, amazing, and I'm so stoked to share this with you. And to Randy's point there, right? The losses were incredibly small, right? This is awesome. And I'm really excited to teach you everything about it. Brian says you need to pick up college Quidditch. Oh my gosh. True Texans will tell you you're out of state with those comments like that. I know. Listen, Texas high school football is a real thing here. I played Texas high school football back in the day, but I give no shits about any sort of football now. Peter, glad to see you. And he's here to looking forward to teaching. Great trades. Yeah, no doubt. And I was having this conversation with my parents this morning. I was on the phone with them. And I was saying, like, we have come across something amazing, not only with the outlier data, but combining the data and with these options that we've been putting on and just seeing these incredible results come through. And where was I going with that? Oh, I was talking to them, and it's like, it's not just a 2-week thing, right? Yes, it happened in the last 2 weeks, but then I went through, marked off all my trades over the last 2024 that had the master key set up. And then I did again for all my trades in 2023 that had the master key set up. And in 2024, the win rates, I got the numbers here. In 2024, the win rates with the master key. So only the trades that had the master key, and every trade that I had that was only set up with a master key, I should say, had win rates of 81%. 81% win rates. Year-to-date return would be 94.75%. So this is ideal returns for me. The only difference in what I showed you a minute ago and now is the ones that weren't set up for master key were taken off. Now, We'll jump more into the master key later on, but it's just the SPY signal being long or short, the market breadth matching, and the sector breadth matching in that same direction. And then I did it again for 2023, which I showed you guys yesterday, because I wanted to prove to myself that this is not a 2-week fluke. That's really why I did all this. I want to prove to you this is not a 2-week fluke. That's not the right one. Hang on. Here we go. Master key 2023. So same trades I took last year, all last year, 40% returns. Now this chart's messed up. I know I didn't fix that data, but on only 11 trades, 40% returns. This year on only 27 trades would have been 94.75% returns. So what I'm trying to tell you is that this is not a 2-week fluke. This is something that I've proven over 2 years of data works. We're going to change the market. We're going to take over the world. I texted Mahesh and Mark whenever I was figuring all this out, and I said, guys, listen. What we have figured out is going to change how the market operates. What we have figured out, the way that we have built all this data to work together, is literally going to change the way people trade. And I don't mean like, oh, you know, if you don't have this, you're not going to win. Like legitimately, we're going to change the scale of the market with this. And I am in shock of how awesome this is. So the first question that people always ask is, what is OVTLYR, right? And I'll be very honest with you. I've had a very difficult time explaining this. One time I got my haircut and the stylist was doing her thing, and while I was waiting on her, the owner came over and we were talking. And dude's actually like incredibly wealthy. He owns 14 businesses. I don't know how you have time to manage 14 businesses effectively, but owns 14 businesses. And I was trying to explain OVTLYR to him, and I was like, it's the world's best AI stock trading assistant. And he's like, oh, how does it work? That's a great question. I don't know how it works. This was not that long ago. I'm telling you, this was in July. Like literally just a couple months ago. So that gave me a little bit of an existential moment there, because it's like, how can I trade this without being able to articulate what is happening, what works, what even is OVTLYR, right? And so Mark and I went back a million times back and forth on this. He's like, Chris, I already explained this to you. And I'm like, oh, I know you've explained it to me, but I don't get it still. And so he'd do it again. And Mark's incredibly smart. So Mark is one of the founders here, and a lot of this is his brainchild. And he's way too smart for his own good. That's the truth. And I couldn't understand every time he told me how it works. I just couldn't grasp it. I know it did work. I'd seen it. But when people ask me, how does it work? I didn't have a good answer. So we recently updated the homepage. If you want to go to check out the homepage, we did a lot of updates here. And one thing that's really cool is actually we do like live back testing right here on the homepage. So you could show this to somebody and be like, hey, how good are our results? Well, go and look at it right there. So really cool stuff here. And, you know, a couple things while we were building this together, right? OVTLYR signals outperformed 78% of stocks, and 5.35x was how much it outperformed on average. It outperformed 78% of stocks by a factor of 5.35x. So that's 535% more. Pretty sweet. And so we've added in a lot of your testimonials in here. A lot of the feedback that you've given us inside of the Discord, which we really appreciate. And one thing down here is where Mark created this graphic to try and explain what OVTLYR is. And we'll go through this in just a second, but even this was a bit complicated for me. Brian says, did you take into consideration the exit points that would have been different based on that? No, the only thing I did, Brian, was lop off ones that weren't set up for master key and keep ones that were. That is it. I didn't change anything. I didn't change the entry points, exit points, nothing, except for, was it master key? Yes or no? It's binary, and then move it off. It's a trading AI magic 8 ball. Yeah, for sure. Sebastian says, when you're closing the system to just us being with you already, when are you? When are you closing the system to just us being with you already? If everyone knows the strategy won't work anymore. Actually, I disagree with that, Sebastian, because and in fact, this ties well into this, right? Imagine that you are buying 1,000,000 shares of something, right? When you put in your order for 1,000,000 shares, a lot of people are going to take notice of that, and they're actually going to jump on board. And it's not to say that it wouldn't work anymore. It actually would help push the market forward. You could therefore move the market by having more people do the same thing that you're doing. So the more people who are buying a stock that we're seeing, the better. Brian says, you need to record it and go back through a ChatGPT to streamline it. That's actually what I did, Brian. So I took this and I put this in a ChatGPT and I said, explain it to me like I'm a 10-year-old. So this is really what I focused most of today on is, what is OVTLYR? How does it work? So I'll read you what's on the website, and then we'll go into a breakdown, which is a bit easier to understand. So our founding team has unique experience in building advanced models to quantify qualitative data. See, I told you, like, Mark is way too smart for his own good. That's exactly what we've done with OVTLYR, the most comprehensive data collection engine on the planet, or on the market, for deciphering aggregate behavioral metrics from diverse data sets. Data tells the story, but stories also generate data. We live in the information age with breaking news at our fingertips and a diverse form of engagement and reciprocity across platforms and geographies. Mark wrote this. Each story that crosses our path exists on the axis and interest of proliferation, along on the spectrum of forgettable to captivating. How we react is often more telling than the content itself. Man, I can't even read this. With contextual, historical market data baselines to judge against, OVTLYR discerns instances of highly efficient markets and those far more susceptible to irrationality and forward-looking volatility. The result, a bridge between what you think about an asset and what others thought, and the thoughts of others. There we go. And an undeniable market edge. So here it starts with the data. Investors react to changing market conditions, latest news, and other economic metrics. And then, thumbs up, thumbs down. Proprietary method collects investor reactions at the individual asset level. Then it goes through classification, algorithmic identification of investor biases. And then interpretation. OVTLYR identifies periods of extreme irrationality for individual assets. Now, this is where things start to get a little bit juicy here, right? It identifies the areas where things are starting to look unusual, right? An outlier instance. And then there's observation and feedback, right? So it goes through this loop here, looking for times when the stock is not performing or not behaving in a way that it normally does, and actually could lead to a huge move. And then the OVTLYR heat map, OVTLYR models distinguish behaviors from baseline irrationality and displays these differences as excessive fear or greed. OVTLYR price trajectory oscillator. AI models identify behavioral outliers to predict price trajectories and reversals. OVTLYR signals. Machine interpretation of OVTLYR data at stock, parent sector, and broader market levels to generate high probability positions. Okay. This is super high level and way, way, way more complicated than I understood. So, like Brian said, we do spend too much time together. I put this through ChatGPT and I said, explain this to me like I was a 10-year-old. And I sent this over to Mark, so Mark approves. And I was like, I'd really like to share this with people. So in a nutshell, if you want to explain how OVTLYR works, this is where you start paying attention, because it's actually really cool. Imagine you're trying to pick the best movie to watch, like the best stock, okay? We're going to do a movie analogy. Imagine you're trying to pick the best movie to watch, but you don't want to guess. What if there was a tool that could watch how everyone else is reacting to the movies and help you decide the best one to see? Right? Imagine you're clicking on Netflix and it tells you exactly what you think or what it thinks the right movie for you to watch is. That's OVTLYR. It's like having a super smart assistant that knows what's happening in the theater, how people feel about each movie, and which movie is going to get really popular. So, how it works at the movie theaters. OVTLYR pays attention to everything going on. who's buying tickets, what movies are being talked about, what people are saying about each movie, whether it's an action movie, a comedy, whatever. And then in the collection stage, it gathers detailed reactions from people about each movie. Are people clapping? Are they bored? Are they excited about each specific film? Then classification. Then it figures out the pattern in people's reactions. Some people might love the action movie, while others are totally uninterested in the horror movie. And it sorts everyone's feelings into different categories. So it's seeing what people are talking about, it's seeing what people are doing, and it's saying, okay, based on these behaviors here, this is the data that we're starting to pull together. Interpretation. The outlier, it looks for moments when people's reactions change unexpectedly, right? Like suddenly everyone starts talking about a comedy that wasn't even popular before. This tells you when something big is happening. So it's pulled in all these data points here, and it's starting to realize, hey, this is an abnormality. Hey, something different is happening right now. What's going on? Then the outlier heat map, which let's jump into outlier real quick so we are all on the same page here, what the heat map is. The heat map is this area down here. This is ranked from R50 to the most fear to G50, green 50. Green 50 is greed. So the most fear is R50, the most greed is G50. So that's what it shows down here. And as you know, I love using this for exit points. This part shows how this part, the outlier heat map, this part shows where the excitement is highest. It's like outlier telling you which movie is creating the most buzz, whether it's because people are excited or they're scared. You can see where people are feeling super emotional about the movie. The price trajectory oscillator, that's the blue line back here. The blue line is not a moving average. The blue line is the price trajectory oscillator. Outlier predicts which movie is going to be a hit next. Maybe people are starting to notice an indie film, and outlier tells you it's about to become super popular. So relating that to stocks, it's telling you which stock is about to become super popular, which stock is about to be the one that people are very excited to buy. Then the outlier signals. Finally, outlier gives you recommendations based on what it's seen. It'll help you pick the movie that has the best chance of being amazing based on everyone's reactions and what's coming next. So in simple terms, outlier is like a movie expert that can watch how everyone else is reacting to the movies, figuring out where the excitement is, and predict which movie is going to be the best one to watch soon. And that helps you make the best choice by analyzing everyone's feelings and actions. So I hope that made sense. But now we're going to translate. Now that you understand the overall aspect of it, let's talk about it in stock terms so we can. Imagine you're at a big party and everyone's talking about different things. Some people are excited, some people are nervous, and others are confused, right? Imagine you're talking about different stocks. Outlier is like the super smart friend at the party who listens carefully to everyone's conversations, figures out how people are feeling, and helps you decide which way to act next. Here's how it works when it comes to stocks. Outlier watches what's happening in the market. It looks at the news. It looks at how people are reacting to certain companies and how prices are moving. Okay. Kind of like looking at the movie theater, getting an idea of who's doing what inside the movie theater. And then collection. It listens to how each investor feels about the different stocks. Are people excited about buying? Are they scared and are they selling? And it collects all those reactions. So just like the movie theater, right? If people are having an incredible time watching the action movie, but they're bored out of their minds in the comedy movie, and they're ultra scared in one horror movie, and the other indie horror movie, they're not into it whatsoever. So it's taking all these different reactions here and categorizing that data. And then outlier figures out if people are acting in unusual ways. Like if suddenly everyone starts buying a stock that was quiet before. It looks for irrational behavior. Like when people buy or sell based on emotions like fear or greed, right? So if everyone's running to see a certain movie because everyone else is saying, hey, this is a great movie, kind of like what I was saying a minute ago, Sebastian, right? If everyone's buying a stock, then everyone else wants to know why they're buying the stock. That's what it's trying to say here. Outlier heat map. This is a tool that shows where people are either too excited or too scared. It helps identify which stocks are being moved driven by emotions rather than logic. And that's why whenever I look to trade, I only give it so much room, right? I don't want it to get it where people are too greedy and then it reverses very quickly. I don't want it to get it where people are too scared and then it reverses on me again. Then the price trajectory oscillator. It predicts whether the stock's price is likely to go up or down based on how people are behaving. So when we look at this, right, it says, hey, it's likely to go up at this point here. So it's moving up, and there we go. It's moving down, and there we go. It's moving up, and then it did go down, but then it came right back up, right? This is the SPY. We've seen that. And so this blue line back here, that's the price trajectory oscillator. And then the outlier signals. Finally, outlier gives advice on which stocks are good to invest in right now based on all the information it's gathered from the market. So it's collecting all these different data points, and it's saying, okay, based on what's happening, you know, we have set a baseline in the behaviors of how these stocks are moving. But you know what? This other stock over here is not acting like it has been. And then it's going to start to evaluate what's going on over there. And then it's going to determine, hey, you know what? This actually is a very solid signal. And so it's going to have a buy signal come through for you, or a sell signal. So outlier helps you figure out if people in the stock market are making decisions based on facts or emotions. It gives you an edge by showing you when to invest in a stock or when to avoid it, helping you make smart choices based on how the market is behaving. It's like having a super smart friend who watches the crowd and helps you know what is coming next. So I thought that that explanation was really good, and especially having that movie theater metaphor to go along with it. It really helped me understand what outlier is, what outlier does. And there's Mark in the chat. One catch, how GPT describes the heat map. We're measuring irrationality, irregularity versus historical baselines, and macroeconomic context. Too much irrational fear can lead to a positive reversal, whereas a movie with overwhelming negative feedback will probably just bomb. So there you go. There's the man himself. Like I say, Mark is incredibly, incredibly intelligent. So much so that sometimes it's way over my head. So I needed ChatGPT to explain it to me like I was a 10-year-old. So let me know if you have any questions. Like I say, the objective here right now, while I'm not trading, is I want to make sure that I give you the most in-depth, comprehensive understanding of everything that we do inside Golden Ticket Trading Strategy and everything that we do inside of Outlier. And so this week is going to be all about Outlier. And we're going to be going through and talking about what each of the indicators are inside of here, what the constituent map means, directional volatility, everything with that we could possibly do for you. I want to explain in as much detail as possible. Oh, Michael just got here. Let me start over real quick. So yeah, definitely scrub back to the beginning, Michael, and watch, because we're going to cover so much in the next few weeks. I don't know when I'll be trading again, but here is the game plan. We have the 10 over the 20, prices over the 50. However, when price closes under the 20, this is my personal rule right here. When price closes under the 20, I'm going to wait until it crosses over the 10 EMA again. Now, I don't know when that's going to happen, and that would be up here. It could be tomorrow. It legitimately could be tomorrow. But we also need to keep in mind that we are seeing a reversal in breadth at this point. Looking at the watch list today, Michael says, sorry. Oh, slapping necks and cashing checks. What are you, Tony Soprano? On the market breadth today, we did see a very strong pullback in breadth. There were 16 on the bull list, whereas 108 on the bear list today. So I don't think that that's coincidental, right? I think we're about to see a small term pullback. I don't think we're going to get another deep 8% pullback like we did a few weeks ago. But I do see a short term pullback, and then we'll need to wait as well to make sure the market breadth is moving back up again at that point. So that's why I'm just going to go ahead and plan on giving you the most value as possible, because we're going to have some time on our hands. So please be sure to come back every single day. Also, invite others, right? We do this as a service to help you, and I want you to start helping others. So I'm asking for you to start inviting at least one person every day to come along with you, and we can see this grow exponentially if you do that. Because there are plenty of people out there who don't know how to trade, and now is a great time before we start getting deep into long or short trades to learn as much as you possibly can. So Thank y'all for coming today. Please, please, please continue to ask questions. Please let us know in the Discord if we can do anything. And like I say, tomorrow, start inviting somebody. You're required. Your cost of entry to come is to make sure that you bring somebody with you tomorrow. Otherwise, I'm going to send Michael after you. He's going to start snapping necks and cashing checks. Y'all have a great afternoon. Talk soon. So let's start on the watch list. And I'll make this real big. So on the watch list here, this is really great because it has, it's got really, how should I phrase this? There is a ton of data here, right? And at first glance, it doesn't look like all that much, but actually, let me just expand everything and show what I mean. So you've got your favorites on the left-hand side, all right? You can add any stock to it by just clicking that star, and then you'll see AJG show up over there, right? And if you're like, I don't want that as a favorite anymore, just hit the star, it goes away. And then it'll reload and AJG is gone. Now, a couple of things to notice across here. You've got your favorites list. It shows your current buy and sells for any of those. You can click this button over here, and it'll actually show you the list of sector ETFs all at once right there, which is pretty handy. Then on the bull list and the bear list, these are all of the buy signals. These are all of the sell signals arranged by signal date. And you can sort it by the opposite signal date. I have no idea why you'd ever want to do that, but you could. And then same with the bear list. And then the ETFs also do that as well. Now, these ETFs are more comprehensive than what you're going to find over here. These are your sector ETFs like XLI, XLB, XLY, XLU, XLF, XLV, XLK, etc. But then you've got other ones like KRE. I know that is a regional banking ETF. IWN, I believe, has, in fact, let's just go to IWN real quick. It'll tell you what it is once you go into the stocks dashboard there. Yeah, Russell 2000 Value ETF. IWM is the Russell 2000. This is the Russell 2000 Value ETF. So there's tons that you can get over here. Same for the bull list and bear list. Now up here, you'll notice there are 15 new on the bull list today and 1,054 on the bull list overall. 36 new on the bear list and only 110. Oh, wait, that's on the ETFs. Let me go over here. 72 new on the bear list today, 733 in total, right? So you can see like it's having some migration, right? This is what's measured in the market breadth. That's this percentage right here. How many stocks are on the bull list? That's what we're measuring, okay? So as you can see this going down, the market breadth would be going down. So that is what this is measuring here, is how many stocks are on the bull list. Then you can expand these and actually get a lot more data. In fact, before we had the screener, which we'll look at in a little bit, this is where I got a ton of information from. You can pop this open and you can see the symbol, the current signal, the last signal date. So if it wasn't today, you could scroll back and see yesterday and keep scrolling down, and you can load more and see for ages basically. You go all the way back into the beginning of time, I suppose, if you really wanted to. Then you can filter on sectors, right? Let's say I just want financials. I'm a financial guy. I only want financials. And you can close it. Is that not working? Oh, there it goes. And so it should filter on the financial sector only. And then give that a minute to load. Well, clearly I did it wrong. Maybe that's a bug. I think that is a bug. Mark, if you're watching, I think we found a bug. Let me click utilities. Oh, there it is. No, it's not a bug. I think it's me. I think the button is down there. Sorry, talk amongst yourselves. Yeah, I don't know. I can't get this to filter. But it looks like you can do more than a few. I just can't find like the go button. Or is it just click X? No. Okay, we'll get that worked on. In fact, let me make a note. And here's one of the cool things, right? Is that we are actively using this every single day. And we are always, always, always trying to improve the product. So clearly we found a bug on here. We'll get it fixed. Filter on full test. Okay, cool. Then you've got your overlay. Now I know this works. I used to use this a lot. So let's say you only want to look at the green overlays. Well, what the heck is a green overlay, Chris? It's this area behind the chart, right? You've got your white overlays, which are like sideways moves. You've got your green overlays, which are the bullish moves. And you've got your red overlays, which are the bearish moves here. So you can filter on uptrend, downtrend, or neutral, right? So you can just filter on only greens. That was one of my things that I would filter on. And you can see the last day's close. You can see 30-day average volume. And you can sort those as well. But it gives you a ton of information right here. And same on the bear list, basically everything the same over there. But one thing that we recently added is the screener. So we're going to move off the watch list and onto the screener, because this is like the watch list on steroids. This is like the watch list on all the steroids, right? And this is so cool. One of the things that we recently did, or what I did was, in fact, I did this today, was I created a bearish screener, and we can jump right through that right now and talk about how it works. Okay. So the sector here, you can choose any sector, right? Maybe you only want to see energy and financials, or maybe you want to just see everything. That's how I like to do it. You can change the industry. So you can click discretionary, then you can say automobiles. Okay. We can hit all. And then you can go to OVTLYR signal return. This is positive or negative. So what does that mean? Inside of every single stock that we cover, over here on the performance summary, you can click one click back test, and you can see right on the screen the OVTLYR results versus buy and hold. Now, they're pretty similar on the S&P 500. So let's go to something like Tesla. Everyone's favorite stock to talk about, either good or bad. You go to performance summary here, and you can see OVTLYR, handily outperforming buy and hold. And you can see how the OVTLYR signals would have performed over time, and the buy and hold, how it performed over time. So that is the signal return that it's looking at right there. Capital efficiency. This is a measure that is actually really interesting, right? So let's look over here at Tesla's capital efficiency is at 7.48. It's a function of the return of the signal versus the average holding period. No. Total trading days. In fact, let's go back to SPY, because this one's going to be a lot easier to visualize. I'll show you what I mean by easier to visualize here in a second. So the OVTLYR and the buy and hold are very similar to each other. Yet the total trading days between the two is very different, right? So with buy and hold, we measured 1,176 days. OVTLYR, we measured 641 days for every buy signal to every sell signal. Yet we had similar returns. So our capital efficiency at 1.83 is like this. I'll show you a quick and dirty calculation here, right? So let's say we had 1,200 days that we measured. I'm rounding it. Divided by OVTLYR's 600 days. Okay, so that's 2. And because the capital efficiency is nearly on top of each other, we could say it's 1, right? So your capital efficiency rounds to 1.83. So it's a measure of how much return do we have, how much alpha do we have, how much return in excess of buy and hold do we have, versus how much time we're in the market. Now, going back over to Tesla, capital efficiency here is 7.5, basically, because we're in it for roughly half the time, 1,096 versus 526. But yet our returns are much bigger. Let's see. 1176 divided by 327 is 3.5 times. And if we're only in it for half of it, right? So you could say 3.5 multiply by 2 gives you around 7. So that's that number right there, right? We're in it for half the time and we're making 3.5 times as much. Therefore, capital efficiency is 7.48. It's a big number. It's a big deal. So you can filter on a capital efficiency if you choose to do so. 30-day average volume, that's your choice and how you like to trade, right? I like to trade with as many shares as possible. I want as much liquidity as I can find, but it could be totally different for you, right? One of my mentors, Mark Minvervini, he likes to trade low float stocks because for him, that fits his trading style. And when a low float stock starts to move, it can move very, very quickly, very rapidly. So for him, he may filter for under 500K. I like to be over $1 million, like I say. Now, if I'm building this for a bearish screener here, I'm going to go on the sell signals versus the buy signals. Simple enough. Price change. Now, this is a price correction change. So it's saying like over the last 5 days, show me ones that have corrected by 5, 10, or 20% or more. I'm not one who likes to use that, but that may be the way that you trade. I know Mahesh, he built it because he likes it that way. The oscillator. The oscillator, we're going to speak more about in a few minutes, but that's this blue line back here. So what this does is it essentially gives you Outlier's prediction on where the stock is headed, right? If it starts moving up, that's Outlier's prediction of, hey, this stock is starting to look like it's going to move up. If it starts turning and pointing down, that's Outlier's prediction of, hey, this stock looks like it's going to start turning down. And then when it goes sideways, right, there's not a whole lot going on when it's sideways. When it's sideways and in a white overlay right there, basically that's just dead money waiting for something to happen. Then the market cap, you know, if you like to trade small caps or whatever, you can filter that to any size that you want. Personally, I like to leave it wide open. You can filter it to any size of price that you want. I like $20 or more. The heat map value on the chart here on the bottom right here, you're going to see the behavioral heat map. I love the behavioral heat map. There is so much information that can be gleaned from this. And the way that you look at it is start looking up here and you'll see as I move my cursor, the R value change where it says heat map. Look where it says heat map. And you'll see it change from R48, R38. I'll go over here to G6. So this is the behavioral heat map. This shows how fearful and how greedy investors are looking at this stock, right? If it's super red, right, R47, it's very possible that you could see a snapback. I kind of think of it like a rubber band, right? The further it gets stretched from 0 to 50 on the fear side or the 0 to 50 on the greed side, the further it gets stretched, the more likely it is to snap back. So I love trading with that as an exit signal here. And you can see, you know, the volatility of the fear and greed can be quite stark, right? So lots and lots of fear. And then, oh, look at that. It got super deep in fear and then popped right back up. So it got super deep in greed and then it started to go back down. So just one of those cool indicators that we have inside of OVTLYR. And you can actually filter on that in your screener. And then the overlay indicator, that's these overlays back here that we talked about. So they can apply your filter. And like I say, this is the watch list on steroids. It's everything and more that the watch list has, and you can customize it to what works best for you. So I love the screener. The screener is one of the most time-saving things that we have come across inside of OVTLYR. And in fact, I would imagine that our users are loving this. And you tell me in the comments, right? How you're using this. I'd be very curious to hear, because for me, this saves me several minutes of time every single day because I can do, you know, I can click my saved screener up here and click, you know, run. And then it shows me everything that I'd want to see in my type of trading, my style of trading all at once instantly, which is super, super cool. I love that. So now let's jump into each of the, I'll tell you what, let's go back to SPY because the ETFs actually have some interesting data that is not inside of the individual stocks. So we'll look up here. You can type in SPY, or you could even go up here and click into any of the different ETFs that we cover, right? So in fact, let's go to financials. So this would be like XLF, right? So that's the financials ETF. We can see the performance summary, OVTLYR at 73% versus buy and hold at 50%. We can see capital efficiency at 3.34x. And now you know how to calculate that, so that's good. And looking down here at the constituent map, this is the data that is not on the individual stocks. So let's just say that we went to January 29th, 2024. Looking at the heat map here, we got a buy signal, but also on the constituent map, look at all of the green. Okay, look at the bottom here. All of this green, 246 companies, it changed because it goes on whichever day you're on. 256 companies reflected greed. Only 35 companies reflected fear. And the measure of this is how deep it is in the behavioral heat map. Okay, so the ones that are way up here have tons and tons of greed. The ones that are way up here have tons and tons of fear. In fact, if we go back to COVID, this should light up the opposite. Look at that. Look at all that fear, right? Do you remember the COVID meltdown, right? This was March 27th, 2020. A ton of fear in the market right there. It had okay, so this is funny. XLF, 270 of the companies inside of XLF showed fear. One company showed greed. So I think that's super useful. Definitely something you might want to check out when you're looking at ETFs. And in fact, as we go through all this, if you are curious about, hey, how does this work? Click these little buttons right here, and there's a video by a super handsome guy exactly how each one of these works. And there's my hash too. So we really tried to explain what every single thing is inside of here. In fact, even with the constituent map right down there. Then over here, the directional volatility histogram. This is an interesting chart because it tries to give you an idea of what the movements look like for this particular stock or ETF. If you have a super wide and a super flat set of data here, then it actually moves a ton in both directions, right? It moves a ton with big up moves, it moves a ton with big down moves, and a ton of volatility overall. But if you have, I always use Coke as my most boring example. Let's go to Coke real quick. If you have one that's really isolated in the middle, a lot more like this, right? This is a stock that's not really that volatile. Okay, a lot of the moves are very close to zero. I guess you could put it that way, right? It doesn't have these big 10% moves up or down all that often. Then you can go to something like AMC. And you can see this has really volatile moves, especially to the upside, right? Huge moves to the upside. And so that might factor into your trading one way or another. Maybe you build option spreads or something like that around these type of moves. Or you go the other way where it's Apple, right? I remember there was a point in time where basically you buy Apple, it goes up. And I remember for years thinking how dumb I was not buying Apple. And that's reflective here in the data, right? You buy Apple, it goes up. Right. There's only so much down frequency where there's so much up frequency. That's not the case anymore these days with Apple. But at one point, Apple was like the easiest trade ever to make. Okay. So we covered the constituent map. We covered the directional volatility histogram. On the stocks, the constituent map is replaced with some stock information just for that one. Let's jump into the chart up here. And so we've got the overlays we talked about. We talked about the blue line is not a moving average. This is our price trajectory oscillator and the prediction of the price trends. And then you've got the behavioral heat map down here. And then probably the most exciting thing, the one that you're here for, is the buy and sell signals. Now, the buy and sell signals are not on their own. The buy and sell signals take into account everything that we talked about, everything that's on the chart, all the data points included, and then it builds a buy or a sell signal. And I'll give you some pro tips on this, right? We've traded a lot with this. I started trading exclusively outlier signals last May, and I lost a lot of money last summer because I didn't know how to use it correctly. So Sebastian, who's on the line right now, he threatened me with my life one day. He's like, Chris, why do we have so many losers? And reason being is that there's a sell to open and a sell to close. There's a buy to open and a buy to close. Now, like I say, this is my own personal use of it. This is pro tips. This is not company policy, I guess you could say. But let's jump into it and I'll explain what I mean. So this signal right here, right? You've got this red sell signal inside of a green overlay. You can see the price trajectory oscillators pointing up, and you can see the stock itself is trending up. I would not short that. No way, Jose, would I short that. But I would take it as a sell to cash, sell to close, sell to go to cash, right? And then you can see here, this one, in fact, let me zoom in a little bit better. You can see this signal right here being a buy signal in a green overlay in the stock that's trending up with the price trajectory oscillator also pointing upward. That would be a strong buy. Okay. That would be a very strong buy. Whereas this one right here is not a sell to close, or I'm sorry, not a sell to open, not an excuse to go buy puts, not an excuse to start shorting that stock. That is a sell to close, take your money. And you can see right here, we're not trying to pick the very top, very bottom, because it did continue to go on up, right? And then we got another buy signal, and then whatever happened after that. Let's go look at Boeing. Oh, Cam said, great cover call stock, probably on Apple. Now, Boeing has been getting absolutely destroyed lately, but one of the very greatest signals I ever saw was this one right here. And it went up $70 during this time right here. It went from 193 up to 260. And, you know, OVTLYR totally nailed this, but you could look at it the other way, right? Where I said I wouldn't take a long signal inside of a red overlay. If you had taken a long signal here, you could have done great. And so that's what I'm saying here is like, it's not company policy, you know, to give strong buys, strong sells, but taking it from a holistic perspective, right? Boeing had reached a very oversold point, and then it got a buy signal, and then it started to go well on up, and then it got a sell signal right here. So yeah, lots and lots and lots of really great information inside of OVTLYR. In fact, let's go to, I keep going to this page here because this is all the features. If you want to learn more about what each feature is, definitely check out our features page. You should get lots of information right there. Let's go to one that's got a buy signal today, just for fun. OVTLYR bullish. Peter says, maybe an idea to be able to look at a time frame in the directional volatility histogram. Volatility histogram. So, oh, down here. I see what you're saying. Yeah, that makes sense. You know, one thing that's cool about this is you can zoom in, right? It starts out here as at the max view as weekly candles, and you can zoom in and they seamlessly change to daily candles. And then you can drag this bar around. That helps a lot. But yeah, you're right. The directional volatility histogram is all the data over time. So let's go to Amgen. Let's go look at Amgen stock here. So this is one that came through on a buy signal today. It's got the directional volatility oscillator pointing up. It's not like a huge pointing up right now, but the direction is going up. It's inside of a green overlay with a buy signal, and it's actually like right at zero, G0. It's not too over greedy or too over fearful. So to me, that's an excellent opportunity to look into a stock. In fact, this one has a 65% historical return versus buy and hold at 42%, capital efficiency at 2.89x. So that is the way that you can use all of the data inside of OVTLYR, right? There's a ton of data in here. And realistically speaking, I think the screener is the best use of your time in OVTLYR. Once you understand what all the pieces are, what it's asking you to filter for, and then going in and adding your criterias into the screener here, you can instantly get that data, right? You can instantly know, hey, okay, this is exactly what I want to see. This stock fits my criteria. I'm moving forward. And in fact, you can see me doing it live every single day here in the trading room using the screener because it works. So that's everything I wanted to cover. Do you guys have any questions about any areas in particular inside the platform that I could cover? I'll give you just a minute to type those questions in. Market's not looking so good. Not looking good at all. In fact, if I ran my bearish screener, let's do that. While you're typing those questions in, I'm going to run the bearish screener. Let's go look at, there were only two that fit my criteria today. BP and triple V, Valvoline. Cam asks, Where's the features located again to see the videos? Right on these blue, like YouTube looking buttons. We have the videos for each thing, right? Buy and sell signals. And for example, Mahesh and I talk specifically about each of these signals, how I use them, how he uses them, and how they're built. Or then you could look at a price trajectory oscillator, the blue line on the chart here. So it's got an explanation of how that works. So hope that helps. Very cool. Michael says it'd be great to have a field or positive. Great to have a field for positive for the sector. Oh, yeah, we've talked about that. Having the sector screener in here. What I've been doing is just going through each morning before I start my workday, basically, and coming through and taking a look at where the stocks are, where the sectors are, right? And be like, oh, look, the healthcare sector actually just turned bearish, right? And this is not something you have to do every day. It's not something you have to obsess over because, as you can see, here's a great example, right? It's very cyclical. It may go 2 weeks one direction and then another 2 weeks in that direction. And then it may go 3 weeks the opposite direction, right? These don't change very much, but it's definitely something to keep an eye on for sure. Cam says, all right, got it. Joel asks, are your signals for buying puts the exact opposite for buying calls? Joel, it absolutely, most certainly is. And tell you what, let's do some analysis here on BP, right? BP came in with the sell signal today, and it has a red overlay. Its heat map value is R10. So for me, that's everything in Outlier I need to see to start looking for buying puts. Now, of course, there's more to it, and we cover all that stuff every day in the trading room. But yeah, BP absolutely looks like a great candidate for buying puts. Not today, for me. For me, not today, because the market is not quite trending down, but it's getting close. It's getting pretty darn close. In fact, if BP gave up that area right there, yeah, that looks pretty ugly. Ugly if you own the stock, I'll put it that way. Tug says, concerning your screener settings, what's your thinking for $20 a share? So that's a really good question. And this is a personal preference for me. What I have found is that in fact, there's an old adage where it's like, a stock is cheap for a reason. The stock is expensive for a reason, right? I'm not really not interested in buying a stock that's an $8 stock, right? If it's an $8 stock, that means nobody wants to buy it, right? I mean, let's look at Peloton. Peloton is a $4.75 stock, right? Peloton had its day. I own a Peloton. I haven't used it in like 2 years. It's upstairs and I have not touched it, right? Now, it's cheap for a reason. And let's zoom out a little bit more. In fact, there's some notes on when I've traded it previously. I mean, how high did Peloton go? Did they have like a reverse split? It looks like good gravy. No, I guess not. Peloton at one point was $171 stock. That's a valuable company, right? A stock that's got $171 a share, probably multi-billion dollar company at that point, right? That's a company I'm interested in. That's a company I want to own. That's a company where, buying calls on that sounds pretty good. And let's say the opposite's true, right? If I were to buy puts on Peloton, it's $4. Like, it can't go all that low. So buying puts on a $4 stock, like, there's only so much you can make on that, right? So by getting a $20 limit, and like I say, my own personal limit, you could decide, up to $5. Maybe that's the way you want to trade. For me, that gives me stocks that are a lot more liquid. More people want to trade them. More people want to own them. And, a better stock that I can actually make more money on those type of movements. Makes sense. It's not your clothes hanger? Yeah, during the pandemic, Peloton was absolutely crazy. So I appreciate you all giving me the time to go through all of this today. Tomorrow, the plan is I'm going to be doing a special live stream at 2 o'clock Central Time, 3 p.m. Eastern Time, talking about how Outlier helps you save time, make money, start winning with less risk. And then we'll come into the trading room. We'll do a very brief overview of if there are any trades to put on, maybe a plan for starting out next week, and then we'll cut it out early. I don't plan to do any lessons tomorrow because you know how Outlier works. If you don't, go watch yesterday's video, and you know all the spots inside of Outlier on today's video. And then next week we'll start with the market trend. Or no, next week we'll start with the master key. We'll talk about how it works, why it works. Right? It's not just a checkbox. Right? I do so much consulting with financial institutions, and everything that I do with them sometimes is just a checkbox. Like, okay, just did that, cool, good to go. This matters. This means something. This is important. And these are not just checkboxes. Like, these have a meaning. And I'm going to explain to you why they matter. So tune in for that on Monday. But otherwise, I'll see y'all right back here tomorrow. Have a great afternoon. We'll talk soon. This is the percent of stocks on the bull list, the percent of stocks that have buy signals here. And as you can see, it's very cyclical, right? And right now it's trending downward. And when it's trending downward, like less and less stocks are getting buy signals and more stocks are getting sell signals. So from a macro perspective here, when the market is moving one direction or another, yet it doesn't have the breadth behind it, I would consider this a very weak trend, right? We've seen some very powerful moves down in the last couple of weeks. And in fact, this morning, it was a pretty powerful move down. This candle, top to bottom, is a 2.4% candle. That's a huge candle. That's a $13 move on the SPY. Now, market breadth being weak like this can absolutely have movements that you weren't necessarily expecting. In fact, let's break that down a little bit. The more people that are participating, the more liquid a stock is, the more liquid the market is. And you can think of the market's liquidity through market breadth, okay? More people buying, pushing up the buy signals, pushing up the market, okay? So they're connected, right? The market and the breadth, how should I phrase this? The way that I had heard it described to me is it's like the market number, the number of the market, right? The market average is like the general, right? And if the general is moving higher, if the general is moving one direction, yet all the soldiers, being the individual stocks that make up the market, if the general is moving one direction, if the general is moving north and all the soldiers are moving south, then the general is very weak. Then the general is left vulnerable. Then the general can retreat very quickly to where his soldiers are. That is a really decent analogy. I would highly recommend going back. In fact, I'm going to save this video and use this as like a market breadth explanation here, because the more stocks that have buy signals, the more stocks will push up the market. But when the market moves like this, while the breadth is coming down, that leaves you vulnerable. That leaves you like the exposed general. That leaves the market in a weak upward trend. Now, when they move together, when the breadth is going higher, meaning more and more stocks are getting the buy signals, that inherently pushes up the market, right? It's like filling up the bathtub, okay? When more and more stocks have those buy signals and the market is pushing higher, it is a very strong trend moving in one direction. But when you have the dissection here, when breadth is going down while the market price may be up for today, it's a very weak trend. So I would be highly, highly cautious. Now, yesterday, we didn't take any short trades, even though I really wanted to, because it had closed above the 50 period moving average. And this morning, it was well below the 50, and it's popped right back up over the 10, over the 50, and over the 20. So this is really key here, right? This is a crucial level. If we can see, and in fact, we've got an order block right above this. So I would actually see, I would expect some reversals. In fact, let's do Chris's prediction time. Let's say, I don't think it gets up to that order block fast. Let's say it takes, I could be totally wrong, by the way. Let's say it takes 2 more days to get up to where that order block is. And then the order block rejects it. and then it bounces around in this area for a little bit, and then back down. That's what I think is likely to happen. Doesn't mean that it will. It's just what I think is going to happen. Let's catch up in the chat here. Peter, good to see you. Cam says, it's all good. I thought it was going to be interactive broker platform that the deal was going to be done with. I'm looking forward to the big news. I will tell you, we're not making any deals with interactive brokers right now. That's all I can tell you. Peter is watching in VR. Dang. Oh, hang on, Peter. I'm going to mess with you at this point. Oh, Peter. Very cool, Peter. Question about sizing trades. How do we account for various option pricing? Different expiration dates have different prices. Yes, they do. We'll talk about that in a minute. Unless there's a mutiny. Unless there's a mutiny with the general and the soldiers. Sebastian made it. So yeah, that's what I want to cover today. You want to have the market breadth and the market trend being in price. Market trend and market breadth moving together because they work together, right? When one is moving opposite of the other, it is a weak trend, either direction. And you don't want a weak trend, right? You don't ever want a weak trend. Who wants a weak trend? Who wants to buy a stock who is just in a weak trend? Right? That's like going to a car dealership and you've got two cars there. One is a Hyundai, one is a Lamborghini. And you are trying to get from point A to point B as fast as possible. They both cost the same. Which one are you going to pick? Clearly the Lamborghini, because you need to get from point A to point B as fast as possible. You want to grow your account as big as fast as possible, right? So why would you go with the weak car? No offense if you drive a Hyundai. Why would you go with the weak car with like a weak trend, weak breadth, when you could go with the fast car when the trend and the breadth are moving together? Does that make sense? Right? We want that strength behind us. So I won't be taking any trades today, unfortunately. I wanted to, but it didn't set up, right? And this is another reason why I trade at the end of the day. Right here. Well, it'd be that way. The screen's over there, but it's over there on your screen. This is a great reason why I trade at the end of the day. Because when all the liquidity came in, what happened? Price went up. So won't be taking any trades today, unfortunately. I feel like there was a question in the Discord. Let me review the Discord real quick. Because I dealing with my computer, I haven't been as on top of things as I have been. Hang on. Stole the wife's laptop. Yes, so the screener is going to be fixed by tomorrow. Mahesh is literally working on it right now. I think that may be it. Oh, there was a question about order blocks. So order blocks are super cool. In fact, there's a great one right there. Let me zoom out just a smidge, and you can see some order blocks down here. Order blocks are a great way to see. Peter says that was indeed scary. Order blocks are a great way to see support and resistance. I was never a believer in support and resistance. I thought it was one of those things that those Forex trading gurus made up. But here's a great example. Here's a great example. This order block was created on April 30th, right? And then price went up, price went down. It kissed that order block within a couple pennies and rocketed up from there, right? That's not coincidental. We've seen it time after time after time. Here's a perfect example here. It went up, order block created in February, down, went right in that order block, and then went up after that point. Order blocks are powerful, but you don't have to have TrendSpider to get them. I don't know what other chart platforms have it, but I feel like a couple of people are saying TradingView, and they may not be specifically exactly the same, but this is my criteria. It doesn't even give me anything to choose from other than the number 50. Okay, there you go. You can change it to whatever number you want. I think the default, at least in TrendSpider, is 20 something, like 24 or 26. But working with this, seeing how it works, I saw that 50 seemed a lot more 50 seemed a lot more realistic advantageous, effective. That's the word. Seemed a lot more effective than 24. It's going to make minor differences, but either way, I thought that was pretty awesome. So wanted to share that with you. Brian says, I need a PC sponsorship. Dude, I would love a PC. Could you imagine what kind of baller ass PC if I had a PC sponsorship? Max says, I use TradingView and it looks very similar. It's close enough to TrendSpider. I agree. Got here late. Well, good to see you, Randy. Glad you made it anyway. Randy, the market has recovered. I ain't going short. I don't think you should either. Okay. I believe that was everything I wanted to cover today. We talked about the scanner or screener. We talked about market breadth and how important that is. I think we're good to go. Okay, let's wrap it there. As far as I know, my computer should work tomorrow, so there shouldn't be any issues. But if something does go crazy, I'll let you know otherwise in the Discord. But again, this market right now, it's going to chew up a lot of people. You don't have to be one of them. Follow the plan. Follow the rules. The rules are proven to work year after year. And I would hate for you to go rogue and totally get botched. Oh, no. Tug had a question. I knew that there was something I was missing. Tug had a question on sizing trades. How do we count for various option pricing? Explain. Okay, give me a second, Tug. Let me log into Tastyworks over here. Talk amongst yourselves while I log in, please. All right. Let's load this in. We talked a couple days ago about the math behind position sizing and why ATR is so vital. I would highly recommend, if you haven't seen that one, go back a couple days because we really went into how you can trade Coke and you can trade Tesla at the exact same risk level in dollars to your account, even though one has 12 times as much ATR, and ATR meaning volatility. One has, I think it was 12 times as much volatility as the other. Tesla has 12 times as much volatility as Coke, yet you can equalize the amount of risk to your portfolio on every trade. So would highly recommend reviewing that video. But to Tug's question here, he's talking about position sizing on option pricing. Okay. So yeah, for sure. Let's drop the September 20th and October 20th. Good gravy. There's so many strikes on the SPY. Let's go to Coke. Coke is my default, like, boring stock. All right. So let's say that I want to buy an 80 Delta Coke on the September 20th. 80 Delta, let's say that's the 70s. Okay. So that's, let's say mid price is $1.20. All right. Now let's say I want to buy the 80 Delta in October. It's going to be a different strike for sure. 80 Delta in October. We're going to have to round because they don't have all the strikes here, but 67.5 versus 70. Okay. Now this one being $1.20, this one being a lot more, right? Let's call it 385. So the difference between the two is $2.65, like 3x what the first one cost. Different expiration dates had different pricing. Yes. Now, I don't have that built into here. And that would be almost impossible to build into here because it does have different pricing. It will always have different pricing, and there's no way to account for that. So whenever I build this based on share size, and then I equalize that because I usually around the 80 Delta. So I always divide my share size by 80 to get me number of option contracts. Now, to your point, you could go to the September 9th or September 20th, which is 9 days away, and get 3 times as many as you could in October for the same notional value to your account, right? Let's say if you had $380 you wanted to spend, that would get you one option in October, or 3 options in September. Totally valid point there. I don't worry about that. Like I say, I focus on position sizing based on shares. I divide that by 80. It's usually the delta that I end up with is the 80 delta. And then whatever the pricing comes out to is what the pricing ends up as. Generally, that hasn't really been an issue for me. Of course, sometimes you'll end up with 10 times as many options as you would on a different stock. But there's not a real way, in my opinion, and I could be wrong, to normalize that betwixt expirations. So I don't worry about that. I just focus on hitting around the 80 delta. As long as everything else falls through, it's not been an issue for me. So I don't know if that is a great answer to your question. But the point is that yes, there is a difference in pricing. And there's not really a way to normalize that out. So I just focus on the share size and then I divide by 80 to get my option size. Max asks a question. Why do we rely so much on the SPY? The SPY is the general, right? The SPY is the general. Why would you rely so much on your steering wheel of your car? Because it's going to point you in your direction. Why would you rely so much on the gear shifter of your car? Because it's going to move you forward or backward. Why would you rely so much on the glasses on your face? Because it's going to give you clarity so you can see where you're going. The SPY rules all. Replace that with any other market index you want to. You could replace it with the Qs. You could replace it with the Dow, DIA. You could replace it with the futures of ES, right? Point is that it's to Randy's point, exactly. It's the 500 largest companies in the United States. And that is the market benchmark. That is the benchmark set by everybody. This is the index that is tracked by everybody. And that is, like I say, it's the general. So that is the reliance on SPY. It doesn't mean that there isn't a better thing to rely on. Sure, I mean, in theory, in fact, a lot of brokers, I don't know, maybe not a lot of brokers, but I know one thing that Tasty Trade would do is they would try to give you a beta weighted delta. Beta weighted, meaning there's a bug in here. Good gravy. Beta weighted delta, meaning like how is your performance stacked to some sort of index, some sort of baseline, okay? The SPY is the baseline for 99% of people out there. Some people might say, okay, I want to know my returns relative to Amazon. You could beta weight to Amazon. You could beta weight to Tesla. You could beta weight to anything. But the SPY is the index. The SPY is the benchmark. And so that is why, and you can do whatever you want, Max. I look at everything from a top-down perspective, and the SPY is the top. The SPY tells you where it's going. That tells you where the market is going. If the SPY is going up, the market's going up. That is a fact. But you can't say the same with Amazon, right? Just throw a stock out there, right? You can't say the same with Amazon, okay? Because Amazon isn't the market. You can't say the same with Nike. We looked at Nike yesterday, right? Because Nike's not the market. The market is the SPY. That's why I look at it. Thanks. Clear now. Very cool. Wes says it's a great set of rules to stay safe. I know, dude. Cam says that was a great session where we talked about position sizing. Glad to help. Tug says that works. And Wes says, don't you try to stick to around 3 to 4 weeks? Yeah, absolutely. But to your point, those 3 to 4 weeks. So I usually go 21 days to expiration. I will fudge that. I will fudge that if needed. In fact, when I was looking at Etsy yesterday, I'll give you a great example of fudging that I was ready to do. Had we put on Etsy, which would have been a great trade, I was ready to go, not in October, but to September. Here's why. In October, the puts, we got to look on this side for puts now, not on the call side. The puts basically had no liquidity except on the 55s at the 69 delta. And at the time, it wasn't liquid enough for me. I mean, number of contracts was good, but it wasn't the spread. It was the extrinsic value was too high. And I was like, that's not so great. However, if I pull in here and I look at the 80 delta on the September 20th, so 9 days out, the 80 delta was super liquid at over 4,000. This is 15 cents wide. There's hardly any extrinsic value, 5% extrinsic value. I was like, oh yeah, I'll trade that. So it's a guideline, but I will fudge that every now and then if needed, more for liquidity's sake than anything else. So, all right, cool. Covered a lot, didn't we? Thank you all so much for coming. I really appreciate your time. We do this every day to help you out. This is something where we feel here at OVTLYR, and this is one thing Mark mentioned this morning. He said, Chris, we really need to stress the fact that we couldn't do this without you, right? We at OVTLYR could not do this without you, and we are eternally grateful, and we would like to return the favor by trying to make you as much money as possible. So thank you all so much for coming. We will try again to go short tomorrow, but if not, we'll continue to control our risk and wait until something pulls through. Thank you so much for coming, and we'll talk soon. I've been trying to understand the risk management side of your formula and would appreciate your input to confirm your calculations are correct. Here's the summary of my math. Account value and risk capital. Account value, 100 Gs. Risk capital, 5% is 5,000. Absolutely, you nailed that. No doubt about it. So that's this right here, 100,000 times the risk that you're comfortable with. Now, position sizing and stop loss calculation. ATR value, okay, so as example, ATR value is 1.5. The full ATR stop distance would be 3. So 2 times 1.5. You nailed it. Absolutely. Wait, hang on. No. I misread that. I was thinking something else. Okay. Full ATR stop loss distance. Me personally, I like half of an ATR as my stop loss point. You can do whatever you want. I got that from the Complete Turtle Trader. That's an amazing book if you haven't picked it up. I know we've talked about it before. Do definitely pick up the Complete Turtle Trader book. So a full ATR stop loss would be 1x the ATR, a full ATR. So it would be 1x 1.5 here. Half ATR stop distance is 0.75. It's just half the ATR. Yes, and that's the one I would go with. I wouldn't go with the full ATR. You can do what you want. That's what I go with. Number of shares calculated based on ATR, which should equal pretty much this, right? So 2 times the ATR value is used to establish the volatility. We talked on Friday just how important it is to position size based on volatility, and I showed an example. In fact, I would recommend going back to Friday's video if you have questions. My camera has moved. I look like I'm like falling out of my chair. Give me a second here. So I have this really cool camera that can move. It can move and track me, and I don't always want that. I want it like set. So there we go. All right, back to the story here. So the 2 ATR value is to set the volatility on your position size, not necessarily the full ATR stop distance. True risk calculation with a half ATR stop loss, 25% of the full ATR stop loss distance. Oh, I see what you're saying, because it's 2x the ATR. I get it. I don't think you're far off. I think we got off a little bit on the full ATR calculation here. It is 2 ATR on purpose, right? It actually should give you less than 5% in risk on purpose, right? We're starting there and we're adjusting based on our position size. We're adjusting our position size based on volatility. The more volatile it gets, and so this is what I was trying to say. On Friday, we talked about how on the SPY during COVID, it went from, I think it was a 5 ATR. No, it was a 3 ATR right before the COVID meltdown. And then it went into a 15 ATR. So it was 5x. That's what it was. It was 5 times bigger on the average true range, which means your volatility expanded. Okay. When your volatility expands, you want to trade a smaller size. That's why this is in the denominator, because it'll reduce the number of shares you would take in this case by being in the denominator versus not being included at all. In fact, let's do this math. Let's do this math here. So let's say we have 100,000 and we have 5 in risk. Okay, so that's our 5,000 risk that we talked about. And then we're going to say the ATR is 1.5. So we're going to say this divided by 2x this. All right, that's the number of shares. That is the example that I give. Okay. Now, if volatility expands and the ATR goes from 1.5, and let's say it's 5 times higher, equals this times 5, exactly the same situation as the SPY we talked about, you would be so much less. You would take 333 shares versus 1,666, right? A tremendously smaller position size based on the volatility. It's so important to base on volatility. And that's one of those things that pro traders do, right? I don't just pick a number and go for it. There is zero reason to just pick any number and be like, oh, I would love to trade 27 contracts. Why not? The last one I traded was 27 contracts. The example I always give is Coke and Tesla. Okay. And we'll do a live example of those, in fact. So let's say this is Coke and this is Tesla. Let's go get the ATR values for both of these. All right, Tesla's ATR value is currently at 1165 on the bottom right here, this line, 1165. Coke, their ATR value is 0.992. So you could say 99 cents. You could have 2,500 shares versus 200 shares and have the same risk. That's a big difference. That is a huge difference, right? But when you do that, you're still basing it on the 5% position size. Okay. And then, so let's work on the math on this, right? And see the actual risk, because it's more than likely going to be less than 5%. So let's say we take it at what's the current price? 71.86. And we take a half ATR off of that. So 0.99, we'll just round to 0.5. So 71.36 is a half ATR. We'll just say 71.35. So if our opening was 71.35, our half ATR, oh, that was half ATR. Current price opening. So that is how much? This minus this. Okay. It's not 0. Shut up, Chris. There you go. All right. So it's 51 cents of risk times the 2,500 shares. It's actually $1,200 of risk versus 5,000. And that's by design. That is by design. Yes, we're saying we want to take 5% of risk. Okay. And you can't always get out at the half ATR, right? There are days where it's gap down and it freaking sucks. But if this is where my risk is starting and this is where my risk is ending, I'm comfortable with this risk, but I would much rather take this risk instead. So let's do the same for Tesla. Like a tornado in Colorado, stay safe, my friend. 1165 is huge, yeah. So this is why it's a great example here. And that's why I always use those two. All right, Tesla is currently trading at 216.92. And if we take 1165 divided by 2, let me subtract that off of 216.92. 211.09. And the opening price was 216.92. Huh. Would you look at that? It's the same amount of risk. Who would have thought? That's why it's so important. Okay. Isn't that cool? Right. So you can trade Coke or you can trade Tesla, and either one, if you're able to get out at the half ATR value, basically, like if you took a stop loss at the half ATR, would be nearly identical. Super ultra close. That's why I say you can't just roll in and say, okay, I traded 100 shares on this stock. I trade 100 shares on Coke and 100 shares on Tesla. I have the same amount of risk. I have 100 shares in both. Not even. If you look at it, you actually have 12 times the risk because of the ATR value is 12 times bigger, give or take. Randy says, nice. So this is by design. Right. This was not my design. I wish I could take credit for that. This would be from Richard Dennis. Richard Dennis is basically the star of the Complete Turtle Trader book. Let me show you Richard Dennis. Richard Dennis puts me to shame, absolutely to shame. He made, I think it was $180 million by the time he was 28. I mean, good gravy. Yeah. Richard Dennis, one of the market wizards. Is he still around? Yeah, he's still around. Dude has made ludicrous amounts of money. But that was one of the things that he taught his traders, and traders all over the world should still follow, is base your position size on volatility. If you can do that, you can trade vastly different markets. You can trade vastly different stocks that have the same risk. That helpful? Let me know in the chat. Is this helpful? All right. I'm trying to do my very best to give you as many teaching moments as possible. All right. So much better than chasing growth stocks with blindly using 7% stop loss just because the orange book said so. I know that book. I know exactly that book, Wes. Turtle Traders is a great book. Read that last summer. It is an incredible book. Dave says, very helpful. Awesome. All right. Well, I'm not taking a trade today, even though I really wanted to. I honestly was thinking about it all weekend in Citibank, but the heat map's already stalled. So no, thank you. But we'll be back tomorrow. We'll try again. And hopefully my PC will work, right? Hopefully I don't have to buy another one of these for tomorrow. But either way, thank you all so much for coming. Why we use order blocks. Now, order blocks are outside the scope of OVTLYR, but they are honestly one of the coolest things I've ever come across on a chart. We're going to focus on the order blocks here, but there are millions of indicators. I mean, millions of indicators. And if you add in the settings for each indicator, we're talking about billions of combinations potentially. And there was one point in time where I had stochastics, MACD, multiple moving averages. I don't know, you throw some in the chat, right? Some that you've been looking at, maybe a squeeze indicator, right? There's so many indicators out there, right? If we go into TrendSpider here, we can see, oh yeah, Bollinger Bands, Donchian channels. I traded with those. Let's see, there's so many. Choppiness index, Elliott waves. Let's see, whole moving averages, Ichimoku clouds, Keltner channels, traded with those for a while. Moving average ribbon, pivot dots daily. I don't know what that is, but like there's hundreds and hundreds and hundreds and so many combinations of them with indicators, right? And VWAPs, all kinds of stuff. What I have found is 3 moving averages, which we'll cover that moving averages tomorrow. 3 moving averages, order blocks, ATR, which is just for position sizing to me, and then the outlier signals, right? There's so many potential things you could look at, but I'll tell you, I've done the work, I've done the research, I've done the trading, and I've made the money to let you know that you don't have to look at everything. It is super fun. It is super exciting to layer on all these different indicators on your charts. But as you see on my charts, they're pretty clean. I got 3 moving averages, order blocks, and ATR at the bottom. Let's see here. Brian says, glad these slides are a live document. Yeah, dude, I'm always making changes to them. Randy says a VWAP, like ankle VWAP, anchored VWAP, ankled VWAP, right? Anchored VWAP. I had Brian Shannon on, and his thing is anchor VWAPs, and he was really cool. I think I've chatted with him a couple times. He even sent me an autographed copy of his book, so I appreciated that. But oh yeah, Brian talked about Brian Shannon's book specifically. That's in my autograph book collection. I have a little collection of autograph books. Randy says Fibonacci's, RSI. Yeah. I don't understand anchor VWAPs. And you could go back in my podcast history and find it. I'm telling you, I looked Brian dead in the eyes and I'm like, I don't understand. What are you anchoring this to? Because there's like, how many candles are on this chart, right? Right? Let's say there's 100 candles right here. What do you anchor to? The bottom one, the top one in the middle? And are you just like picking one at random? Right? Why does this one matter more than that one? Why not the one right before it? So I don't like subjectivity. I don't think you should like subjectivity in your trading either. It needs to be binary. Yes or no. Is this above? Is this below? There's no room for interpretation. Okay. So here's one of the really cool things, like I said, is order blocks. Order blocks are large institutional orders that are sitting out there waiting to be filled. They're waiting to be filled. And until they're filled, they're going to show on the chart when you add these in as a shaded area like this. And I mean, some of these go back months, right? Like this one right here was made in February. This one right here was made in April. This one right after that was made at the end of April. This one here made August 27th, and this one here made September 6th. So order blocks are these key areas where there are big open interest, open orders ready to be filled, right? When prices come into that area, expect them to be filled. Now, these also could work as support and resistance. Support meaning it keeps the price above that point. Resistance meaning it's like the glass ceiling, as they would say, right? It's difficult to overcome and get over that point. Now, let's look at this. So there's a big order that started on this day right here on August 27th. And we've come right into it for the first time today. And wouldn't you know, we're wicking up into it. And then it looks like we're going to close maybe right at the bottom of it. And then this one here was created on September 6th, a big order right there. So these don't necessarily have to be sell orders, and these don't necessarily have to be buy orders, but they're just big orders waiting to be filled. So let's talk about why that matters. So this one right here, made November 29th, has never been touched. And the longer this goes and the more they get stacked right here, the greater that support in this case would be. So this one here, created February 13th, price came up, price came back down, price went into it by 1-2 candles and then bounced back up, right? So until it closes on the opposite side of it, the order block remains. Once all those orders are cleared, that's when it will be on the other side of it, and that's when it goes away. And then so price hit that area, came back up, bounced down. So 1, 2, 3 candles tested it, and then came back up. And then in that process, another order block was created on April 18th. So this one from February exists. Then another one just got added in February or April. And then this one had a couple of candles moving in and out of it, but it never closed below it. And then another one, April 30th happened. And then boom, rocket ships, right? And then we hit a high on the market, came down to this very first, the very highest order block. And I mean, it's within pennies. Boom, rocket shipped right back up. Like, it's not coincidental. Not in the slightest is this coincidental. But it doesn't mean it's guaranteed. I'll put it that way, right? At some point, price is likely to go through that, either up or above or below. It's likely to happen. But when you get to these points here, I don't trade against them, right? Let's say that I have a stock set up and it's coming right up into this area here. I'm not going long. I'm not going long because, you know what? There's a good chance that it could get rejected at this order block. And I'm not going to go short on this particular stock either, because there's a great chance that it's going to be rejected when it hits this area. So there is absolutely any chance that this could bounce around for a while. So let's look at a couple other stocks. I'm literally choosing these at random. You could throw some in the chat if you wanted to. Amazon. This order block created in January. I'm sure that there were some otherwise. In the meantime, this one got decently close, a couple dollars, maybe, yeah, a couple dollars away and back up. Here's another one created in March of 2023, is still waiting to get filled. And let's zoom into that. The first time price came into it, it bounced up. The second time price came into it, it bounced up, continues on its way. Let's look at Etsy. I have that one handy here. Zoomy. All right, this is a good one from the other side. Oh, this is a great example. April 2023, price came in and out of this order block and then went down and back up and down. And I'm sure, like I said, there were other blocks that have been closed in between that time. Price comes up. Look at this. This is not coincidental. Price comes up, wicks into it on this candle here, July 21st. Let me make this even bigger. It wicks into this order block, comes back down, wicks into this order block again, comes back down. These are powerful. Wes wants to look at Tesla. Oh, and you'll find these at all-time highs as well. I remember there was one on Netflix. We'll come back to Tesla in a moment. There was one on Netflix at its all-time high. And I told Mahesh, don't trade that because it's going right into an all-time high order block. And he traded it anyway. I'm going to draw one for you just for fun. It was... the zooming skills are not that great today. Hang on. This order block was right around here. It was at the all-time highs, which was in November of 2021. We got a buy signal. I guess it was around here in June, late June or July. We got a buy signal in OVTLYR. And I literally was like, I'm not going to take this trade. Mahesh put on that trade. And I sent him a text. I'm like, you got an order block right above this. Be careful, Mahesh. And then price came in, out, in, and then down, right? Now, it did eventually come up and close right above wherever that spot was. This is my order block. It could be totally wrong. But it's decently close, right? Let's say it was right there. It closed just above that point where the order block went away. So remove it. Now there's no order blocks in the way of it. Let's go back to Tesla for Wes. Oh, look at this. Huge resistance overhead. Huge. You've got 1, 2, 3, 4 order blocks on top of Tesla's price right here. So let's go back to when these were set. In fact, let me zoom out. Is there any more? No. My zooming skills are all over the place today. Apologies. Here's an example, a pretty damn good example. Price came up from around 225. Order block was created right here at 304-ish. It didn't close above that point. Here's the key. This is why it hasn't gone away. It didn't close above that point. Closed right under it. Came back down. Price came back up. Didn't close above the order block. Price came back down, right? So rejected once. Rejected a second time. And then down. Do you see why I don't trade against these? I mean, this is data on a chart that I couldn't imagine trading without at this point. Here's another time. Price came up, got pretty close, rejected. Solidly rejected. And then other times where order blocks have been created. Right, this one here in September 2023. First time it came back up into it was October, rejected. The October order block, rejected it in December. And then it happened again. It came up in July of this year, rejected. And then a third order block was created. So there is some overhead resistance like crazy right here. It would be tremendously difficult to get over that point. So why fight it? Why fight it? Right? You've got the data. You can add this to any chart. It's not available on all platforms, and for that I do apologize because I only use TrendSpider. But if you wanted to add this as an indicator, it doesn't give you any real settings to change other than the sensitivity of 50. That's what I use. I think the default's like 28, but I use the sensitivity of 50. I've seen 50 be a lot more relevant on the results here. But I mean, they're crazy. You could put Coke. Coke's my default boring stock. Create an order block here, another order block, an overhead order block right now. Let's see. Here we go. An order block created in May. Price came up. Price went back down. Price came back up. Price came back down. Price continued on. Wes wants to look at Apple. And I like showing all these different examples because it's not isolated to one stock. It's not isolated to one time frame. This works broadly. And it's really cool. Right? Apple's making an order block right here. Okay, so here's some way down. Let me remove my notes here. There we go. So these were created at the low in January 2023. So there was one created there, another one. You can see it tested it right here just by one candle. Then a third one was created. Then a fourth one was created. But it doesn't have any that came down into those order blocks. So that's not the best one. Let me catch up on the chat here. Michael made it. Good to see you, Michael. Brian says, using order blocks with price under a VWAP and 2 standard deviation on Bollinger Bands with MACD crossover is a good entry point. Dude, I don't know if you're being sarcastic or not, but that's a lot of stuff. Brian says, do institutions cancel the order blocks? I don't know. Because this is a chart related indicator, I don't know if when they do cancel the order, if it gets reflected in the chart, or if it just paints it on the chart until it closes under or above that order block. So I don't actually know on that one. Mahesh is here. After that, I took initiative to learn about it, and I'm always learning. Very, very cool. Glad you're here, Mahesh. Glad to see you on the live. Oh, speaking of, Mahesh is going to start trading live. Well, he won't be trading, but he'll be doing his analysis starting next week, starting next Monday. So we're going to have 2 live shows a day. So this is going to be great. His show will be at 10 a.m. Pacific time, which is noon o'clock Central time, 1 p.m. Eastern time. So you'll be able to see us twice a day. So that'd be really cool. Michael says, give a quick explanation of the sensitivity setting. Let's do this. Rather than me trying to explain what it is, because I truly do not know what it is. In fact, we might be able to go on TrendSpider's website and look at it. I wanted to just drop it over to like, oh, here. Rather than change mine, let's add it as a new indicator. And you should be able to see, because yeah, the default's 28. So it's going to plot different ones on here. Right, and it's kind of hard to tell because the colors are similar, but it did plot another one. Look at this in the past. And is that not a redonkulous result right there? Look at this. This one created in June of 2021. Price did its thing for years. Price did its thing for years. And what would you know? That one created in June 2021 shows to be the low, the exact low, where it bounced right back up. Isn't that cool? Maybe we add both of these on the charts. I don't think that's a bad idea either. So we could have both the 50 and the 28. I'll keep that on for now. That'll be fun. Oh, 10:30 a.m. Pacific. My bad. Looks like Buffett isn't selling Coke. And Wes says thanks. Yeah. Let's do a couple more just for fun. ADNT. These were on the bull list a couple days ago. Oh yeah, you can see, so the colors are a little bit different. So you can see that they're both like overlaying on each other. So if I take off the 28, yeah. I might add in both the 28 and the 50. After seeing that one on Apple, that was crazy. Let's see. This one doesn't really have a lot of price action at it. APO. Here's a good one. Oh, APO is a great one. So, created March 2023. Price bounced around there, came back up, bounced around again. That was the low. That was the short-term low. And a third time, came down, bounced again. Right? It's not coincidental. I don't know how else to tell you. This is math on the screen, and it's legit. If anybody tries to tell you, oh, just look for this or that to make the support and resistance, say, no, you don't know what you're talking about. You need to add order blocks in on your charts. And then they'll see something like this and be like, oh, you're totally right. Let's see. I don't think it has tested that order block yet. See, this is a 50 where the 28 isn't showing, where this is both where the 28 and the 50 are showing. Then let's go back to, oh man, these are really good order blocks. Look at this. All right, yeah, I'm going to keep the 28 on because this is a 28 order block here. So you've got a low set here in March of 2021. And it flirts in that area and then bounces right out of it. Price does its thing for years, comes back down after years later. That's the low. Bounces up, bounces down. Another order block is created, bounces, bounces, goodbye. Oh, look, it's back. It bounces in and out and in and goodbye. Right? Does anyone have any questions about how powerful or how to use these order blocks? Because these are crazy, right? Do you see how well these work? Let me know in the chat. Type in a number 6 if this makes sense. And if it doesn't make sense, type in your question because I'm here for you, right? Michael says, so I use TradingView and using the Sonar Lab order block indicator. I believe these are the same. They say the sensitivity refers to the number of blocks that are shown. Oh, well, look at that. You just taught me something. Yeah, when I click into the order blocks here, it says it's by Sonar Lab. So I assume we're looking at basically the same data. However, after doing this live with you, I really like the idea of putting both the 28 and the 50 on here to stack them both in, because this has given us tremendous results here. And the 28 continues out further. Yeah, that was the 28 that I just took off and add in the 28 in. And then the 50, take this off. Looks like pretty much the same data here. What about this one? Yeah, pretty much the same data. What about this one? Oh yeah, and so the 50 that I just took off was reflective on that one. So I don't see a reason not to have both in this case. Oh, Joel asks, what does a 50 or 28 mean? So that goes to the number of candles, number of blocks that are shown. Is it candles? Or is it a different type of block, Michael? Those were set for electricity. That's how far back they go. Speaking of electricity, let's go look at GE, General Electricity. I know that's not what it said, but why not? Let me remove my notes on here. All right, where's some order blocks here? Wow, look at that beautiful. That's what a trend looks like. That is a 10, 50, 20 right there, right? And that's what we're going to talk about tomorrow. I'm going to save this for tomorrow. This is a good one. That's what a 10, 50, 20 trend looks like. Oh, goodness. That went from November 6th up to, let's say right there, June 18th. So that was, how long was that? 159 candles, 84% gain. That's the power of a trend right there. Okay. Number of order blocks. Okay. Brian says, yes, 6. Oh, it's number 6. He's having 2 order blocks is even more helpful. This can be even more helpful for day traders. Oh, yeah. Good point. Let's jump into, so SPY. Let's go to SPY. And let's go to the 1 minute chart. Huh. Enough said. Huh. Order block was made. Price came down. Rejected. 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 This is on 1 minute chart. See if there's any others. Let's go to a 5 minute chart. Look at that. This is stair steps for days. Let's go to GE on a 5 minute chart. Here we go. Here's a good one. Order block created. Order block created. 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 And this is the first time it comes back down, kisses this area, and then goodbye. Isn't that cool? And then overhead one was created at 11:20. Price came in, flirted with it, gets rejected. Now another one's here. Right? There is no way you could tell me that this doesn't work. No way. Because I've seen it, I've proven it, I've shown it time and time again, and I trade with it and I make money with it. So there's no way you could tell me that this doesn't work. This is not one of those esoteric, oh, just look for support, just look for resistance, right? Like, I don't know how many Forex gurus I've seen who, you know, I kind of look like them. I'll give you that. They got the beard, they got the glasses, but they got the gold chains, which is stupid. And I don't know, the vibe of them is different. And I'm sure you can tell the vibe between me and one of those guys is different. In fact, I'm just going to Google up Forex trading guru just for fun. And let's see how closely I look like one of them. Wait, come on. No, not that guy. Here's one. One of these guys, right? All right, just throw some glasses on him and he's gonna look like me. One of these guys that take a picture in front of the rented out jets. Gosh, I wish I could think of one. Austin, I don't know him personally, but Austin Silver reminds me of that as well. He had that look for a while. So anyway, it's not a personal attack on him. I don't know him, but it's just a look that I've seen. But yeah, I've seen so many of them on the internet be like, you got to look for support. You got to look for resistance. How do you explain that? How do you articulate that? How can you show me on a chart in a mathematical, in a completely objective, 0% subjective way? This is how you do it. This is how it's done. Randy says, wow, on that GE trend. I know, right? Michael says, a higher sensitivity will show fewer blocks, which I assume would be larger. Oh, interesting. But you know what? As of this moment, I'm gonna have both. I'll go color code them so they look the same, so it doesn't look weird. But I mean, we saw a 50 turned off, and then a 28 turned off, and comparing the two, and seeing how they both are useful. Both show slightly different data points, but also overlapping data points. So by all means, let's go. What are your trend spider settings? Showing more order blocks than mine with the 28 and 50 on the SPY 1 minute chart. Friend? There's a lot of order blocks right there. Here, I'll show you mine. So order blocks 50 here. Wrong button. Here. It's just a 50. I don't know. And then this order block here says 28. That was the default one we just put on. If I drop both of those off, it should be clean. Yeah, there you go. You want to say? So either way, we'll get it. Michael says, am I in the color bullish or bearish? Yeah, the colors are something you can change. I'm going to go change mine to be the same color. But yeah, it's just clicking in here and changing the order, the color there. I like the default colors. But either way, I hope this was useful, right? This is such a powerful and cool indicator. And I am so glad that I found it. I don't remember how I came across it. But boy, am I so glad that I did. And so couple new slide decks on the way out. I'm going to show you real quick. First, don't forget, we have the lowest pricing of the year on OVTLYR until September 30th. If you haven't already gotten the OVTLYR annual pass, it's only $2.99, which is 82 cents per day. Make sure you click the apply limited time coupon so you can get that special pricing. And then lastly, thank you so much for being an OVTLYR. We couldn't do this without you. And we want to pay you back every single day by helping you save time, make money, and start winning with less risk. I like being able to close the show with that. I think that's really good. And Wes says, I feel like knowing this much about order blocks is like having a cheat code. Welcome to OVTLYR, my friend. That's a cheat code. Y'all have a fantastic day. And I wanted to just take a moment to really work with you. Think of me as your coach. Think of me as your mentor, right? I'm literally here for you. This is as close as I can give you as to one as possible. And because of that, you are allowed to ask any questions you want, give any opinions you want. And even if I don't agree with them, I'm going to give you my opinion back. And you're definitely welcome to not agree with that either. But the point is that I'm going to give you the best that I can, but I want you to give me the best that you can, right? I want you to give me the best you can because I'm here for you. You don't have to be here. I don't have to be here. Both you and I are choosing to be here together. So let's be fully embraced into this. Tug says, got it. Now to Costco. Brent says, I started a new job. Congratulations on that new job, Brian. I'm glad it worked out. And he's going to dress up nice like Dave. Cam says, how do I show my avatar? You've got to go into your Google settings. I don't know how to do that. It's been 100 years, but my avatar on my personal channel is a little picture of me. And I set that up in Google. So that would be how you do that. So let's go to the Discord. Okay. Max had asked about a different trading strategy. And I just gave some notes that, look, I'm not familiar with this strategy, but I'll put it to you this way. Any trading strategy has the potential to work if the wins are bigger than the losses and an acceptable winning percentage. The problem comes down to individual implementation. Most people want to trade, don't comprehend how to take a loss. Now, if you see some errors, I was doing this on Siri, so it may not be perfect. Even with an 85% win rate, hang on, my camera just did something. So my camera is kind of cool. It has gesture tracking. And when I raised up my hand like that, it started to do something. So I had to turn that off. Even with an 85% win rate, I struggled for years because I was unable to take losses. Now, you may have heard that story where I had an 83% win rate. And at the end of the year, I was down and I didn't understand why I was down. If I'm winning so much, why do I have an issue with making money on balance, right? And the issue was that I was losing 10x what my winners were, right? So even with an 83, 85, 90% win rate, if you're losing 10x as much as each one of your winners, it's never going to work. It will never mathematically work. So basically, I don't want to give an opinion on any other trading strategy. I really don't. Other than it should have small losers, big winners, and an acceptable win rate. And that's where my strategy years ago broke down because it had big losers, tiny winners, and a high win rate, which doesn't mathematically work. And it has to be something that fits with the individual trader's personality and temperament, right? Some people, the way that they trade, they may have 20 to 30% winners, yet those 20 to 30% winners are huge, right? And I don't know how they do that, and I can't claim to teach you how, but that's what they have been able to figure out. But in the process, they understand that in order for those 20 to 30% of times for it to win, they got to cut losses like crazy, right? Anytime it moves against it, cut. Anytime it goes down a penny, cut. Whatever the case is. He was also mentioning that he joined during a time when I wasn't putting on a lot of trades. And I can understand how that's frustrating. Completely understand. OVTLYR does deliver new opportunities every single day. But I get that if you're looking for someone to be the lead for you, to be that mentor, like I was talking about a few minutes ago, it can absolutely be frustrating if there's no trades going on. Then I replied, I said, there's no setup worth taking unless it's perfect. Everything else is noise. Larry Height, who was one of my mentors, he's a market wizard and the very first $1 billion hedge fund manager, taught it to me this way. Do not take any trades unless they're set up. If you take a trade that's not set up, you have completely invalidated your model. If you don't take a trade that is completely set up, you are once again completely invalidating your model. Right? So the moral of the story is don't trade unless you have a reason to. And I just wanted to preface this and say, that's just the way I trade, but OVTLYR does deliver you new opportunities every day. And one of the great things about being in the stock market is that you don't have a boss sitting there telling you when to take trades or when not to take trades. And that unlimited freedom has been the downfall of many traders. After I typed that out, those are not my words. Those actually came from this incredible book right here called Trading in the Zone. And after I typed that out, I got to thinking, like, I feel like anybody in our Discord, anybody who's watching on the live streams, they need this in their lives. So I put this out there and I said, hey, everyone, I'm assigning some homework over the weekend. Go order this book on Amazon, Trading in the Zone by Mark Douglas. Buy it new, buy it used. I don't care what you pay for it. You could pay $6. You could pay $28. Whatever the cost is, it's worth it to you. It will be one of the best investments you make for the rest of your life. I don't know how well this is going to come through, but I have probably 60 tabs in this book here. And I'm just going to pull, literally randomly picking one. Page 47. If you have to win, if you have to be right, if you can't lose or can't be wrong, you will cause yourself to define and perceive categories of market information as painful. So if you have to win, if you have to be right, you're going to be looking at the market every moment of the day, and it's going to be painful. I mean, I just pulled that at random, right? Because I've been there. Have you been there? Alex says, SPY had an uptrend this morning on OVTLYR. It sure did. It sure did. I got that email. Did you get that email too, Alex? I saw that email, and so I clicked over here real quick, and it did go into the green. Oh, you can't see my screen. It did go into the green uptrend overlay. Yeah, I saw that exact thing. Goran says, Etsy is up 8% today. Wow. Are you saying that we sidestepped by following the rules? That we sidestepped an issue? Because it looks like to me we did. Randy says, I messed up rule number 2 by not taking some trades that I should have. Yeah, that's the thing, right? You've got to take the trades that set up, and you have to not take the trades that aren't set up. Anything else invalidates your model. So well said, Randy. Peter, good to see you. Some of the smartest traders on Wall Street just can't sit down and wait. Trend Followers book. Yes, the trend following book is absolutely one of my favorites. But I want to work on trading in the zone. So like I say, I dropped a link on the Discord. Go get a copy. You could listen to it on Audible. It's also a great one on Audible. And then I dropped 2 links to 2 videos. These videos I personally saved years ago, and I will go back and occasionally rewatch them because they are so great. So what I wanted to do today, because I'm not trading, because we don't have a confluence of signals here, is go through the shorter of the 2. One of them is an hour, the other one is 2 hours. I'm going to play this at 1.25% speed, or 1.25x. So this will take 40 minutes or so, give or take. I'm only going to jump in when it's necessary, but the truth is, I don't need to jump in. You don't need my opinions. Mark Douglas, the man who wrote this book, the man who's going to be interviewed here, he's the one whose opinion really matters. And as I like to say, I just stand on the shoulders of giants, right? These men have pioneered so much in our industry, and all you have to do is listen and pay attention. We are blessed beyond belief in 2024 to be able to have access to these things. Imagine what life was like in 1914 when Jesse Livermore was trying to trade. How difficult that would be. And here we are 100 years later. You've got OVTLYR. You've got somebody coaching you directly through the internet every single day. You can reach out on the Discord and ask questions anytime. we're going to change the world. I'll put it to you that way. So Dave says, just bought the book on Amazon, $14.99. It's free on Amazon audiobooks. There you go. Go get it today. Like I say, whatever it costs you will be the best, one of the best investments you've ever made in your entire life. So I'm going to let this play, and I'm only going to jump in when I really feel like it. But honestly, you don't need my opinions. You just need to hear Mark himself.
Psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, last time we were together was at WiseFest, and had a lot of fun. I'm really excited you're here with me today.
Thanks.
So let's get started. First of all, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as a profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit, this profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that, that they can rely on from their trading. And I'm sure that many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy.
Right.
I'm only going to interject when I feel like it's needed. I agree with that completely because so many people want to get into trading and say, I want to make $10,000 a month. Dude, there's no way that I could promise you that. I don't care what you want. There's no possible way I could guarantee you an income in the market. Now, there may be months where you make 100,000 in a single month, and then you go 11 months and you make nothing. Would that still work for you? Really? Would it? Most people, it wouldn't. Most people, that 11-month downtime is like, I got to do something. Why can't I make money? But the 1 month pays for all those 11 months. So that's why I say I can't guarantee you any time frame, but you just have to show up.
Because it's easy to find yourself in a winning trade, which many people do.
Right.
They think it's also easy to become a consistent winner.
Right.
And it took a long time before it actually dawned on me that winning and being a consistent winner are 2 completely different animals, 2 different things. And in some ways, there isn't even a relationship between the 2.
It almost seems like there's no relationship between the 2.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, it's so easy to find yourself in a winning trade because winning actually requires no skill at all. In other words, unless you consider that, the being able to click a mouse button or, tap a pad is a skill. Right. And we don't have to have a reason or a good reason or actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of what kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse for me to sit there and make $5,000 or $10,000, and it must be pretty darn easy for me to sit there and make a living out of this. And that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, we're gonna get into that, but at the most general level, I'm going to say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example.
Proper execution of those trades. Proper execution of that setup, right? And to Mark's point earlier, like any trade you put on, like I could ask my 12-year-old son to walk in and enter a trade at any time, and it could win. The skill of making a winner actually is very easy, right? It's as easy as clicking a button. But so is the same as having a loser, right? It's a random outcome in that case.
Well, take for an example, a high school basketball player who, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's not
see that all the
out of the
time.
realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method,
right,
and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now. Trying to stay focused. Yeah, trying to stay focused on the process of this presentation and not blowing it.
What are you doing, fantastic?
Anyway, with trading, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method or trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Exactly what we need to do, when we need to do it, without any hesitation or fear. So that goes back to 2 things, right? Like we talked about. There's the type 1, let's call them type 1 and type 2. Type 1 error is you take a trade because it's subpar. You take a trade because it kind of fits your plan. You take a trade because you're bored and you want to do something, right? So people told you, hey, being a trader means being active all the time. And then a type 2 error is not taking the trade when it is set up, right? Maybe you just had a losing streak. You lost 6 in a row, 8 in a row. And now on that next trade, are you still going to take it? Or are you going to second guess the entire world? Most people second guess everything at that point. They say, my strategy must be completely broken. I have to upend everything and start over from scratch. But that 6th or 8th trade, that next one, could be the one that pays for all of those and more if you had only followed your predefined strategy. So we'll continue on.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And
2 things that he just talked about, which is what we do for every single trade. And I really want you to pay attention and see the correlations of what we do on a daily basis to what he teaches, right? Because number 1, we predefine the risk in every trade. Every single trade that goes on, you see exactly where I'm marking, where I'm going to get out if things don't go right. I'm predefining my risk. I'm predefining my risk on the chart, and I'm predefining my risk in position size. Those are 2 ways that you limit yourself to having as small losses as possible. You have to do those.
that's happened to everybody, okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent
you need to have a reason to get in and a reason to get out.
us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about, we say the word methodology is the wise trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here, okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, a result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis.
Ooh, ooh, ooh. Okay. There is one word in the English language that drives me absolutely crazy when it comes to trading. I want you to try in the chat and guess what that is. It's one word, starts with S, that when I hear somebody say it, when it comes to trading, I can tell you two things. They have no idea what they're talking about, and they have never traded before. I'll give you just a second to type it in. When I hear this word, it's like nails on a chalkboard. 5, 4, 3, 2, 1. Should. The stock should do this. The stock should have done that. Right? My trades should give me this result. There is no possible way that you know what a stock should do. Let me give you a couple examples, right? Let's say that you're going out to your car and you push the button to start the car, depending on your type of car, right? It should start. If it doesn't start, there's a problem. But you can't relay that to a trade, because even if a trade is 100% set up in your criteria, it can still be a loser. So saying should is you are imparting what you believe will happen upon a stock when there's no basis in reality to determine if it should do this will actually happen. Tug said, sure thing. That was a good guess. Randy says, should. Sounds like CNBC, right? Oh, stock should go up after earnings, right? Or how about the good earnings reports, yet the stock price goes down? It shouldn't do that. Yeah, exactly.
And not understanding that technical methods aren't designed to do that. Right. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful.
Okay, and that's where people go wrong. There's no way to guarantee anything in the market, right? Even if it, in your opinion, should do this thing, it could do something completely different. It could outperform, and you could be so stoked, right? Would you at them go back and say, well, it should have only gone up $1, but it went up 5? How dare it? No. Every outcome is random, and that's why on the data that I keep, right, I like to keep a standard distribution curve, because I don't know where it's going to end up, but I do find that interesting, right? There's going to be plenty of winners, there's going to be plenty of losers, but you can't tell the trade where it's going to go.
And I understand what you're saying. I think, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player, if the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he'll undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
And I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique. Right. They have to be able to view that as random and unique. That's, I think, the big issue.
No, I know. And that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade.
And that's how OVTLYR works, by the way, in case you were wondering. As we talked about earlier, the OVTLYR patterns, it looks for those fearful and greedy times, right? And then lets you know when those reach extremes. Mark just said those really do exist. Oh, that was kind of cool.
by trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with a pattern, and that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
And to that point, these patterns generate the buy and sell signals, but they don't generate, hey, you should you should expect an 8% return on this one trade, right? You can't say that there will be X outcome because we don't actually know what the outcome will be. That's why I like to give the example that, you know, if a stock goes up $5 instead of $1, are you actually mad at it for doing more than you wanted? No, of course not. But would you also be mad if it went down $1? You probably would, but why? Right? There's no way you can control that except for position sizing and risk on the chart. But it's going to move in one way or another, and it's just data. It is, in theory, as likely to go up $5 as it is to go down $5. Mark is here, smartest man in the room. Distribution curves. Now you're speaking my language.
So, you know, and if the last trade was a winner, this trade, even if the charts are the same, even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade is going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
And he's going to say this too. That's why every trade is unique, right? Every trade has the trade you put on right now has no bearing from any trade prior and no bearing on any trade in the future. This one trade is a unique circumstance, a unique event that cannot be replicated.
Yeah. This is interesting. I mean, I'm trying to, for us up here, you know, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, you know, let's again back up here for a second. There are traders out there using WiseTrade every single day. They're getting the same exact patterns. Okay. But what you're saying is, even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria, same formula, same everything.
Right. The chart pattern can look exactly the same. Everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, you know, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learn how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of, you know, the same kind of emotional trauma that the typical trader does, because they're expecting something that just may not happen. So for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, you know, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration, because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over?
Because you are trying to tell the trade what it should do. There's that key word again. But if you just allow it to happen, either way, if you just allow it to happen and have a plan to get out if it goes against you by whatever loss percentage that you want to assign to it, or let it work until you get an exit signal, then the anxiety goes away. Right? When you know what you're going to do, when you know why you get in and why you get out, the anxiety goes away. The stress goes away, and especially when you position size correctly. And I know some of you have watched me put on trades in a flippant manner, right? Meaning it's like, wow, he just risked, you know, tens of thousands of dollars on this one trade with that little of information. Yeah, because I know exactly where I'm going to get in, and I know exactly where I'm going to get out. I know why I'm going to get in, and I know why I'm going to get out. And I'm not basing anything in my self-worth on the outcome of that trade. And if it works, awesome, I'm here for it. If it doesn't, that's okay too, because I'm limiting my risk. Sebastian, we are still live. It is for real. This is live.
I mean, how does a trader take, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or how do they begin to remedy these issues?
Well, here we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this is because their initial exposure to the markets themselves is through electronics. Right. In other words, there's through electronics, there's a real disconnect between what you're actually participating in and what's causing, you to want to participate in the first place. In other words, markets started as exchanges, right. And there were, and so when you traded at an exchange, so that all prices are people-generated events. Correct. They are, and see, this is what people have to take into consideration. Everything happens because of what people believe. When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low. Correct. Is there any other way, Jared? No other way. In every market. In every market. So basically, everyone's trying to do the same thing, are they not? Yes. Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay, right. So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points, meaning what you're doing is you're translating the human behavior, the human belief in, if I'm going to buy
something visual.
Was that? No, it doesn't have to be visual, but it's like, it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, or it's going to go to 12. Certainly, if I thought or I believed it was going to go to 9, I would wait, would I not? Correct. So the reason why I'm buying at 10 is because that's what I believe. In other words, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously, we as individual traders are not large enough in our accounts to move the market.
Exactly. And so this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't.
But maybe one day we will be. Maybe when I hear those things like that, like you can't move the market, you're not big enough. One day I'm going to be that unusual option that people see. I'm just putting that out there. One day that's going to be me. They're going to be like, oh, there's an unusual option buy on Etsy. Yeah, that was me.
Doesn't understand is that there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Okay. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite. And this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last.
So how does understanding this concept, how does understanding what moves the markets help our traders to take it to the next level? Is this the first step for them getting control and understanding how the market's working?
Yeah, they definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or wise trade or whatever, you're using mathematical formulas. Okay, you're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point as a price over time, okay, or with volume. There's any number, there's any number. That's what it ends up being, is a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this: is that when this set of criteria, okay, is present in the market, that there is simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
You can't, mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it.
Right.
In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market,
using all of my money,
using all your money to, if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now the price is at 13. All the trades that you put on at 10 are winners, right?
Yeah, I still bought it at 11 and 12.
Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else
exactly
to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event.
Just have to put a disclaimer out there. Don't use the Wise Trade software. Use OVTLYR. It's way more better.
The edge you said in our favor.
Jared, when you put on a trade, okay, when you put on a trade, do you know who, now what we've done, we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, the firm that clears the
bottom line is
bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence, the heads to tails?
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically, it's going to come up heads 70% of the times. I still don't know which flips are going to heads. Which flips are going to come up heads. They say which flips. It's not the times. Right. Which ones? In other words, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails. The next one's tails. The next one's tails. In other words, we could have streaks of heads or tails. Okay, we could have streaks in there. The point that I'm making is that there's no way to know the actual sequence.
But at the end of the day, we know we have
And that goes to the point that I was making earlier, where it's like, I can't guarantee you $10,000 a month. There's no one who can guarantee you $10,000 a month. But over the course of a year, you might average out $10,000 a month, and it might be $100,000 in a single month, and then a little bit here and a little bit there. There's no way to be able to determine, and Mark wants to call it reliable. I don't necessarily want to call it reliable. There's no way to say when you will get the outcome. And that's his point, right? Let me catch some in the chat. Cam says he also wants to move the market. Brian says MGM doesn't say you should win the bet or at the casino. Exactly. You shouldn't be emotional about your trades. And that's hard. We know that's hard. I know that's hard. I wouldn't ever say to somebody, you shouldn't be emotional, and just expect them to be like, okay, unless they've done like years worth of trading, right? I think I stopped being emotional about my trading when I had lost 2/3 of my account, right? I guess that would be like the first time I blew up. Yeah. After that, it doesn't hurt anymore, right? The stats are that 90% of traders lose 90% of their account in the first 90 days of trading. And so it's not unusual if you have blown up your account, right? I've done it twice. And that's why I say, I think it stopped hurting once I got used to being okay with taking losers, because that's part of the game. Sucks, but it's also part of the game. But then you get those times when you're on a winning streak and you're standing in the shower, you're lathering up your hair or what's left of it, and you're like, genius, such a genius. We've all been there too, right? But in the end, we couldn't control either of those outcomes. But we have very different reactions to both of those outcomes.
70%. So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way. That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? And it skews our expectations. See,
that's a really, really, really good one. And that's something that people who aren't familiar with the market, they'll never understand. They'll never understand. Why would I put that trade on if I don't know if I'm going to win or not? Right? I couldn't convince my wife to trade. There's no possible way I could, because she wants that security. Why would I ever put on a trade if I think that I'm going to lose? That's a hard choice, isn't it? Why would you ever put on a trade if you think you're going to lose? Because you're potentially just as likely to win. And if you structure a trading strategy soundly, your wins should be so much bigger than those losses. But we can't control the outcome.
It messes our expectations.
Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, this makes a whole lot of sense to me, and I hope it's getting through to you guys. We have a tool that gives us an edge. Whatever it is. Even if that edge is 2% or 3%, I don't know if we can...
No, it's more than that.
Maybe more than that.
What do you mean more than that? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. I was using edge as defined as... So maybe 55 or 56% of the time. Right. Let's just say...
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize too. That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis, 95% of his trades were losers. 95%. But the 5%.
Richard Dennis, who I just talked about earlier this week, the man who had the turtle traders experiment. I didn't know his win rate was only 5%. He said something just a minute ago that I thought was really good. Let me see if I can remember as he keeps going.
Percent that were winners were monsters, and he was able to put on trades at a 95% loss ratio and make at the most at one point, and I think around 1987 or 1988, he had $400 million.
Is that using his edge or his money management or a combination of both?
Of all of it.
Okay.
And see, one of the things he did too, and this is something I ought to really qualify it with, he would use orders to actually probe the market. See, there's one of the things I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment, and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, that there's a higher probability of one thing happening over another,
which is very easy to do when you have outlier, right? Like the master key, SPY signal, market breadth, market trend, sector breadth, and then running your screeners, right? It's very easy to find an edge. And in fact, it's super easy to see the edge. Let me pop this down in outlier because it shows you what the edge is, right? You go in here, you click the performance summary once it loads in, and it'll show you what your edge is, right? Outlier has given us 73% return over time. That is an edge, okay? And there are ones in outlier that don't have an edge. Those I avoid. But when you see an edge, that is not the end all be all. That's not saying, hey, every time you put a trade on, by golly, you're going to make 73.24%. No. Because as you can see here on the chart, there are winning times and losing times. But on balance, overall, over a data size, a data sample set, you should have enough winners to outpay for the losers. Let me catch up on the chat here. Cam says, it's like real estate investing. I never fall in love with a deal until I know it's done and I know what the end result is. Absolutely. TrendSpider's having a 50% off sale this weekend. Go get it. Michael says, I think they mentioned that in the turtle. They sure did. That Dennis's win rate was dismal, but his profit on the winning trades blew his losses out of the water. I'm glad you read that one, Michael. But he didn't lose like most traders. He dumped his losers instead of hoping and praying. instead of holding and hoping, right? Let me go back over here.
Once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations, aligned with the way the market actually exists.
Right.
And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows he has learned there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay, but what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits. Right. But the typical trader.
Does that sound familiar? Know when you're going to get in. Know when you're going to get out and why.
What does a typical trader do?
They don't have a plan. Or they think about the trade too much. They think about, is this going to be a winner? Is this going to be a loser
right.
for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine the risk, do they?
Right.
And they also don't have a plan to take profits because they think
it's going to be winning.
It's going to go on.
And I want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win, how much he's willing to lose or risk.
Right.
Exactly. Does he put a cap on the upside? Does he put a cap on his win side?
It's not a matter of a cap. It's a matter of how his assessment of how much potential there is. Okay. In other words, see, the problem is on a winning trade, we're
before he gets too deep into this, I want to share with my rule, right? Selling into strength when it hits these certain targets, a 10-point spread on the heat map or a 5-point spread on the heat map, because, and I don't know what he's going to say, when it gets deep in the heat map, when it gets deep green or deep red, let's see if I can find one that's deep red or deep green. Oh, here we go. No, I want to go back to COVID. That's the best. Yeah. When it gets deep red like that, I don't want to mince words. What do you
obligated? His assessment of how much.
Does he put a cap on the upside? Does he put a cap on his win side?
It's not a matter of a cap. It's a matter of his assessment of how much potential there is.
How much potential there is, right? Because when it hits these extremes on the heat map, and we can see these, and this is why I use this as one of my exit signals here. When it hits these extremes, the potential for a bigger move is no longer there. We're already hitting an extreme greedy point. We're already hitting an extreme fearful point. So there may not be all that much more to go. Which is why I have these type of rules over here. Tug says clarity. Randy says, I have to work on selling into strength. A trade is not going to go up forever. Exactly. Let's go back to Mark.
In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk-to-reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions. Right.
Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break, guys. It's already time, as I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on WTV.
Let me ask you this real quick. Do you want to continue going, or do you want to listen to this in your own time? Let me type a number 1 in the chat if you want to keep going, or number 2 if you want to just listen to this later on. It's up to you. Majority vote will win. Number 2 is or number 1 is we stay on. Number 2 is we bail after we get past this break thing here.
On putting your mind over the market. All
right, Cam is going to bail, but Dave, Tug, Michael's number 3. That's not even an option. Randy says 1. The ones have spoken. Thanks, Wes. Thanks, everybody, for voting. Let's keep going.
Jared Levy, Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin, and you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads.
Right.
Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern.
Right.
You also talked about how
it's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how.
I think I can quote him exactly about what he's about to say. There's 4 types of trades. There's a winning trade, a losing trade, a right trade, and a wrong trade. A winning trade does not necessarily have to be a right trade, and a losing trade does not necessarily have to be a wrong trade. Or good trade and bad trade. Yeah, I shouldn't say right or wrong. I should say good trade or bad trade. A winning trade does not necessarily have to be a good trade, and a losing trade does not necessarily have to be a bad trade. You can have a bad trade that's a winner, or a good trade that's a loser. It's irrespective of the outcome, right? If you followed your plan, that's what makes it a good trade. If you didn't follow your plan, that's what makes it a bad trade. And the very worst, he may say this exact thing, the very worst outcome that you could ever have is a bad trade where you didn't follow your plan and a winning trade, a bad winning trade. That is the worst. You don't want that because that messes with your mind. Because then you're like, oh, if I continue to do these bad things, bad meaning not following the plan, if I continue to do these bad things, then I should continue to get wins. Oh, this is great. I'm actually curious to see what he says because I don't know if I quoted him exactly, but it's going to be really close to this. It could totally be totally different, but I just think that's where he's going to say.
How does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, with the possibility of being dissatisfied or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information.
Right.
So for an example, if I'm in a losing trade and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case.
Right.
It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting.
Okay, I was wrong. He's talking about something else. But I know exactly what he's talking about, and I know you know exactly what he's talking about. How many times have you been in a losing trade and maybe you're trading on a daily time frame and you're like, oh man, let me just go to the 5-minute candles or the 1-minute candles. Then every candle that pops in your direction, right? Every up candle, every green candle, you're like, oh, here we go. Let's go. Let's do this thing, right? And you're focusing on every little thing. And then you stopped seeing the obvious trend that's working against you, right? Imagine you've got a chart and it's all red candles and then you get a 1 green candle and you're like, let's freaking go, right? You no longer are paying attention to the trend. You're focusing on the details that do not matter because like you have blinded yourself to the reality of the situation.
An inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right. I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks I've traded, but just for some particular reason, I feel great about this stock. Mm-hmm. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to? Or?
That was the second time I blew up my account. The gold trade, I don't know what year it was. I wish I could tell you, but I was following this person on Twitter, and he literally had a monkey avatar. But I had seen him make great calls, so I was listening. And Bama Broker, if you ever go back in the Wayback Machine and look up Bama Broker on Twitter, that was who it was. I remember he I remember specifically being on a little getaway with my wife to Fredericksburg, Texas, and walking down the main street there and looking at Bama Broker saying, oh, you know, the Dow's going to do whatever today. And the Dow did that day. And I was like, oh my gosh, this guy is a prophet. I have to listen to everything he says. Well, then gold was in a downtrend, a very obvious, very clear downtrend. And Bama Broker came out and he's like, listen, now is your chance to buy as much gold as you possibly can. So I did. I put all of my account into GDX, GDXJ, GLD, Dust, whatever you could buy options on. I'm like, give me all the options. If you got options for sale, I'm buying them. Or calls for sale, I should say. Let's make that disclaimer. And every day, the market's going down and down and down and down and down. And I'm watching this and I'm like, maybe today's the day it's going to go back up, right? And we'll get one green candle. And I'm like, oh, finally, let's go. Yeah, this is how it's supposed to be. And then another 16 red days after that. And I remember going to Disney World and looking at my, looking out the window of the hotel. And I don't know where it was in the Disney World area, but there's this like hot air balloon thing that goes up and down. And I remember looking out the window, beautiful hotel room we were in, right? And thinking to myself, what did I do that for? Because I still had the trade open. I would check into my account, you know, through the day as we're going and just watching my account evaporate before my eyes. What was I doing that for? Why did I do this? Because I wasn't willing to see the data that was right in front of me. I was not able, I couldn't mentally look at the chart and say, well, that's a downtrend. Maybe I shouldn't be buying calls. Because I was so blinded by having so much invested in that trade working out that I was completely blinded to see what was actually going on. Maybe you've been there too. I don't remember if I said this. If it was easy, everybody would be making money, right? We've all made big money on a mistake. Chris, I love your half ATR rule. That one rule can save me tons of money. Yeah, no doubt, dude. That's what it's for. Randy's laughing at my full portfolio. Give me a break, dude. I didn't know what I was doing. I was just trying to make some money.
Well, yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto. Okay. The thing that they have to understand is regardless of the reason that they got into a trade, it doesn't, regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Right. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13 and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good. Right. And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. That you know, my reason might be great.
Professional traders don't think about it any other way. We have to predefine the risk before entering into a trade by position sizing and market on the chart where you know you're no longer going to be in there. Those are two ways that you predefine your risk.
Great. But if someone else isn't buying into it, what difference does it make? It doesn't matter because it's not a winning trade. And so, you know, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you
by changing, yes, by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay. Now,
I don't like it.
You might, okay.
But I played it.
Whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it because it might make the example even better, okay? Okay, you play a slot machine. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do people betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's a
random outcome.
Ooh, this is really good. I forgot about this example. I'm going to back it up a smidge. I really want you to focus in on this. Really, really, really want you to focus in on this.
How do you feel?
No.
Button. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do people betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's a
random outcome. Okay.
He doesn't feel betrayed because he has the expectation of losing. Trading psychology in a nutshell. He doesn't feel betrayed because he understands that whenever he rolls that slot machine, there will be winners. And he understands when he rolls that slot machine, there will be losers. So when he has the losing trade, when he has the losing roll of the machine, not upset. It's part of the game. I think that's such a great example. Such a great example. Randy's laughing at me and Brian. Peter says, so how can you have a predefined exit point and let your winners run? Predefined exit point you do on the chart ahead of time. So let's just, for fun, do this, right? Let's say I want to get in to SPY. Look at that. It closed right under that order block. So it might or might not go away. I'm really not sure how close that was. Let's say I was getting in SPY right here. Right. I'm gonna predefine my risk by putting in a half ATR exit, which I'm just gonna round it. Let's just say it's right here at the bottom of this candle. Okay. And then I'm gonna let my winners run because I'm gonna let that go as far as it can. I'm not gonna handicap it. I'm not gonna say, okay, when it gets here, I'm out. Or when it gets here, I'm out. Or when it gets here, I'm out. I don't care. I don't care where it goes anywhere up here. I care a hell of a lot where it goes down here. And you should too, right? If it's going down here, I care a lot. I care more than anything if it goes down here. But if it's up here, hey, anywhere up there is great. But then the other exit signals I have is not allowing, as Mark would say, it to go to where there's no more, or the opportunity becomes less and less. And we can measure that. This is a huge benefit in Outlier. We can measure this, right? Here, heat map shows, I'll make it bigger. Heat map shows like 36, 37, 36, 37, 34, right? Anywhere on here, that's really deep in the heat map. So I would only give it a 5-point spread because there are so many people who are so greedy at this point. There's only so much time before it reverses, and it did. Right? So it's not that you're limiting it on the chart. It's not that you're limiting it in price. It's that you're taking the perspective of, I have this data, which nobody else in the world has unless they have Outlier, which is really cool. And then you're looking at it and you're saying, people are getting really greedy here. They may have reached a point where all the people who are greedy have already gotten in. There's nobody else left to get in. And then the only people who are left are those that are fearful. And they take their money out and goodbye. Michael says, have a trailing stop. That's a great example. I will tell you, though, I gave up trailing stops. I gave up trailing stops on the whole because I don't know how many times I got into a trade. Let's say I got in right here and it went up and it went up and it went up. And then by the time I got my trailing exit, I made next to zero or was even losing on the trade. So I do have some trailing exit criteria, like a 10 EMA being broken, but I would much rather sell into strength. If I can sell into strength, that means I'm getting out where it's really, really strong, right? I'm getting out while people are still trying to get in rather than getting out while everybody else is also trying to get out, right? It's the difference in walking out the door before the movie's over and walking out the door when the movie's over and everybody else is trying to cram through that door, right? You've got 200 people in the theater. Everybody's trying to cram out the door. And so you're just having to get in line until you can get out versus, oh, I got out 3 minutes ago without any issues. So I don't like to do that. I really like to sell into strength when I have the opportunity to. But of course, I can't tell it when it's going to. Right? I can't tell the market when it's going to sell into strength. All I can do is react.
So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome. Right. And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly. Okay, because the odds aren't exactly in your favor. And what trading systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not. I mean, this is the whole role reverses if you learn to think about it correctly. In other words, if you understand that, so for an example, well, let me backtrack a little bit and say that most traders, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put it in the machine, or otherwise we can't play. Right. So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in.
That is our loss.
By putting your money in, be it a quarter, a dollar, whatever, you've already limited your losses, right? You can't pull a slot machine unless you've put in money to start with. And you can't pull a slot machine and lose your house, right? Unless you decide to put your house in the slot machine. I don't play those high roller stakes, no way. But similar thing in a trade, right? If you can't handle the risk, you shouldn't be taking the trade, which is one reason we size based on risk. Wow, look at that. How everything just ties together. This is so great to have today. Wes says, I love your idea of rolling up strikes and reducing delta risk. Wasn't my idea, my friend. I actually got it from, I always like to quote who I got people from, because as I said earlier today, I just stand on the shoulders of giants, right? All these people who have taught me everything, I just do my very best to relay the information to you. I got that from Michael Coe, who, there was a show on NBC called Options Action, and I had the opportunity to work with him just a little bit. And that was one of the questions I asked. It's like, hey, when things are going my way, I want to take profits. What do I do? And he's like, just roll the option up. It's like, what do you mean roll the option up? He's like, just move from strike A to strike B, closer to the money. And then you can have profits now, and you can keep the trade on. I was like, wow, that is cool. But yeah, that's why I do that.
The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay? And then what we do is we wait for a pattern to show up. And if the pattern's a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market. First. The pattern shows up first. Okay? Then what we have to do is put up our money. Meaning, how much am I willing to risk to find out if it's going to work? But most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right, they actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market, like some of those errors that I said in the beginning. Right. How many people put stops in the market and take them out, and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it, but they haven't really accepted the risk.
They see it every day.
Yeah, they haven't really truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is. In other words, you get an edge that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence to wins and losses. You got to be able to identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right. Which is another problem I want to say.
Oh, yeah. But see, the thing is like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong. And so what potential do I have to get disappointed? No more potential than what you had.
It's not right or wrong. Key on that. He said it's not right. It's not wrong. It's just price movement up or down. You are not wrong. You as a person are not wrong. I can't tell you, I think it was years that I tied my self-worth up with how much money I made in the market or how much money I lost in the market. If I was making money, I felt like $1 million or multiple million. If I was losing money, I felt like the lowest of lows, right? Couldn't even stand up straight. You are not right. You are not wrong. Unless you completely botch your trading plan. The outcome has no determination on that. It's just price movement up or down. The way you go wrong is not handling it in the way that you've predefined your risk.
Had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
You see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think.
And how does a trader do? I mean, what are the steps? I mean, Pal, is there obviously by reading your books, by getting themselves immersed in your thinking is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise?
Yeah, yeah, absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just it's just like anything else in our lives. When we realize that there's a particular goal that we have, and and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone or how to think like a professional trader or some other methodology that people are more comfortable with or whatever. The point is that if someone really really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there. But the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay. And that's why there's so many people who are so close to getting it, but never really get beyond that threshold.
Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
By changing the way that they think. They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate the potential is by understanding that trading is not about being right or wrong. It's a probability game. Right. If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do
an hour and a half, by the way. Keep going.
Oh, yeah. Well, yeah. I got that long, honest to God.
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development that we start out learning these fundamental skills, like learning how to think in probabilities so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's right. And that's all it is. When you put on a trade and it doesn't work, all it really means is this, is that some of the traders didn't come into the market that had the same belief that you had or the same conviction that you had about this market doing whatever it is you thought it was going to do. That's all it is. It's nothing more than that.
And you have to learn to walk away.
And you have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? In someone else's behavior. People aren't that good at predicting other people's behavior. Or even their own behavior for that matter. Okay. Exactly. They find themselves doing things that what am I doing this for? And so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade by trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology at the very most fundamental level, what this is telling me, right, is that fresh cross. There's a higher there's a high, or let's say the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means. Right. The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Now they're either going to come or they're not. And so as a result, I don't look at this as being a right or wrong. I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out, not worth the cost of finding out. That's all it means.
You talk about stop losses. You talk about stop losses and management in your DV.
Yeah, absolutely, but not like very specific. Not the kind of specifics that like if you're in a half an hour time frame. How much?
Well, that's the trader's decision.
Yeah,
but the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to the risk tolerance, etc. Right. What you do, I think, is give people an understanding and a basis of where they should be placing their risk, or how much, not from a dollar perspective, but maybe from a
in other words, so that they can, yes, from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take $100 loss, see how you feel. If you're able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm willing to trade a more volatile stock and move to something like a $200 or $300 loss, etc. Is that an exercise you think would be beneficial?
Oh, absolutely. Yeah, absolutely. I mean, and that's what I suggest to people, all the time, especially, I was doing coaching. It's like, and when I was doing coaching on an active basis, I mean, I was coaching some pretty substantial money managers, and, they'd get into a situation where they're on a pretty good losing streak. And often it required that they actually go back to a risk level that, they hadn't. Meaning that if they were trading, 10,000 or 100,000 shares, or willing to take, $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares. Yeah. And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that, I mean, look at it this way. Paper trading. Okay, paper. A lot of people who teach trading say that there's no point in someone paper trading because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when their real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology of paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to get familiarize yourself with your trading platform. It's a good way to really get confident with your methodology, but more so, it is a graphic representation of the mental skills that you don't have. That's
an interesting concept.
Yeah. So in other words, how does someone convince themselves that they need those mental skills? Look at your paper trading in relationship to your real trading. Yeah. Now, if there's and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss, right? Because the way our minds think. In other words, if I have to take a loss on this trade, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets or what, people and that sort of thing, or jobs. And so because our minds have this tendency to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader. Right. But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point of that is that, when you can trade those 10 shares flawlessly based on whatever your methodology says, and do it without any fear or,
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as kind of almost your goal, if you will, almost like this is where I could be if I was trading from a carefree state of mind.
Absolutely, it's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. And that's the way that we can, and that's and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before both at WiseFest and earlier we talked about some events of pain in your life, and a lot of our traders right now feeling some pain with what's been happening in the markets the past couple of weeks. Mark, is there does a person have to experience this, a total drawdown in their account, a total loss in their account where their account's almost wiped out or is totally wiped out, for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change something? And I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change? Or can someone just in a normal course of every day with a little bit of dedication actually? And I'm not trying to be rhetorical. I really want a serious answer, because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a change?
You aren't in pain right now, are you, Jared?
Yeah, I'm good. I've been out of the market all week.
Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring to?
Explain the gutter principle.
The gutter principle. In other words, how much in the gutter do you have to be before you're willing to say, I'll do anything? As a matter of fact, this kind of brings something up. Is that when I was actively coaching, my coaching clientele basically fell into two broad categories. One was with traders who were already successful, who were already consistent, and what they wanted were, they wanted fine tuning. Okay, they wanted creative ways of fine tuning themselves so that they could actually increase the amount of money that they make over a year, whatever. And then you had the other group was they're literally in the emotional gutter. Okay, they're so exasperated. They're so frustrated because of the potential it's so obvious what the potential is. And yet there seems to be these invisible barriers that keep them from getting into that potential, that they come to me saying, I'll do anything. And that's, now everyone has different tolerances of pain before they get to the point where they say, I'll do anything, and mean it, and be sincere, and mean it. That's the whole thing. They got to mean it.
Mark, we're wrapping up the show. We have a couple more minutes now. There was a couple points I know you wanted to make before we end up the show. And guys, just so you know, next show we're going to open up to phone calls and emails. So if you want to start lining up your emails or your phone calls, do that now. Mark, a couple more minutes to go. In this arena, I mean, is there any message you can give to our traders, or any final thoughts, maybe a mantra, something?
No, just basically just to kind of sum up what we've been talking about, that if consistent results are your objective, then you're going to have to learn how to think like a professional trader, because that's what they do. They make consistent results. That's why they're pros. That's why people give them their money to manage. That's why they have jobs where they actually trade for a living, because if they didn't make consistent results, they wouldn't keep their jobs. And so to do that, you have to learn to change the way you think about trading in a way where it doesn't cause you to have this potential to think that you're going to be disappointed or betrayed or put you into a state of emotional pain. It's like getting to that carefree state of mind. And once you get to that, once you shift your perspective, everything changes. It's not about being right or wrong. And when you really understand that, and then you go through the process of learning how to accept the risk of losing, then everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You don't think about it. There's nothing to think about. It's like, don't think. There's nothing to think about.
And you trade within your means.
Except the risk and how you're going to take profit. But I'm saying the pattern.
To that point, when the pattern presents itself, you trade it, right? When everything lines up, you trade it risk-free, fear-free, because you know what the outcome will be, at least on the risk side. You don't know how much you could make. You have no idea how much you could make. It could turn out to be amazing, but you do know how much you're willing to risk, just like running the slot machine.
Pattern itself, when the pattern presents itself, there's absolutely nothing to think about.
That is the objective
there's no way
part about trading.
you can know. Yes, there's no way you can know what the outcome is going to be.
Mark, we do have another hour, like I said,
Okay.
so we've got plenty more time.
All right, let's wrap it here. That was really cool. And I'm really proud of everybody who stuck around and watched the whole thing. And of course, those who are watching this on the replay, I'm proud of you for watching it too. I hope that this was useful. Let me know in the chat. Was this useful to you? Was this worth our time today? Right? We've been going for nearly an hour and a half at this point. I apologize for taking over so much of your day, but at the same time, this is really good stuff. He's the godfather of trading psychology. Every other trading psychology book wishes they could be as good as Trading in the Zone, which you're going to buy before the weekend's out, and you're going to read it over the next couple of weeks. It's not a difficult read, and it's only not that long, is it? Right around 200 pages. So you could get it done really quickly. Dave says, very much so. I appreciate it. You're welcome. You're welcome. Before we go real quick, let's just wrap this up. Thank you so much for being an outlier, right? We couldn't do this without you. And we want to pay you back every single day by helping you save time, make money, start winning with less risk. And of course, be sure to go get Outlier's lowest pricing of the year, which will be up until September 30th. After that point, prices will be going up. The annual pass is only $299, which is literally 82 cents a day. So I don't want you to miss out, because we'll be raising prices on that soon. Peter says, very useful. It was great. Thank you. You're welcome. Excellent room today. PhD level. The mind game of trading. Absolutely. Thank you all so much for coming today. Have an incredible weekend. I'll see you right back here on Monday. We'll talk soon. We can focus on narrowing down which target is the best to take the shot on. Well said, Dave. I love this. From there, the evaluation of the options using the methodology for which options have liquidity and are priced appropriately. All of this is truly technical and unemotional. Yes, without a doubt. Like, as you have seen many, many times in all the trades that I place, I have said so many times, if it sets up and you don't take the trade, you have invalidated your trading model. And as you've seen, if it doesn't set up, I don't even look any further, right? If I see one step in the chain, if one link in the chain is broken, I'm not even interested. I immediately disregard the trade. If the recommendations filter all the way down through, you release the shot. You have set yourself up for success, no different than Michael Jordan throwing a three-point shot. Perfect execution, positive results will follow. This is a very different style of trading, but this is a far more elite level than most people realize. Thank you. Following all the rules is always hard, but it speaks to the success of the program. Very, very cool. And then Dave also recommends Zen and the Art of Archery, if you haven't already picked that up. So Dave, thank you so much for sharing all that and allowing me to share this with the Outliers. So with that out of the way, let's continue on. Be sure you share your stories in the Discord just like Dave did, because the first rule of Outlier is you tell everybody about Outlier, and hit the like button down below, right? I know you're already subscribed, so go ahead and do me a favor. We want to tell everybody out on YouTube how good this is, how great Outlier is, so you can do that by just tapping that like button. Doesn't cost you a penny. So the golden ticket trading strategy always starts with the market, and it's going to let the market tell us which direction it's going, with a 10 over the 20, price over the 50 on the SPY. So let's go to the SPY real quick. Let me zoomy. Here we go. And that's what we have here. We have the 10 over the 20, prices over the 50. Now, this blue line up here, I marked as a new all-time high. We're not quite there yet. If it closes above this order block, that order block disappears. And typically, you would consider that support in the future. So we'll see how that pulls out. But as of right now, we do have the 10 over the 20, price over the 50. I went ahead and marked that red line on the 50 as well. Because not all that long ago, we were considering going short, but we didn't. And in the process, we didn't lose any money, right? Because we followed the rules. Let's catch up on the chat here. Michael, finger red number 1. Sometimes the emojis don't pull through, but that's all right. I get it. Dave says, happy to share. Very cool. So the market is absolutely trending bullishly. And then we go the next step here, which is to look at the market breadth. Now, the market breadth is how many stocks are on the bull list. Go back over here. How many stocks are on the bull list as a percent of total? And that list today shows, as it loads, 38 new on the list today, 831 total. Now, what that looks like is this. Let me go to today. That's not today. This is today. It looks like we may have hit that bottom. We may have legitimately hit the breadth bottom. And now it is starting to turn back up. This may cross back over as soon as tomorrow. It may. I'm not going to pressure it. I'm not going to force it. I'm just saying it may turn back up tomorrow. And we might have bullish breadth. But as of right now, when we look at the master key, which unlocks the rest of the trading strategy, the SPY signal is actually set to sell. The SPY signal is actually set to sell. I forgot that part. Now, one thing to keep in mind, a sell with a uptrend overlay is not a sell to go short. It is a sell to close. Okay. I lost a lot of money figuring this out middle of last year. But a sell within a red downtrend overlay, you can consider that a strong sell, as in a sell to open. Okay. Sell to go short. In this case, that would have been a sell to close. So it might reverse course. I don't actually know. And I'm not going to force it either, right? Because with the golden ticket trading strategy, as I mentioned before, we follow the rules. So SPY signal is currently bearish. The market trend is currently bearish. Market trend is currently bullish. Market breadth has turned and might be heading bullish in the near future. And then if we did find a stock to trade, we'd look at that sector breadth. So we won't be trading today, but I did want to work today on how important charts are in using the 10, 50, and 20-day moving averages. So that's where we're going to spend the bulk of today's trading room on. And I'm going to go ahead and clean this up a little bit because I only want to focus on those. So I'm going to take off everything that's not that drawings. There we go. Okay. So I have traded every moving average you can think of. And these are the 3 that I landed on. And I'll tell you where I learned that from. So Steve Burns, one of my mentors, wrote this incredible book. Let me grab it real quick. Like I said, I live in a library. I spend 90% of my time in a library, and all my trading books are right in this area. New Trader, Rich Trader. Here we go. This book is a fantastic book. If you don't have it already, go get it. It's not expensive at all. In fact, this one's probably better on Audible than the Complete Turtle Trader. This is one you want to get, New Trader, Rich Trader. Yes, you can consider me a book salesman. It costs me nothing. It might cost you $8. Who cares? This book has so much good information on it. I don't know why I don't have tabs in it, but I have lots of markings in it. And I wish I could point you to the page where it's on. But in this book, Steve, so we're all familiar with the Rich Dad Poor Dad, right? This is like a play on that, New Trader, Rich Trader. So Rich Trader is this gentleman that lives in a big, beautiful house. And New Trader is a young gentleman who, comes into his life, and he talks about how, whenever he trades and his style of trading, very similar to how we trade, by the way. And New Trader is, so excited. New Trader wants to spend all of his cash on a single trade. New Trader wants to do everything he can. He wants to jump in and just go for it on every single day. Man, I tell you what, I kind of want to put this in my, I know I have this on Audible. I might just put it in this afternoon and start listening to it again. Because there's so much you can take from a book like this. It's not just a read it once and move on. It's a read it once, enjoy it. And then as you've progressed in your trading journey from new trader to rich trader, like I've done, you will catch so much at different points in your life by rereading the same book, which is why you have a library in the first place. So you can go back and visit those books different times in your life and see, oh yeah, that's that I've learned through one thing or another how I got from A to Z. Anyway, in this book, talked about the 10-50-20, which is my like number one trend rule. And that's what I want to discuss with you today. Why the 10-50-20? So the 10 period here, I'm gonna share with you a cheat sheet that Steve gave me. And I want you to take a screenshot of this so you can keep it forever. So let's break this down. The 5-day moving average is a super strong momentum, and you could use it as support or resistance if it holds or breaks. Now, let's look at a 5-period moving average. Because a 5-period moving average is tight. It's really, really right on top of the market, okay? So if we look at a 5-period moving average, that's the gray line right here. As you can see, I mean, that is like super tight, but it also gives you a lot of good information here, right? So let's look at the SPY in May. It crossed over the 5, and at no point in time did it even touch the 5 until here. So if I add this on, all my other drawings come back in too. Let me remove this one. Actually, I can just use this one here. Didn't even touch the 5 period from this point to this point. So the SPY went up nearly 20 bucks, almost 4% in the span of 13 days. Now, here's the thing, is that even though it didn't touch that period, right? If you're following this, trends like this are very unusual, right? It is very common, like this right here, just a couple weeks later, to see a lot of activity around the 5 period, right? Because, I mean, consider it this way. If you are giving something the shortest leash possible, how often is that going to just like bump into you, right? You know, this is a really good example. You know, those retractable dog leashes, right? I don't have a dog at my house. My wife can't stand the smell of pets, so we don't have pets. But my parents have a pug, and this dude is fat. Oh my gosh, he's so fat. Like I don't know how his little tiny legs can support how just morbidly obese he is. Corpulent is the word to describe him, and his name is Spike. So they have one of those stretchy leashes, right? And anytime we go to our lake house and my parents go with us there, or Spike always comes with us, and you know, we have a good old time. So Spike has one of those stretchy collars, those stretchy leashes. So imagine you give him 5 feet, okay? If you give him 5 feet and you lock it down, Spike's gonna run and hit it and come back. He's gonna run and hit it and come back. He's gonna run and hit it and come back. And he's gonna turn you and he's gonna be like, bro, what the heck? Why are you only giving me 5 feet of room here? Okay, I wanna go. If you wanna come with me, you need to step up your speed, okay? So that's kind of the case here with the 5-period moving average, right? It's gonna go and come back and go and come back and go and come back and go and come back. And it's gonna be really frustrating. But at the same time, if it goes above, you've got a really strong trend. Now imagine Spike's on a run and you're on a run and you're both running together. And then Spike, you know, he's so big and fat, he can't run any further. So he's like, okay, I'm gonna take a break. And he just sits down, okay? That's almost exactly what happened right here. And then you've got times where you're running with Spike, but he's going faster, you're going faster, and you keep bumping into the end of the leash and things like that. And it's not as easy to run with, okay? So a 5-period moving average does show you an incredibly strong trend, but you're gonna bounce, without a doubt. It's going to be a lot more chaotic around that period, right? Because you're just not giving it any room to run. Now, let's say that you gave Spike a 10-foot leash, okay? In fact, let's clean this up a little bit more. Let's say you give Spike a 10-foot leash, just like you would maybe follow the 10-period moving average. So it crossed over the 10-period moving average here, didn't even come close to it, not even looking at it. And then we get to here, and you can see Spike had to sit down, the market had to sit down, and it pulled back. Now the 10 is your indicator of the short-term trend, right? Where this is strong momentum, super strong on the 5-day, the 10-day is a short-term trend. If you're moving above the 10-day, that means the short-term trend is up. If it's below the 10-day, it means the short-term trend is down. But then you can go for potentially days or weeks in a strong trend with nothing happening, right? You can go for, while this one here was flirting with the 5 period so much, it didn't even wasn't even messing with the 10 period for all that time. And then you can see the short-term trend here changed, reversed course, and went down. The short-term trend changed, reversed course, and went up and down and back up, right? It's not to say that this is a guaranteed end-all be-all, but it does tell you where the short-term trend is. I mean, I've told the story a million times, but I love it. I was upstairs in one of my extra bedrooms on the laptop doing a Skype call with Steve, and Steve said, "Okay, Chris, is this stock trending up or down?" And I'm like, "I don't know." He's like, "How do you not know?" I was like, "How do you know if it's trending?" And Steve was like, "How do you not know this?" And I'm like, "Steve, listen. The way that I used to trade was just sell calls, sell puts. It doesn't matter what it was. But at no point in time did I learn charting." And so he's like, "Chris, listen. The first thing you got to do is put a 10-period exponential moving average on your chart. You put a 10-period moving average on your chart, and if the stock is above, it's trending up, Chris. If the stock is below, it's trending down, Chris. It doesn't get much easier than that." And I'm like, "Oh, listen, I'm sorry. Thank you very much. I have learned a lesson today. Putting that one in the old long-term memory. Not going to go against that." And so that's the 10-period. That's your short-term moving average. So then let's talk about the 20-period moving average. So the 20-period, I always just, blue, black, and red. It can be any color you want. I would suggest, if you're following along with the trades we make, just use the same colors. That way you don't have to think about one or the other. Blue I use as 10, black I use as the 20, and 50 I use as red. And so these are all exponential moving averages. And I should talk about that real quick. A simple moving average is literally you're taking 10 periods of data, dividing by 10, that's your average price, okay? An exponential moving average takes into account where price is at today. So it gives further weight on the most recent of the days and less weight on the further of the days. So if there's 10 periods, the first 1, 2, 3 are going to have significantly more weighting in where the moving average is versus the last 9, 8, 7. And because of that, your moving average is a lot more dynamic. Your moving average moves a lot faster. So let's take a side trip real quick and do a 20-period simple moving average. And this will be yellow. Let me make it bigger. Thickness. We want it ultra thick. There we go. So you can see the 20-period simple moving average and the 20-period exponential moving average. They move a lot differently, don't they? Right? These are both measuring 20 periods. Keep that in mind. Both of these are measuring a 20-period moving average. But you can see how much longer it took for the reversal to take place here, right? So let's say price comes down. You can see the black line, the exponential, moving down faster than the simple. Price goes back up. The exponential is already moving up, while the simple is still flattening and changing and then finally going back up. You see why that makes a difference, right? I want to know, as a trader, what's happening today. Or I have a significantly higher recency bias by, I want to know what's going on right now in the market, what's going on right now in this trend, and not so much what's going on 20 days ago here, okay? So looking at this, you can see just how much faster the exponential reacts than the simple. And there are periods of time where they pretty much do the same thing, right? When it's in a beautiful trend like that. But here's another example, right? 20 period, it's moving down. Price is below it. It's moving down. Reverses course, flattens out, was above, and then once again turns down. And during this time, the simple moving average is just waddling itself down, smoothly working, and then boom, it pops back up. And the 20 period's like, oh, I guess I'll flatten out for a while and then come back up, right? You can see November 1st, 2023 was the date that this changed direction. This didn't change direction really until November 13th. So you had a 2-week head start on the change in direction on the exponential versus the simple. Okay, so that's the difference in exponential and simple. And just go exponential. You don't have to do any calculations. It's just one button on your chart. So the 20 period is your intermediate term. That's the way I like to think of it. Your 10 period being your short term, right? and your 20 period being your intermediate term. Your 20 period, you can think about it as like a month, right? If there's 4 weeks, in a month, each trading day, let's say, or each trading week is 5 days. That's 20 times 5 is essentially a month. So this is your last month of data, okay? And then if you want to look at a 10 period, the short term, that's your last 2 weeks of data. Does that make sense? Right? You're looking at a month of data here. And on the short term, you're looking at 2 weeks of data. And then the 20 period here, according to Steve, says a reversion to the mean after an extended trend. So for example, we find an extended trend right here, right? From November 2023 up till April 2024. How many times did it cross the 20? 1. In that entire movement, 1 time did it cross under the 20, or the reversion to the mean, as Steve described it, and then it continued on. So like I say, that I use as my intermediate term. And then the 50-day I use as my long term. So the 50-day exponential is, if you think of it this way, right? We've got 2 weeks. 2 weeks is the 10-day. 1 month is the 20-day. And then you've got basically 1 quarter, 2.5 months, give or take. You've got 1 quarter for the long-term trend. So you're looking at 2 weeks, you're looking at 1 month, and you're looking at 1 quarter. In a nutshell, I'm rounding here, of course. So this is your longer term trend. And you can see during this long trend here, it didn't even come close. It went over the 50 and went for ages, came back down, back up, down, back up, and then went another ages, and then back down, and then back up. And a lot of people trade on this line only, right? Because if they want to do as little as possible, bro, trading the 50-day is where it's at, right? If it closes above, go long. Wait, still wait. Wait, still waiting. Wait. Finally get out, right? It went from 397, touched it a couple times, but didn't cross under it, up to 442. So a $50 move on the spot without having to do anything, right? A lot of people like to trade like that, but there's a lot of volatility that comes with it, right? Because there's going to be choppy periods, right? Where it's above, below, above, below, above, below, where you're actually bleeding out, right? And these are frustrating times. But in a longer term trend model, that works great. Peter asks, so how does EMA work on an hourly chart? It's the same thing, right? We can go to an hourly chart, right? It's still looking at the last 50 hours of data, each candle being 1 hour. In fact, this does get a little wonky on the hourly charts because the last candle is a half-hour candle. So a lot of people, instead of trading the 1 hour charts, actually trade the 65-minute charts. And then a full day is a full candle for every hour, every 65-minute period. So Peter, if you ever wanted to shift from a 60-minute chart to a 65-minute chart, you would have consistent sizes for all the candles. Either way, neither here nor there. We're looking at the 65-minute chart. So it's taking the last the last 50 candles on the 65-minute chart and plotting it like that, giving more relevancy to the more recent periods than the older periods. Go to a 5-minute chart, right? Same thing there. So the way that these work together is you stack the 10, the 20, and the 50. When all three are stacked to higher, right? When all three are moving on top of each other, that is a bullish trend. And a strong bullish trend, you'll see a widening of those moving averages, okay? So here's a really good example, right? A strong trend, they can get wider and wider and wider. Look at the width right here. The width right here. And then look at the width over here, right? This one's a little bit thicker, but this one's got a lot thicker. And then you can see how they compress, right? When the trend is not as strong, you can see that width between the moving averages start to compress, and may even cross over. You can see it expand and then compress, expand and then compress, expand and then compress, and then turn bearish, right? And then cross over. So it is a mathematical fact, and I don't like to deal in subjectives. I like to deal in facts, right? If you have the 10 period over the 20 period, price over the 50 period, you are in a bullish trend. cannot be refuted because it's math, right? If my 2-week moving average is higher than my 1-month moving average and price is above the average over the last quarter, price is all moving direction in the upward direction, right? It's irrefutable. It is math. But that doesn't mean it's going to last, right? A lot of people think that just because something is in a trend now means it will be in a trend forever. Well, clearly that's not the case, right? Let's go to GE. We saw GE the other day, and I kept this one because I was like, that is the most ridiculous trend I have seen in a while, right? Look at this trend on GE. It's a monster, right? It went from around $86 in November, almost at a 90-degree vertical angle at one point, to 161. So it basically doubled in that time frame from November to June. And how many times do you see a 10-50-20 cross back? Put it in the chat. I want to know how many times in this bullish trend right here do you see a 10-20-50 cross back? How many times do you see the bullish trend reverse? How many times do you look at it and say, oh, maybe it's going to be bearish? I mean, the answer is clearly zero. Yes, thank you, Sebastian. The answer is clearly zero. At no point in time would you ever look at this chart and say, I'm bearish. Why the frick would you do that? Why would you look at this chart? Trust me, I've done this. Story coming inbound. Why would you ever look at this chart and say, bro, it's just gone too far? It's got to turn around, right? Oh my gosh. There was a point in time where I used to be a lot more active following traders on Twitter. And I can't tell you how many times I saw people say, it has to turn around here. It must turn around here. I am starting to buy puts because I am telling the market what it's going to do. Who the frick do you think you are, right? How about instead of trying to stop the ocean, how about instead of putting up one roadblock, like to stop a flood, you grab a boat and you jump on the waves, right? Why don't you go grab a surfboard and ride it in instead of trying to push the water back out? Why don't you just ride it on in? Because it's in a beautiful trend. Why would you ever go against this? So like I said, story inbound. Stories are great learning vehicles, especially when I can relate to how much money I lost when I learned these. And I can't tell you what year it was because I honestly don't remember. But I think it was, I'll find it here. This is my gold story. Oh, there it is. That had to have been it. Had to have been. Look at this downtrend. Look at this downtrend, right? That is the most obvious downtrend I may have ever seen in my entire life. As Randy says, trees don't grow into the sky. At some point, they're going to reverse. Yeah, well said. That is a very obvious downtrend. But yours truly thought he was smarter than the market. Yours truly said, you know what? It has to go back up. I was following these traders on Twitter, which clearly lost me a ton of money. But at the time, they were saying it has to go back up. It has to go back up, right? And as gold is plummeting to zero, practically, you know, the shiny stuff going from, I don't know, $2,000 an ounce to zero is what it felt like. I'll put it that way. It's going down and it's going down and it's going down day after day after day. And I'm like, let's go. I'm going to buy some calls here. Well, not that big. I'm going to buy some calls here. I'm going to buy some calls here. I'm going to buy some calls here because, bro, when that turns around, ooh-wee, I'm going to be making so much money. And of course, down and down and down and down it goes. But this was before I worked with Steve. This is before I learned my lesson here about how a trend works. And this is how I trade now, which is I will never, ever trade counter trend. And I don't think you should either. Doesn't mean you're always going to win, but you're at least moving in the direction of the market, right? If you are at least moving in the direction of the market, you are setting yourself up for so much success. But if you're trying to steamroll the market, if you try to step out in front of the train, right? The train is clearly going south down the tracks here. And Chris decided to throw all his luggage on, right? Step on the train and just, here we go. We're going to go the other way, right? We're going north. Come on. And then the train just ran me the hell over. You don't have to do that. Nobody should ever have to do that. And you don't have to when all you got to do is throw on 3 moving averages. And you don't have to overcomplicate things. You don't have to pay $30,000 to get a haircut. And you don't have to make it super complicated to tell which direction the market is going. 3 moving averages. It'll take you all of 3 seconds. In fact, you could probably teach this to your children, and then they will be able to tell you which direction a trend is going, right? And then there will be times where it's kind of in the middle here, right? Where you've got the 10 is over the 20, price is over the 50, right? You've got some times like that. And then look at that. It seemed to reverse a little bit. But as Randy said, a tree doesn't grow forever, right? And so that's why we intermix the short, the intermediate, and the long term together. Because if the short term is now above the intermediate term, that's a good sign. If the price is above the long term, that's a good sign. So you throw all those together, you're looking in the right direction. Was this useful? Was this helpful? Right? I try my very best to make sure that I can relate these to you because somebody took the time, and I'm so grateful, to teach me everything about trading. And so while we don't have any trades to make, I'm going to do my very best to teach you everything that I know about trading. And I'm going to do it in bite-sized lessons like this. So if this is useful, let me know in the chat because I really want to make sure that we're all on the same page here. Were you in the options that you couldn't hold forever? Bro, I was in the options that I couldn't hold for the next 2 weeks. They were going to expire. Like, that's how stupid I was. That's how stupid I was, Randy. Dave says, this is super useful. Awesome, awesome, awesome. All right, cool. So we'll wrap it there. And before we go real quick, I want to do this every day because I really want you to know that we appreciate you so much for being an outlier, right? We literally could not do this without you. And we want to pay you back every single day by helping you save money or save time, make money, start winning with less risk. And don't forget, we will be raising the price on our annual plan at the end of the month. So if you don't already have the annual plan, please do yourself a favor, go get it. It's literally 82 cents a day. If you're not doing that, you're definitely missing out. Peter says, very useful. So thank you all so much for coming to today's trading room. Glad that I could help out, and we'll be right back here tomorrow. And I hope you'll be here too. Don't forget to hit the like button and share this with somebody else. Talk soon. You're only going to give it $4 to find out if this trade is going to work. And if it doesn't, that's okay. But you got to get out, right? You got to get out. You can't let it go down 15% or 10% or whatever before you decide, you know what, maybe it's not going to work, right? That's $54. That's the difference in a trader who survives and a trader who blows out their account. Is the trader who survives says, oh, you know what? I'm going to give it $4 to find out. And if it doesn't work, I'm gone. Whereas the other guy, it went down $54 and he's like, man, this sucks. I got to get out. You're never going to survive if that's the case. So that's the very first thing I do. The next thing I do with ATRs is I like to go up 1 ATR from my entry point to where I'm rolling options, to where I'm getting aggressive. This is not, what am I trying to say? The rolling options is beyond the scope of what we're going to cover today, but I just want to set that point, right? So if I'm only going to give it a half ATR, in fact, let's remove this line so we don't get confused. If I'm only going to give it a half ATR down, I want to see it go up. And if it goes up, I have plans, right? I have plans. If it works against me or if it works for me, I have plans. So let's say 562.05 plus the current ATR at 7.32. So I would go up to 569.37. Right there. By the way, thank you again, Goran. Goran actually was the one who brought to my attention that I could have like predefined lines on here with the labels and the colors just like I like them. So I appreciate that. It makes it a lot easier. So if it goes up by 1 ATR, that means I have now broken out of the range that I'm in now. We have set a new average range. Now, of course, we've seen this a million times where it'll go up and it'll come right back down, right? We've seen this. And I'm going to get really nerdy on you for a minute. Follow me for a second. If I got in at 80 delta, and delta means $1 in option, or for every $1 move in the stock, the option will move by 80 cents. Okay. if I get in with an 80 delta and it's gone up to here, that option may now be a 90 delta. So I can roll it. And when I do, like I say, beyond the scope of what we're doing, but I'm trying to give you some perspective here. When I roll it, I'm going to roll it from 90 back up to 80. Okay. So I'm taking those 10 deltas away. I'm basically resetting my position, but in the same time, I keep the trade on, I've taken partial profits, and I've freed up capital to do more trades with. Then if the trade goes against me, right, let's say it goes right back here, I will actually have more money in my account by having rolled it at that point than I would if I had just left it there. Now, Chris, how could you have done that? Probably should have waited to explain this when we get to that part of the strategy, but I'll do my best here. If it goes from 80 to 90 and I roll it up to 80 and then it comes back down, it's not going to be 80 again. It's going to be at 70. So my option is actually going to be worth more than the original 80 delta to me because I was able to keep the profits in the meantime, even though it came back down. May not necessarily guarantee a win, but at the same point, it allows me to be offensive yet defensive on this trade. And I do that basing this on the volatility, right? I'm not doing this willy-nilly. I'm not doing it at any point. I'm not doing it at a $5 change. I'm doing it at one ATR change because that can change, right? If it's gone up that much, that means there is an actual fundamental shift in the stock. And hopefully, it also means we're about to see some like rocket ships up to the moon, right? We're going to have Elon take us on SpaceX up to the moon. That'd be awesome. Doesn't always happen, of course. But that's part of trading with the volatility. And then if we did it here, where the volatility is so much lower, 4.25 versus 7, right? I could trade twice as much and I can roll it up twice as fast. That's pretty cool. But I'm also giving it half the risk, right? If this is a $3.50 risk here, or $4, let's just round it up to $4. If this is a $4 risk here, my risk on this side, when the ATR is lower, so I'm only going to give it $2. So I want to show you what that looks like. I did plan this out. No, I don't remove everything, just these. I did plan this part out. So there is an indicator that you can look for called ATR trailing stop. Now this should look really familiar. This should look ultra familiar. We'll make this green. We'll make this ultra thick. So you can set this trailing stop to be whatever, right? But let's say I put it at 0.5. This is really cool. The difference from the current close to this line is a half ATR, right? That would be my my starting point to get out. Now, of course, I wouldn't leave this on my chart because it's all over the place, right? Like if you wanted to use this as a trailing stop where it pulls up behind it each day, you totally could, right? Giving a half ATR. And then when it closes on the other side, it flips, right? Then it goes a half ATR above it. But that's a really easy way to account for volatility in a trailing stop, right? Instead of a 10-period moving average, right? You could use a half ATR trailing stop and say, okay, when it closes below my half ATR trailing stop, then I'm out. But it is definitely a lot more work. It's not something that I would never trade with that, but I would use it on the one day to get my new stop level, right? If this is here to here, right? 285 is a half ATR on that particular candle. Whereas if I take 285, in fact, this is one of the things I wanted to do. If I took 285, which was a half ATR at one point, and I put it on this candle here, I don't know how well that's going to zoom in. You can see I'm nowhere close to the half ATR. The half ATR here is expanded. Now it's 419, right? It's like $1.50 more, basically. So 50% more risk, maybe even more. Right? Let's say it's $2 more. So this is useful, but I would only use it on the day you're putting on the trade. Otherwise, I would take it right off because it's going to mess with what you're looking at. So ATRs are great because they allow you to change what you're doing with the market based on what the market's doing. And I couldn't think of a smarter way to trade than by having the ATR value built into all these parts of your system, right? Where you're going to get in, give it an ATR above, give it a half ATR below. When you're position sizing, right? Building that in. So now you're limiting your risk in multiple ways, right? As Mark Douglas talked about on that trading psychology video we did, second time I'm mentioning it, he talks about limiting your risk. And during that point, I was like, we limit your risk in two ways. Number one is by position sizing correctly. You can't position size correctly without taking into account the volatility and how it changes on each individual asset. And number two, knowing where on the chart you're going to get out, right? The charts aren't magical, okay? But they do give you lots of data, lots of information, okay? You've got to remember that if I'm going to get in at this price, I'm only going to get out if I have an exit signal happen. Sometimes, you got to take your losses and move on. But when it's a half ATR loss, it's a lot easier to take than assigning a random 7%. We mentioned that the other day. That's William O'Neill's rule in how to make money in stocks, 7%. That's so arbitrary. How can you 7% on one stock could be half an ATR, whereas 7% on another stock could be 17 ATRs, like it never moves. So why would you use that? Using the ATR gives you way more information and definitely worth your time. Tug says, in my opinion, a rate cut is probably already baked into the market. Totally could be, right? That's the whole thing, right? The market already prices things in. My guess is the indecisiveness is the uncertainty of the magnitude of the cut. Randy says, Thinkorswim says ATR 14 Wilders. I don't know. Yeah, this doesn't say anything about Wilders. So I assume it's going to be the same data, honestly, Randy. Take this off. Wes says, these books you recommend are worth at least 10x, maybe 1,000x. How much they're priced at the store? Absolutely. Absolutely. I'm glad you're getting value out of that, Wes. Okay, let's wrap this up over here. How traders use ATR. It's a volatility measurement, like we discussed. A higher ATR indicates higher volatility, while lower ATR indicates lower volatility. A stop loss placement. Some traders use ATR to determine where to place stop loss orders, giving them more room during highly volatile periods or tightening up stops when volatility is low. Exactly, right? The ATR will expand or contract, and so the half ATR will also necessarily expand or contract. Identifying breakouts. ATR helps traders understand when a price breakout is significant, like we talked about, right? Helps us understand when it's moved up, an ATR from where we got in. As higher volatility often accompanies strong price moves. Would you like more examples of ATR in stock trading strategies? Yeah, let's go for it. Dave says, I think Thinkorswim is the same data as TrendSpider from what I've seen. And he says, looks the same. I'm just not sure what Wilders is. Dave says, I've used ATR to determine the width of iron condors. Works well. Iron condors don't work well. That's beyond here. But that's where I was losing my face over and over and over. Okay, so this just talks about how to set it as your ATR value for your stop loss, breakout opportunities, ATR for trailing stops, ATR position sizing, right? All the stuff that we do on a daily basis. And we do it because it works, right? We do it because it keeps our risk small. It lets our position sizes be dynamic based on what the market's doing. And that lets us have a position size that's appropriately risking the same amount of account value in any different stock. Coke and Tesla had 12 times different ATR values, but yet we can risk the same dollar value in our account by changing our position size using the ATR. And then we can also find the risk on our the risk on any stop loss. And we can also figure out when we've got those breakouts that are really working by using one ATR above. So it's a complete package. It's one of those things that I'm so glad that I came across because 99% of people don't even know what this is. They don't understand how powerful it is and why, you know, just this little tiny line on your chart can be so impactful. And Randy says, like I said before, love the half ATR to get out. I do too, my friend. So that's going to cover everything in the charts section of the trading strategy. We'll go into, I think we already did market breadth before, didn't we? Yeah, we did. We did market breadth here. Okay, so the next step will be reducing risk. We'll work on this next time. So we'll work on setting your stops, taking these exits for the next few days, right? I want this to be the most comprehensive trading course you've ever had in your entire life, which is why I'm taking the time to go through every little bit as best we can. Because at some point, you're going to look back and you're going to say, wow, I am so glad I learned that. And I am too. I am so glad that you're going to learn this because I am blessed beyond belief that I had the opportunity to work with 5 market wizards and some incredibly wealthy people who taught me how to trade. So how about I just pass that on to you? Plus, making it with OVTLYR just makes it a million times easier. So thank you all so much for coming today. Real quick, before you head out, I need to go over here. Hang on. There we go. Thank you so much for being an OVTLYR. We literally couldn't do this without you, and we want to pay you back every single day by helping you save time, make money, start winning with less risk. And don't forget, we are raising the price on the annual plan at the end of this month, so you need to go get it. It's only 82 cents a day. Make sure you click the coupon on the pricing page if you haven't already got it. And of course, if you haven't already, hit the like button. It is totally free, and it lets YouTube know that you like these kind of videos. And like I say, the first rule of OVTLYR is to tell everybody about OVTLYR. Have a fantastic day. Let's talk about the screener. So this is a new thing that we have here at OVTLYR, and it is awesome, right? It is so cool to be able to, I mean, it does everything that I was doing before, but in the click of one button, right? It does everything that I wanted it to do that I was doing manually, but in the click of one button. So that is one of the reasons why OVTLYR is so awesome, is because we real traders are actually really using it every day and trying to find ways to improve upon it. In fact, Mahesh's idea of adding moving averages to it was because Mahesh is using it and he's trading it. And he's like, you know what? It really would be a little easier if we had moving averages on here. And I was like, yeah, I know. And order blocks might be in the future. I can't make any promises on that. But I know that both he and Mark were very interested in seeing if they could incorporate order blocks into the platform. So maybe that enhancement will come one day. I would love to see that because, as you know, order blocks are a huge part of how I trade. Cam says, my 30 deltas blow up today. I love days like this in both the SPX and IndieX. Cam, I'm glad it's working out for you, my friend. All right, let's go to the screener and let's talk about how freaking sick it is. Okay. So this is what I use here. Positive backtest. Over 1 million average daily volume, a buy signal, oscillator moving up. That was just what I was talking about, the blue line. All the market caps, like I don't care about market caps. I like to see over $20, right? You don't have to do that. I am a snob. I want my stocks to be expensive. So I want them over $20 at least. The heat map, I do have some limits on this. I want all the R's. I want anything that's moving out of fear into greed, okay? And then green, I only want up to G40. Right? Because if it goes over 40, it's already really far out there. In fact, I mentioned this just a couple days ago. You got to take a look at it from a perspective of how much greedier can we get here? If we're already at 40 out of 50, we're like 80% of the way there. I don't know how much further that can go. So I'm not even going to risk it. So let's build this together. So you would go over here to the screener. You click this button and let's reset the filter. Click the wrong button there. Reset the filter. So like I say, I like all the sectors. doesn't matter to me. If you wanted to eliminate and only look at certain sectors, you can. Let's say, for example, you want to look at financials and you want to look at banks, right? You can filter everything else out and only look at financials and banks. But I like to do it all wide open. Outlier signal return. The positive is this number here. So you get a performance summary, and it's this value right here. How is the outlier results, right? If they have positive expectancy, we talked about expectancy earlier today, that's what I want to see. So I only want positive signal returns. Capital efficiency. Capital efficiency is this metric here. The way to describe this is it's a measure of how long you're in the market versus how well it has performed. Let's see. Let me see if I can find an example real quick, like right at 2.0, so I can do the math for you. .0 works. CWH. Let me show you what capital efficiency means. It's a measure of how well you're performing in the market versus how long you're performing. That's a negative. I don't want that. Oh, it's because we haven't done our filters yet. Hang on. 2.14. We'll work with that one. Okay. EVR. John Louis says that would be a game changer. Absolutely. Randy says order blocks would be awesome. I agree. All right. So this one here has a 206% return and outlier. Pretty freaking sweet. I love that, right? Capital efficiency is 2.14x. What does that mean? So first off, take a look here. Up in the corner, you can see buy and hold. We've been in it for 1,186 days versus outlier signals would have had you in it for 480 days. There were 25 buy signals during that time. Average holding period only 19 days. So you were only in the market 40% of the time versus being, 100% in buy and hold. Okay. So here's where we start to get the capital efficiency. I'm only in it for 40% of the time, yet my returns are outstanding. 206%. Buy and hold is at 238. Okay, I'm only in it 40% of the time, but the returns are nearly identical to this, right? So if I'm only in it 40% of the time, I'm trying to think about how I'm going to do the math here. I'm only in the market 40% of the time, okay? We got 203 on our returns, and it was 238 in buy and hold, okay? So that is 85% of it, okay? So if I do the math correctly, and it's going to take me a couple times. I want to make sure I get the math correctly. This divided by this. I did it right the first time. What's up? So that 2.14x, right? We got 85% of the returns, yet we were only in the stock 40% of the time. So that means our capital was working twice as hard. Does that make sense? All right? Do you understand the math behind what the capital efficiency is? We got nearly the same returns, but we were only in 40% of the time. So our capital is working twice as hard, which is pretty cool. Randy says that capital could be used somewhere else. Nice. Exactly. Let me know if you have a question on what capital efficiency is, right? Because we're measuring how well you are performing relative to the stock itself, relative to how long you're in the stock. All right. So moving on, that is one of the things you can add to the capital efficiency. Above 2, 1 to 2, or less than 1, I just leave it wide open. 30-day average volume, pretty obvious. I like over 1 million. I want liquidity. Current signal status, buy or sell. Well, daggum, if I'm buying stocks, I only want to look at buys. Price change. This is something Mahesh likes. I don't use it, but he does. So let's say over the last 1 month, I want a correction of 5%, 10%, or 20%, right? Maybe for you, that's the way you like to invest. You want to see something with the correction first and then it pull back. Whereas I personally, this is my personal preference, I like to see a stock that's already strong and getting stronger versus a stock that was weak and is now getting stronger. So that's why I just leave that wide open. No selection there. Oscillator. That's the blue line we talked about a minute ago. Right? That's the price trajectory oscillator right there. So I want to see that moving up. Market cap, I leave it wide open. I don't really care. But maybe you trade small caps and you can do up to 5 billion. Totally up to you. Price range, you can be a snob like me and say minimum 20 and leave your maximum wide open, or you can leave it wide open and I'll give it you everything. Or let's say you only want to trade anything under $5, right? There you go. Then you can come to the heat map values. We talked a minute ago about what the heat map values represent, the fear and the greed. So if I'm going long, I want all the R's. I want most of the G's up to G40. Leave it like that. And then the overlay indicator. That's these backgrounds here. Green is an uptrend overlay. Red is a downtrend overlay. White is a sideways overlay. So I would add just uptrend. Then I'd hit apply filter. Then after I do that, these, in my opinion, are the creamiest of the cream of the crop. These are the ones that I want to trade, right? And then you can say, awesome, I want to save this. I'm going to save this as Randy's very best screener of all time. There you go. Randy, that's your very best screener of all time. Then you come over here to your screeners and you're like, oh, you know what? I don't want to use Randy's very best screener of all time. I want to use Outlier Bullish. That's what I named mine. I hit apply, and then it'll put all of mine onto there. And I mean, you could have different ones, right? You could, I mean, you could have ones for being bearish, which I've got here. You could have ones for bullish. You could have ones for maybe earnings. You know, if that's something you want to look for, there's all kinds of stuff that you could put your screeners on. And then I just do the same thing for ETFs. When you build your ETF scanner, your screener, you can save it over here, and it saves as a different name, right? You don't see Randy's very best screener of all time right here. You see my ETF ones that I built, and basically same thing. The only thing that I do different is I just want the, actually, let me do this. Outlier Bullish, apply. I just want the State Street Global Advisors ETFs. That's the ones you're familiar with. XLB, XLF, XLI, XLY, all those guys, right? And then there's a few others thrown in there too, like KRE, KBE. Those are regional banking, XBIs, biotech. So that is exactly what I do, as I did on these stocks for ETFs, with the exception of I want this ETF. Does that make sense? Anybody have any questions? Carvana, baby, driving me to the bank. Michael, I don't know if you know my Carvana story. I used to have a Mini Cooper, and one day before I got my Tesla, and I'd been wanting a Tesla for ages, but I didn't have an excuse to get it because my Mini Cooper drove great. I loved that Mini Cooper. I drove the mess out of that car. It was so much fun. And one day I walk out in the garage, and all the fluids that were in the Mini Cooper were on the floor of the garage. They were all out of the Mini Cooper. And I was like, ooh, okay, probably need to get that fixed. So I took it to a Mini Cooper repair place right up the road from me, and they only work on Mini Coopers. Like, that's their specialty. And if you're a Mini Cooper guy, you'd know. They give me this estimate, and it's $4,400 to fix it. And I'm like, just slap it together. I'm done with this car. Just put it together where I can drive it over to Carvana and sell it to them. So $500 got me out the door, drove it over to Carvana, and they gave me like $3,200. So clearly it was a total mechanical failure, a total mechanical total loss, right? So I was really happy that Carvana gave me any money in that case. And then I went and bought my Tesla. So it was worth it. Randy says, that's me. And maybe one day we'll be able to share these scanners around. But that's how you build the scanner. So I just want to take a few minutes today to talk about how we build the screeners, how we build, you'll hear me call it scanners and screeners interchangeably, but that's what this is for. A little bit of education on how to run these, because in the very near future, we're going to be running trades, and we won't have time for these kind of lessons. So I hope that this is super useful for you. Hey, Joel asked a question. Do you ever use performance summary other than the max? Let's go to that real quick. Performance. Oh, okay. I'm really glad you asked that. Let's go to Carvana, since that's the stock of the day. this is something early on in Outlier I picked up on, and I was like, guys, we need to work around this, Mark and Mahesh, because if you go to the 3 month, right? Let's say, for example, if you go to the 3 month in Carvana, there's one opening, one closing. There's one closing from something outside the 3 months. So it's only going to register one trade. Okay. Then if you go to the performance summary, right? Outlier did great, buy and hold did great, but it only had 2 buy signals, the one that came today and the one previously, right? So if you look at that, that's going to give you drastically different results. If you look at it just at the 3 month time frame, you are not going to have all the details you need, right? Because you only have 2 buy signals and only one of them has completed. If you go to 6 month, it will change. It is dynamic, which is great, right? These returns are awesome. But then again, you're only looking at 4 buy signals. That's not enough for a lot of data here. So I always go to the max. Always go to the max, because that's going to give you the most amount of data you could ever want, right? Look at how different of a story this is, right? When you include all the data, Outlier is at 70%, buy and hold at 2. Buy signals, 15 signals, right? Think of it this way. If you are evaluating anything in statistics, you want as many data points as you can. You can't do any sort of statistical analysis with 2 data points. 15, that's, 7, 8, 7.5 times better than 2. But of course, we want even more. So this is growing as we get more data. But you, in my opinion, always want to start on the max view, because that's the default. And that's how we got there. I was like, guys, we need to default to max, because then you can zoom in and get everything you need, right? Versus just hitting one of these time views, and that totally throws off your stats. And I don't want you to ever be swayed by the stats that aren't, conclusive. I don't want you to be swayed by, the performance of 1 signal versus the performance of 15 signals, right? A lot more reliable when you have more data. So thank you all so much for coming. We covered a ton today. I'm really glad that we are doing this every day, right? My objective here, especially while we're not trading, is to make sure that you have all the equipment you need, so that when we do start trading, we're going to kick some ass, and it's going to be awesome. You're going to be so stoked about this, right? But before we go real quick, clicky, there we go. Thank you so much for being an outlier. I want you to know that we literally couldn't do this without you. We want to pay you back every single day by helping you save time, make money, start winning with less risk. Tug says, where'd it go? Tug says, great to know. Perfect. Dave says, thank you as always. Great info. John Louis says, great job, Chris. Thank you, guys. Don't forget real quick, if you haven't already gotten your annual pass, the price is going up next week. It's literally 82 cents a day right now. So be sure you go get your annual pass before the price goes up. And do me a favor, hit that like button, right? The first rule of Outlier, you should tell everyone about Outlier. And you do that by right now hitting that like button. Thanks so much, Wes. You are very welcome for LA Education. I'm here every single day. I hope you are coming back here tomorrow, and we will talk soon. One thing that I wanted to actually go over today was Mark Minvervini's rules. Mark is one of my trading mentors. I had the opportunity to work with him a few times. He is a bona fide market wizard and a really, really sweet guy. Like, you would be surprised at how sweet of a guy he comes off as. But it's really funny too. When I started working with him, Mark looked me dead in the eyes and he said, I was explaining to him my trading strategy, and I laugh at this. I didn't at the time. I laugh at this because Mark looked me dead in the eyes and he said, Chris, this is why your trades suck. He was right. And yeah, I mean, it takes those it takes those days where somebody's brutally honest with you to let you know you've not been doing it right. You've not been doing things right. You need to shut up and listen. And so from that moment forward, I was like, yeah, you know what? I really do need to shut up and listen. Dude knows exactly what he's talking about. Tug mentioned he's lost the video feed. Has anybody else lost the video feed? Let me know. If you have, otherwise, if you have, I'll just cut it. But Mark is saying his 6 key trading rules. And I like to follow this here. Wait in cash for proper setups. How long? as long as it takes. Now, I know that you are probably wanting to jump in and put some trades on. I get that. I want to put some trades on too, but I don't see everything that I need to see just yet. And I like to go through this every single day because we don't know when it's going to come through, right? I don't know when it's going to come through. You don't know when it's going to come through. But if we show up every day, take notes, be market aware, we can see trends, we can see things happening, we can make assumptions in the market and then see how they play out without any risk, right? But we are taking notes, learning, making plans, and making preparations, because there are going to be days when things set up and we go hard and we go strong. And it's going to be awesome, right? Number 2, Mark says, always trade with a stop loss. Keep all losses small. We talked in the last few days about how important it is to position size based on volatility. We talked about that one on September 10th. Go back and watch that video. We talked about how to use the ATR indicator to help establish that stop loss for you. And so while some people may put stops in the market, I don't do that. I do stops on the chart. And consider it this way, right? When you position size correctly, you have a stop loss in your account. And what I mean by that is if you put 100% into it, you can't, you could potentially lose 100%. If you put 10% into it, the very worst thing that could happen is you lose 10%, which sucks. I'm not going to say it doesn't suck, but that's a stop loss to your account. Okay. So you put a stop loss in on the trade, you put a stop loss in onto the account, you keep your losses small. That's how you stay in the game. Number 3 rule, he says, is never get bold when running cold. Meaning, like, if things aren't working, right, stop forcing trades. And that's the real key he's trying to get here. Stop forcing trades, right? Take a step back, take a day off, cool off a little bit, and maybe even evaluate your data and say, okay, am I following my plan, right? Have I built in these losses? Does this make sense? Okay, because not every trade is going to be a winner, right? But that doesn't mean you need to start doubling up and tripling up when things aren't working. That's the quickest way to blow out your account. Number 4, nail down decent profits, right? Of course, we want to make as much money as we can in every trade. We can't always control that. But of course, one of my adages, I don't know where I heard it from, so I will take credit for it, is cut your losers short and let your winners run out of control, right? We want those big returns, but not every trade has to be a big return, right? If you stack 5 and 10% winners over and over, you're going to have tremendous returns overall, okay? You don't have to hit 100% on every trade, but you do have to limit your losses every chance you get. Number 5, never let a good sized gain turn into a loss. I have been guilty of this. And there's one big change, and those of you who have followed me for a while, you have actually seen me make this change, and I'll describe what that change was. In the Turtle Traders book, they talked about how if a stock goes your way by 1 ATR, let's just use this as an example, okay? Let's say this is my entry point. Let me make it bigger. Let's say right here is my entry point, and price goes up. Price goes up like this, okay? And let's say that this is 1 ATR. Just for example's sake. And then it turns around and goes against you, right? That sucks, of course, but it does happen. What I was doing and what I actively changed about 2 years ago was, rather than every time it goes up to 1 ATR, doubling my position because it's already working in your favor. Doubling my position sounded great on the surface. Doubling my position was what the Turtle Traders were doing. But if it turns around like this, do you know what happens? All the losses, all the wins from your first trade, they're gone. And now you have losses from your second trade you put on. And that really sucks, right? There was a point in time where I traded like that. And that doesn't mean that it was wrong, but I identified I was not letting this work, right? I was not letting my good size, or I was letting my good size gains turn into losses. because if this had continued on, right, I could have doubled my my win. But instead of like getting out of break even, I was getting out, watching all my gains go away, and then having losers on top, and that really sucked. All right, let's move all these horizontal lines. Okay. Michael says, when we look at market breadth, what are some key insights to glean from the chart? Okay, great question. Market breadth. The way that I interpret this, Michael, is if this value is going up, that's the number of stocks on the bull list. If the number of stocks on the bull list is going up, that means more and more stocks are getting to the point where they have buy signals, okay? And if more and more stocks have buy signals, I'm interested. If more and more stocks have buy signals, mathematically, they have to be pushing up the market, right? If the market is, I'll be crude. All right, so I got a fat sack of cash out of my wallet. Let's say that the market is going up, right? And so you've got, hang on. Let's say more stocks are getting bought, right? So it's going up, right? The more stocks that get bought, the higher this goes, okay? It just goes up and up and up, right? So if more and more stocks are reaching that buy signal, then you could assume more and more stocks are going to be pushing the market up more and more, and buying begets buying, right? And so you're making a trend. And when you're making a trend out of the buy signals, you're watching as the market is pushing itself higher. Does that make sense, right? You're looking at all these pieces stacking together, which is pushing the market up higher, which is what we want to see. Same for not just the market, but also the sector. We want to see them both working together. Dave says, video's still good. Okay, good. Paul, hey, glad to see you. Market breadth. When OVTLYR is measuring market breadth, is it actually using S&P 500 stocks, or is it using the stocks approved for OVTLYR only? That's a very good question. I'm glad you asked that. So you have a couple choices up here. You've got full stocks, or you've got the ETFs, right? So this is everything OVTLYR covers, which is like 2,000 stocks. You've got all the ETFs, if you wanted to just look at the ETFs. And then you can actually filter down on the S&P 500 or the Dow Jones 30, right? So you can make that choice right there, my friend. I go with all of them. How high looking for breadth to be? One thing that I found, and in fact, I am the architect of the breadth indicator here, which I was very proud of. One thing that I found going through all this was something really interesting. First, breadth is so cyclical, right? And I like to measure things with the 10 moving average. As we discussed before, the 10 moving average is your short-term trend. So when you see it crossing over the 10 moving average, the short-term trend is going up. You see it crossing below the 10 moving average, the short-term trend is down, okay? That's why I filter that on. But it's extremely cyclical. Look at it just go like in waves, right? And sometimes the waves are smaller and sometimes the waves are bigger, right? So that's really neat. But what we found is the extremes are very interesting, right? When it gets at 25% or at 75%, and then, you know, above or below at that point, that's when you can see pullbacks happen. And the way that I look at this is if breadth has reached 80%, that means 8 out of every 10 stocks already have a buy signal on them. So our opportunity gets smaller and smaller and smaller. Our opportunity to buy stocks gets smaller and smaller because more and more people have already bought in. And if everybody's already bought in, Paul, what's left to happen? If everybody's already bought in, all that's left are sellers, right? And that's so interesting to me because we see this in the chart of the breadth over and over and over again. And this was an observation I made. Mahesh sent me raw data and I created this chart and I was like, wow, look at this, Mahesh. Every time we reach an extreme, we see huge pullbacks the other direction. So very, very cool. Brian says, Mahesh discussed this on his video. Ah, excellent, excellent. Yeah. Great minds think alike. Okay, let's continue on. And then lastly, I want to know in the chat, just type a number 1 if this has happened to you. Never add to losers. This is something that people consider like revenge trading, right? Or you could go to a stock like GameStop or AMC. Let's go to AMC. There's still the mother of all squeeze, they say, is going to happen on AMC, right? AMC is down like literally 99.9% from its all-time highs, which is absolutely hilarious. Oh my gosh, they've reverse split this several times, obviously. But let's say that you were so stoked about AMC and right, you're one of those people that bought in, maybe not at the high, but maybe the day before. And you saw it go up and you're like, oh my gosh, I'm such a genius. And then it goes sideways for a while and you're like, man, this is so great. I loved it when it was, this is reverse split adjusted, so $317. I loved it at $317, which at the time, I think it was like 10, either way. And then it goes on and sideways and it starts to go down. And you're like, oh, you know what? If I double my position size now at 300, then my average price is 308, right? And if my average price is 308, then I'll make even more when it goes back up, right? And then you're hoping and you're praying and you watch it go up and it goes up to 438. Man, this is probably not the best example. You're like, oh, I'm such a genius. I'm making so much money. And it's back down to 350. And you're like, okay, no, it's fine. I'm still at 308. All is good, right? And then the actual bottom falls out. And you're like, oh crap. Now it's down to 200. My average price is 308. So if I double up again, what would that be? 308 plus 200 divided by 2. Now my average price is only 254. I started at what was it, 300 and then, or 317, and then I doubled up at 300 and I doubled up again when it's at 200. So now it's only got to go up to 250 and I'm profitable again, right? And then it just continues on and now it's down to 150 and it continues on. And it's oh, it went up to 241. We're almost in the green. Now it's down to 100. And we'll just zoom out and yeah, now it's down to $4. Hey, if you loved it at 300, I bet it is the greatest deal of all time at $4, right? Yeah. There's no reason to do that. If a trade's not working out, do not start doubling up, right? Do not ever add to losers. That is honestly something that I don't know why, but that thought didn't cross my mind until I started seeing these rules and learning these rules about never add to losers. And I was like, people do that? So trust me, I've made many mistakes. Fortunately for me, that was one that I avoided, but that's okay, right? Michael says, OMG all the time, but you learn from it, right? You learn from it. Paul says, how much of a leading indicator is the market rep? Not sure what you mean by the market rep. I'll be glad to look at it. I'm just not sure about that one. Dave says, that was one of my early mistakes. Trying to dollar cost average on options was something that was a loser. CCL killed me on that when I first started. Take a look at CCL. Dude, like these moves in CCL are pretty brutal, right? I mean, I imagine you got in at $9 and then it went up to 19 and then it came back to 11 and then up to 19 and then back to 14. I could see people blowing out their account just trying to catch these moves up and down, right? That's brutal. But I also like to point out 10, 20, 50s. Just follow the trend. It makes it a lot easier. You could have traded this both ways and done really well. And good gravy, good Lord. You see those order blocks? Look at the rejections over and over again. There's one there. Reject. Isn't that the coolest thing? I love me some order blocks. Oh, Paul says, how much of a leading indicator is market breadth? Gotcha. I don't have data on that, Paul. But I will say that I need to see market breadth moving for me in the same direction as sector breadth. That's what I mean by this, right? And then once those are in agreement on whatever stock that I'm picking, that's when I'm comfortable taking the signal in outlier. But by all means, That's just my style of trading. I like to preface this and say, you can trade any way you want to, my friend. That's just my style of trading. Dave says, I came in at 1650 on the upswing, mainly in options. Dollar cost averaged with more options without being long enough in length. So everything went down even fast. Oh, yeah. Gotcha. Everything went down even faster. Yeah, for sure. Speaking of things going down even faster, I want to share with you a video I saw earlier today. One of my Finance Bro channels here. Reventure Consulting. I don't know if you've watched this channel, but it's very good. I only want to play a couple minutes of this because I thought he had a really good point about the Fed cutting rates.
In a historic move, the Federal Reserve just cut interest rates by 50 basis. In a historic move, the Federal Reserve just cut interest rates by 50 basis points, suggesting that both the economy and the housing market are going to shift markedly over the next 3 to 6 months. In this video, I'm going to give you all the data that you need to know and understand as a home buyer, investor, or just someone trying to track the economy. Because historically, when the Fed cuts interest rates, everyone, that's the signal that a recession is on the way. Because 10 of the last 14 times that the Fed entered a rate cut cycle, we had a recession. Only 4 times.
Okay. So 10 of the last 14 times we've hit a recession, he says. I don't know this data. I'm just going based on what he says. So the fact that we're cutting rates now, I don't know. I mean, but realistically speaking, who hasn't felt like we're already in a recession, right? Who hasn't taken a look at prices on the shelf and be like, whew, I think I'm going to go with the off-brand mayonnaise this week instead of Hellman's or Duke's, right? Who hasn't taken a look at the cereal? The best example I ever gave for just how much inflation had gone up, and this was like 2 years ago at this point. I can't imagine what it is now. I don't buy the groceries. My wife does. Good thing, because I would have a panic attack every week. Was I went to Walmart one day. I was craving Fruit Loops, and I bought 2 jugs of Fairlife milk and a bag. Not the box, the bag of Fruit Loops, and it was $17. And I was like, I just want milk and cereal, and I had to spend $17 for this? This is unbelievable.
Did we dodge a recession? And what a lot of people make the mistake of with Fed rate cuts is they think actually it's a positive for the economy. For instance, check out this article from September 2007, right before the great financial crash. This article reports on how on September 18th, 2007, 17 years ago to the day, the Fed cut interest rates by 0.5 percentage point in an attempt to help the economy. And look at what happened. Stocks surged following the announcement. The NASDAQ shot up 2.7%. The S&P closed 3% higher. This is a good first move that will give aggressive confidence and aggressive relief to credit markets and the consumer. And the stock market actually continued to rally, folks, through October 2007 after the Fed did that 50 basis point cut 17 years ago. And why I'm giving you that example is so you can understand what we're seeing today mirrors very much what we saw at the beginning of that last crash, and that the people who are getting overly excited that a Fed rate cut is somehow going to mean that asset markets are going to go up forever and the economy is going to avoid a recession. These same people existed 17 years ago, right before Lehman Brothers and right before the biggest housing crash of all time. Now, that doesn't guarantee that we're about to see a repeat of 2008. We, of course, need to look closer at what's going on in the economy, because one of the benefits to Fed rate cuts for the economy is that borrowing gets cheaper. Interest rates go down, mortgage rates go down. Mortgage rates are already down to 6.1%. The cost of borrowing a loan for a car goes down. Credit card interest rates go down. So those things will help consumers. However, the early returns, when I polled you guys on if these rate cuts are going to matter, are not so positive. For instance, 6 days ago, I polled you guys and asked, mortgage rates just dropped to 6.1% in anticipation of these rate cuts. Does this make you more likely to buy a house?
Yeah. So to his point here is that he polled 19,000 people on his social media, and 91% said, nah, the rates are not low enough for me to buy a house. And I mean, I get it, right? That even with a 50 basis point cut to interest rates, that house you want to buy, it still has appreciated like 2x in value. It's nearly doubled in value in the last few years. And just because you can finance it slightly less, that is not enough to move the needle. So to his point, I don't know if he's going to be right that we're looking for a huge crash. But it is interesting to see the correlations here, right? It is really interesting to see that nearly 17 years to the day, we also got a 50 basis point cut. And then the bottom broke out, right? All hell broke loose, right? I was graduating college with my MBA around this time, and I was so completely like out of touch with what was going on. I had no idea just how bad things were, and it didn't go very well, right? It was a really, really tough time. So I'm really hoping that we don't see another repeat of 2008. But you know what? We've got to be prepared for it either way. So I appreciate him putting out the data on that. Let's catch up on the chat real quick. Dave says that's where he learned about theta. Yeah. And Dave, that is why when I go to trade, I try to trade as little theta as possible. Randy says he's been buying a lot of great value. Me too, my friend. Citigroup went from $55 to 96 cents. Brian says, great movie. Dave says, oh, there it is. I think it's funny that they are basing the recession on 2008 on the rate decrease. Very oversimplified, of course. Yeah. Watch The Big Short. It was a great movie about what really happened during that time. Dave says, it really is, Brian. I work in land planning and development in Arizona, and I felt this firsthand. Brian says, you also need to have the need to buy a house. Yeah, for sure. So that's going to wrap everything I want to cover today. And, oh, wait a minute. There we go. That's going to wrap everything I wanted to cover today. I really appreciate your time. Thank you for letting me spend some time with you here on Friday. And thank you so much for being an outlier. I want you to know that we literally could not do this without you. And we want to pay you back every single day by helping you save time, make money, start winning with less risk. And don't forget, we are raising the price on our annual plan next week. So if you haven't already got an annual plan, it's literally 82 cents a day. I would highly, highly, highly encourage you to do so before we raise our prices. And don't forget, hit the like button. I know you're already subscribed. You guys are doing an amazing job of hitting that like button on every single episode. So please continue to do so. It lets everybody else know how great it is to be an outlier. Have a fantastic day. Have an incredible weekend. And I'll see you right back here on Monday. Talk soon. But I did want to take today to spend a little time working on a chart scanner. So as you know, one of the things that I like to do is look at the charts just like this, right? And say, okay, what is this telling me? Is this giving me the information that I need to see or not? So I built a scanner. Now this is in TrendSpider. You don't have to have TrendSpider at all, but it does help, right? It does help. And so you can have any charting platform out there that can do scanners. And I know a lot can. I know a lot of our traders use TradingView, and that definitely could be one that works well for you. Randy's saying, hey, looks like resistance. Totally could be resistance. We might see an order block fill in just here in a couple days. But on the scanners, I have it so it's pretty simple, but I want to go through every bit of it so you can understand why I do it and the way I do it. First is no order blocks in the way. Now, if you've been following me for a while, I will tell you that there have been days where I'm like, why is this order block still pulling through? In fact, let's see if one does it today. No. Okay. So my scanner is supposed to exclude anything that has an order block in its way. Like this one right here, right? It didn't pull through on my scanner, but what I figured out was in the setup for this. Let me show you what I mean by the setup. Scanner. Outlier long. And the setup for this in Outlier, or not Outlier, in TrendSpider, they have what's called order block or order blocks proximity. So let me show you what that looks like. Order blocks proximity is this here. So basically when you put in the details, 50%. In fact, let's talk about that. 50%, band percent. Oh, okay. Sensitivity is 50, which is the same as on the order blocks. We also have one for 28ths. Band type is percentage. Now it could be ATR, standard deviation, or a constant value. Band multiplier is 2. Band length is over the last 14 days. So what I'm trying to say is it's 2% away from an order block. That's, I believe that means developed in the last 14 days or something like that. Exact. I don't know all the details of this, but what the objective here is to filter out when something is close to an order block. It'll be inside of the shaded area here, or when it's away from an order block, it'll be outside of this. Okay, so that's how I've got it set up. But let's go. One quirk of this that I found is that you see the dot right here where my cursor is? That corresponds to when this is created. This dot corresponds to when this is created. This only works on the most recent order block. So that is something that I many times have come across this and be like, I don't know why it keeps showing order blocks. That's because anything that's newer takes precedent on that particular indicator here. And so like these order blocks, while they are there, right? In fact, this is a great example. While the order block is here and the dot is on the chart still, right? It's not reading that it's inside of this one. It's reading that it's inside or close to the newest one. It's within 2% of the newest one. Okay. So that's the first step, is looking at the order block percentage. Now, I will say, being that that is a difficult indicator to come across, you could go without that one. You could go without that one. The rest of these, I think you should definitely have. Next, no earnings in the next 3 days. Now, we have also seen that this is not 100% reliable. There have been days, in fact, Bank of America was one that did not show accurately on the chart. But most of the time, it'll show, see this orange value right here? That shows that there was earnings right there. And we actually did pretty great on that. Thank the trading gods that we did, because I was not planning on holding that into earnings. But you should see, like out here in the future, this says the next earning date is on October 15th. So when I'm building my scanner, I'm saying I don't want to look at any stock where earnings are within the next 3 days or earnings are today. Now, I don't mind trading into earnings, right? If a stock is leading up into earnings, let's say earnings are on Friday, I'll look to trade it on Monday, and on Monday it may run up into earnings, right? If everything else is set up, there's no reason not to, because a lot of the times, and you've seen this too, stocks get or investors get excited and they'll run up right into earnings and then getting out right before earnings. So you don't have that risk, the earnings risk, because earnings are a risk, right? You don't actually know with a lot of certainty what could happen. It could have a great report and still crash the stock. You never know. Next, the 10, 20, 50, like I talked about on the SPY, this exact layout right here is in the direction of the trend. So what do I mean by that? If I'm going long, right, my market scanner, long. If I'm going long, I want the 10 over the 20, and I want today's price close over the 50. Okay, that's what that means there. 10 over 20, price over the 50. Then I want to make sure price is greater than $20. And that's just my own personal preference. I don't have it listed here, but I always look for that. And then price is over the 10, which it should be if it's trending, so that shouldn't be an issue. And then the last thing that I put on here is the price close is greater than the low of the prior day, right? So here on Bank of America, this is below the prior day's low. Do you see that? We talked just a couple days ago about how important that is, right? A stock in a beautiful big trend, you're not going to have many days like this, if any. Okay. So the 10, maybe over 20, price is over the 50. However, it doesn't have the price over yesterday's low. Let's talk about that real quick. So here, for example, this did have it on one day, but every other day during this trend here, you can see it got nowhere close to below the prior day's low, right? So that's what I have in my scanner. And like I say, it is a little complicated on the order blocks, but if that's the only thing that you leave off, you're still going to do great. You're still going to find incredible opportunities. And then you can look on the chart. You can ask me, you can ask our fellow outliers, and see if someone else maybe has order blocks built onto theirs, and say, oh, you know what? I wouldn't trade this. It's coming right up into an order block. That's a dangerous place to be. So does that make sense? Does anybody have questions? Because that's everything that I was going to cover today. I mean, honestly, at this point, I'm racked and ready to go. I told you I added about 30% to my account just last week. So I am ready to make some money. I don't know when it's going to happen, but I'm ready, right? And I hope you are ready too, because it could literally be tomorrow, and we'll start getting real deep. But got to follow the plan. Got to be ready. Got to wait just a minute because Tug says he's got a question coming. So I'm going to hold tight. I'm going to kill some time. There's a Discord update. Jorn and Sebastian were chatting. Hold tight, everyone. Tug is typing out a question. We don't want to take off without giving Tug an amazing answer. While Tug is doing that, let's take a look at one of these. So I apologize. I didn't get a chance to do any back testing this morning. I've had an incredibly busy day. But we can do one together. We'll do one live together. And this is going to be a lot of screen flipping. So try and follow along. So I already ran my screener this morning. I'll run it again real quick. And we'll take the first one on top. I don't know how these results are going to come. So we're going to do this. So ATI, okay? ATI was this one here. I wouldn't trade it today because it's got an order block right there, but we can backtest the signals. So this is going to take a minute, okay? So ATI. And so like I say, I've been doing this. I've been doing it manually, and it takes time, but it is really, really cool to see. Materials. So we're going to go to the materials sector. And then we're going to put on the 10 EMA. I'm going to shove this all the way to the left. I'm going to shove this all the way to the left. This is a SPY signal. Need to get one more market breadth for the full stocks. Shove this all the way to the left. Okay. So the way that we're going to do this is we're going to look for the signal on ATI, if it's a buy or sell. Then we're going to look at the SPY. Does the SPY also have a existing buy or sell signal at that time? Then we're going to look at the market breadth to see if it has it, and then the sector breadth to see if it's bullish, right? Then when all of that is confirmed, then we'll go to the SPY chart, make sure that that's bullish, and then we'll go to the ATI chart and actually see what would have happened, right? Like I said, this is super manual, but I love this. I absolutely love this kind of data. So let's go first to the ATI, shove this all the way to the left. Now, this is a buy signal and a red overlay. No, thank you. I'm only going to be looking for buy signals in green overlays. So like this one here was just outside of the green overlay, so I wouldn't have even looked at it on my screener. This one right here is a green signal in a green overlay, February 25th, 2021, February 25th, 2021. We'll go to the SPY. February 25th, 2021 had a buy signal on the SPY. Market breadth. February 25th, 2021 was bearish on market breadth. So I don't have to look any further. We'll go to the next one. This one, June 1st, 2021. May 26th means that June 1st, 2021 would be in a buy signal there. June 1st, 2021 was bullish on the market breadth. Then if we go to sector breadth, June 1st, 2021, it was bearish right there, right? So the sector breadth was bearish. All right, Tug asked this question. We'll divert attention for a moment. Why are order blocks in TrendSpider at different levels when you use different timing, such as 5, 10, 15, 30? Good question. So they're built on these candles, right? So if I look at ATI on these candles here, and then I go into the 5-minute chart, you'll see that they're built on different candles, right? So this candle right here at September 23rd, 12:25 p.m., an order block was created there. And you can see it bounced right out of that. And then 1:30 p.m., another order block was created, and it's coming down to that. Then we can zoom out here. You can see these order blocks being built, right? So it's the data of when the chart is looked at, right? Let me remove all annotations in ATI. It's the data as to when the chart was made. And so it may have been inside of the 5-minute chart. You'll see there on the different 5-minute candles. And you'll see it's actually built on like the top to bottom of a candle, right? So this candle right here is a really big candle, whereas this candle right here is a really small candle in comparison. And so they're built on the top to bottom of that candle in that time frame. Good question. let's go to the next buy signal on ATI here. February 8th, 2022. Let's go to the SPY. February 8th, 2022. But this is in a red overlay, so I'm not sure if the market's going to be trending right. Let's keep going. February 8th, 2022 is bullish there. February 8th, 2022 is bullish there. Okay, so now let's go to the SPY chart. Actually, I'll do this so I can bounce back and forth. Put my bull list there, aim list there. So we're going to go to February 8th, 2022. Which was definitely not bullish, right? February 8th, 2022. 10 under 20, price under the 50. So we'll go to the next one. Here we go. We got December 22nd, 2023. And the SPY was in a sell signal, so I wouldn't take that. Then we've got May 1st, 2024. And then May 1st, 2024 still had a sell signal on the SPY. So I wouldn't have taken any, right? Not any in the past. And so that's how it goes sometimes, right? We've got all the data here, but if it doesn't line up, and that's okay, I'm just not interested in trading it. But you totally could, right? Performance summary shows outlier with a 103%, capital efficiency of 1.06. So you're in half the time and still making 103%. That's not too shabby at all. So either way, that is my process of backtesting these, right? Look at the stock, look at the SPY, look at the market breadth, look at the sector breadth, then look at the SPY trend, and then finally, once all that lines up, look at the individual stock and move for that particular buy or sell signal. So it's a lot, but I can do this for hours and I love it. And you may not, but I do. I'm a junkie on this. So that's going to wrap it today. Thank you all so much for coming. I appreciate everyone coming to hang out with us here in the trading room every day. And real quick before we go, I want you to know how much we really appreciate you being an outlier, right? Thank you so much for being an outlier. We literally couldn't do this without you, and we want to pay you back every single day by helping you save time, make money, start winning, and with less risk. And don't forget, we will be raising the price of our annual plan next Monday. It's actually my dad's birthday. We're raising the price the day after that. So come October, prices go up. It's literally 82 cents a day. If you don't already have the annual plan, you should really get it. You're not going to see this at this price for a while. That's for dang sure. And don't forget, the first rule of Outlier is that you tell everybody about Outlier. And I know you're already subscribed, so go ahead and hit that like button for me. Thank you so much for coming. Wes says, this is such an awesome way of showing how your rules could have kept you out of trades that were more of just a coin toss. Exactly. I appreciate that, Wes, and I appreciate all of you for coming today. Have a fantastic afternoon. We'll be right back here tomorrow. Maybe we'll finally have some trades, but we won't know until we light it up. Take a look. Have a fantastic afternoon. Talk soon. So what better to do than to actually look at real trades, real money? How has Chris been doing this year? How have you been doing this year? Right? This is a team thing, right? It's cool because this is almost like coaching, right? It's almost like one-to-many coaching, because through this microphone, through that camera, I can reach you. And it's almost like you're looking over my shoulder at every single trade I'm putting on, why I'm getting in, why I'm getting out. And if you're following along, in the last few weeks, you would have been making money hand over fist, like I've been. And it's awesome, right? How did we get to this point? So what I want to do is cover a couple things. First, I want to cover my actual returns in this one here. And then this is the master key, only master key setups, which I'll discuss in a minute, and what these returns look like. 106%. My actual returns are 20% right now. So what do these mean? Let me do this. I'm going to pop this into a new screen. And let's look at the portfolios here. So this is every trade that I've put on this year. And if you wanted to follow along, you can just go back in the Discord, go to the 10-minute trading channel, and you can see every trade I have on here is on here. And it has the exact same date that I entered, the date that I exited, the strike, the credit and debit I paid for the trade, and the returns that I got for it, right? There is nothing to hide right here. Everything you'd want to know is right here in the Discord already. But we got it in a spreadsheet, makes it a little easier. So master key, the only difference between the left-hand side, between this side, and the right-hand side, the only difference between these two is if they were set up for master key. Now, what is master key? Sector breadth being in agreement with the SPY signal, being in agreement with the market breadth. Now, I have a formula right here that says if this, this, and this are all green, basically, give me a bullish setup. If any one of these are not, give me a not setup. Sector signal is one thing that does not make a difference here. So in fact, I'm going to hide that column. Sector signal would be like XLU showing a buy signal. That column here. All right, so all of these are going to be green. Now, this MTG, this YPF, this JEF, make that even bigger for you. 1, 2, 3 is 1, 2, 3. Okay. Are we following along? If you have any questions, I won't be able to see if you raise your hand, so go ahead and interrupt me in the chat. But these trades right here, where it's set up, are these trades right here. Okay, there is no difference, with the exception of anything that was not set up for master key, I've taken out. And I highlighted them orange right here, so it'd be easier to see as well. So let's jump into it. Let's do a couple. Let's do a couple up front. Like right here, right? Started off the year kind of weak. Started off the year with a 30% loss on one trade, 17% loss on the second trade, and 5% loss on the third trade. Didn't start out the year super strong. And in fact, if you want to check these out, you could just search in the Discord, HSY, not there, right there, HSY. And you'll see right there, that trade, January 3rd. Okay. Like everything is here. Start off the year week with HSY. We'll start with HSY. I just think that's more interesting than Hershey, than JCI. So that was January 3rd. On January 3rd, the sector breadth was bearish. The SPY had a sell signal. The market breadth was bearish. But we got a buy signal. Let's see if this is working right now. But we got a buy signal in OVTLYR. I know I typed that wrong. Hang on. Now, I don't want to say that this is a shortcoming of OVTLYR, but this is before we realized some really important data points. Data points being, oh, there we go. Data points being, like, if the sector is bearish, maybe it's not the time to get in. If the SPY signal, if the market signal has a sell signal, maybe it's not time to get in. If the market breadth is bearish, maybe it's not time to get in. Peter, it's time for you to get here. It's all good, my friend. So let's jump to this signal in January. And this may have been before because we had an upgrade, and a lot of you saw that upgrade earlier this year. We called it OVTLYR 2.0. The signals got a lot better, but no, this is exactly that. So January 3rd, you can see it didn't have a green background overlay, so that's a problem. Green background overlay meaning a bullish trend. Heat map was R15 and got a buy signal. So realistically speaking, this is pretty much a neutral trend. It looks like it was at 191.84 on that day, and the sell day, it was at 190.21. Okay. So not a whole lot happened in that time. And so it came out with a losing trade. Now let's go to the first master key setup. There probably were others, but I didn't know about it. I didn't trade it. If the signals were all red, why couldn't we buy puts? That's a good question. Let's take a look. Oh my goodness. That was January 3rd. Let's go look at that, Sebastian. That's a very, very pertinent question. Because January 3rd was right here. January 3rd, right here. Right. So you've got the 10 over the 20 still. It's kind of like today's price. Actually, it's closing under the 10, but still above the 20. Price is above the 50. I'm not buying puts there. Let's go to Hershey on that date. Now, I'm not going to do every single trade, right? We'll just pick some here and there. And you can see, like, it just wasn't going to work out. As soon as I got in, it had a real strong sell-off here. The 10 was over the 20. Price was over the 50. But it was like the moment I got in, it sold off. Michael said, it'd be great to see it directly in the scanner if the master key criteria are filled. It would be freaking sweet. I know. Here's a couple things. We do have some upgrades coming in the pipeline really soon. Mahesh is working on these upgrades. It's going to be so cool. So when we go into a certain stock, I don't know when it's going to be, but Mahesh wants the idea of taking like the breadth right here. This guy, maybe all of this. I'm not 100% sure. Probably just this guy right here. And dropping it right underneath. So you'll be able to track where the breadth is at on that stock. And I thought that was pretty freaking sweet, right? So staples would show right down here what the breadth would look like. So looking at this, right, it makes sense why it was a losing trade. We didn't have the green uptrend overlay. We did get a buy signal, right? But one part of the data is not everything. You need to have a full confluence of data points, right? We got a buy signal, but we didn't have a green overlay. We did not have, let's go to staples. Let's go to staples and, look at that. Here we go. Let's go to staples and full stocks. That's what I want to see on January 3rd. Go to 10. January 3rd, right down here. So this breadth right here actually could have been considered bullish right there. Could have been considered bullish on the, what's that at? There it is. Could have been considered bullish here on the sector breadth. But it's so deep that most likely when I was making this up, not making this up, but when I was pulling the data together, it's so deep down in here. I think it's down at 23% at that point. Let's go to the market breadth on January 3rd. Yeah, your market breadth on January 3rd was definitely bearish. You see that? So all that to say, this one was not set up. It makes total sense looking hindsight why it didn't work, right? I can see right now that the sector breadth, while it may have been technically slightly bullish, was still super depressed. SPY signal was in a sell signal. Market breadth was very bearish. And it was really not the right time to be buying calls, right? Really not the right time to be buying calls. So let's go look at one that we recently, I always like to look at losers. I feel like we learn more from losers than winners. Let's go look at WPM. This is one we just had this week, right? This is the first loss I've had in a month. Oh, this is cool too. So all of my results had only a 30% win rate, which is pretty terrible, especially when the average return was negative 875. That's not good. But when I add it in, when it's only set up with the master key, when it has the bullish setup, in fact, I could just call it master key right there. We've got all the data points lined up. 81.82% win rate. 12.5% average return. That's crazy talk. 81% win rate is crazy talk. But it's not made up. Like, you've been following me. You've literally followed me on all of this journey. So let's go to WPM, right? Of course, the sector breadth was bullish. The SPY signal was in a buy signal. The market breadth was bullish. I mean, we just did this like last week. So I know for sure that it was set up because we did it together. And we see a 30% loss. Max says, I love this stuff. Analyzing the losing trades is gold. Dude, yeah, for sure. You learn so much more by looking at your losers and saying, okay, where did I go wrong? Did I make a mistake? Right? I did make a mistake right here. I even noted it on FI, right? The heat map was already stalled on FI. I didn't see it until after I had made the trade. And then I was like, oh, I need to get out. I luckily pulled a nickel out of it. Just happened to be. Miraculous says, if you don't have the data to back it up, people probably wouldn't believe you. Dude, I know. And that's why I'm as transparent as the transparency. We talked about that the last couple of days. Everything is right here. Everything you see is right here. So you can go through and track everything that I'm doing. So let's take a look at, I'll take a look at WPM. Like this is one of those where it just didn't work out, right? WPM. You were there. Right? It's one of those where you put it on, everything looks hunky-dory, everything looks great, and then just the following day, the bottom falls out. It is what it is, and sometimes that happens, right? Now, this is a 2.75% loss on the stock right here. To me, that hit my portfolio by 3.91%. I did tell you that I have position sized up to 7%. Now, 7% is really aggressive. This column right here, the notional column, it's very interesting. So what this does is this takes your the number that you've got, right? The quantity, let's say if it's 22 or 200 or whatever, multiplies it by the cost of the option, and then it divides it by your total portfolio value, right? So you can see I actually put 13% of my account into this, right? So example numbers, if I had a $100,000 account, I would have put 13,500 into that one trade. Jorn, you and I had this discussion. So it's way bigger than a 5 or 7% position. It's actually a 13.5% position. Okay. But how much did it actually hurt? 3.91. So I still had 96% of my account. And this trade just didn't work out, unfortunately. It's one of the 20 or one of the 19% that have been losers. Max says it's a big dive. Maybe the AI signal missed something. Can it be checked? Jorn says, yep, I get it. I don't know what happened with WPM. Let's jump into WPM in the... And honestly, the signals in OVTLYR are a lot longer in duration. We'll check a look on the performance summary in just a moment after this loads in. Because there is a key to this. OVTLYR's return 19.97%. Average holding period 19 days. So realistically speaking, Max, give it 19 more days, and on average, it's actually been positive. I don't know what happened to it. It just is what it is, right? It went from G19, G20, G22, G24, G25. So the heat map's still going up. You can see the oscillator. This blue line right here is your friend. This is your best friend. This blue line is not a moving average. This is the price trajectory oscillator. When this is moving up, expect price to move up. When this is moving down, expect price to move down. Wes says, this master key set criteria is so great. Just stay out in times like now, where there's the entire market so sideways and choppy with wars happening, a close election on the horizon, etc. I'm just so glad that I can do this with you guys, right? Like this is why I was put on earth. I know it sounds weird, but I know for a fact the Lord Jesus looked down on me and on my mom, Susan Ewell, and she said, you're going to have a little baby boy named Chris, and he's going to be a trader one day. And when he's a trader one day, he's going to make so many people so much money, and it's going to be awesome. I call it the wealth ripple effect. You may have heard me say it before. The long timers will have known what that's about. But it's like, if I can help you make money, and maybe we make enough money for you to send your kid off to college, and your kid goes off to college and goes to medical school, and elsewise they wouldn't be able to go off to medical school. And then they go off to medical school, they go be a heart surgeon, and then one day I'm at the gym, I keel over with a heart attack. I'm like, oh my God, what's happening? They take me to the hospital, right? And little Wes Jr., who we sent to college because of trading, is the one who operates on my heart, saves my life, right? I fully believe in that. Like, give me all that good karma. That is why I'm here. I don't know why. I don't know what it's going to do, but I know that that's why I'm here. Wes says, lots of silver miners are down since the signal, while silver is up. Very interesting. Okay, so let's do a couple more. And then let's jump over to the master key here. Because the master key, these are the master key results, right? This has every trade except for the ones where the master key was not working. Except where the master key was not working, okay? Every trade. Let's go this route. Let's see. I mean, look at these results, right? I'm in shock. Like figuring this out, going back through all of 2024, I lost what year it is, going through all of 2024 and then seeing similar results in 2023 shows me I have 2 years worth of data that proves just how effective the outlier data is when you get all the pieces together, right? You've got not only the signal on the stock, the signal on the market breadth. What does breadth mean? What does breadth mean? Let's describe that. What does breadth even mean, right? That's how many stocks are having these buy signals, okay? How many stocks are having these buy signals? But if you think about it, the more stocks with buy signals means more people are buying, means the market's going up in price, right? It's a self-fulfilling prophecy. More buy signals, more people buying, the market's going up. And then the opposite's true when it comes down, right? More sell signals means more people are selling, means the market's going down, it means the market breadth is going down, it means the price is going down, right? It all works together. Generally says, Uncle Chris, or should I say, Brother Chris, you're the best. I appreciate that, my friend. Appreciate you guys. Okay. Let's take another look at a loser. Let's take another look at a not set up loser. What's the worst loser I had this year? This one. Synex. July 5th, right before we figured out the master key. Synex. July 5th. All right, let's take a look. Shit, I just moved it. Hang on. July 5th. That was my notes right there. Look at that. Now, we see right now that there is an order block, but at the time, and as you know, order blocks do not always show in the moment. It's sometimes they take a few days to develop, okay? So give me that grace. We didn't have an order block at that time. It's out of the way. So we had the 10 over the 20, price over the 50, right? All of that was looking good. Let's go to the SPY on July 5th. That was this candle. So the market trend was up. Synex, oh, I typed it wrong. CENX. I'm gonna say, wait, did it go away? Let's go to market breadth while that loads. July 5th was bullish. The market breadth was bullish. Synex is in the materials sector. July 5th was also bullish. What am I missing here? What was not set up? Oh, the SPY had a sell signal. See, Max, you remember we talked about that? You had asked one day why the reliance on SPY. That's the market, my dude. We want to let the market tell us where it's going. And on July 5th, that was the only thing not set up. The sector was bullish, the market was bullish, or the breadth of the sector and the breadth of the market. And then in addition to that, we got a signal on Synex for a buy, yet an overriding cloud, an overriding dark cloud hung over the market, right? You could make like a little short story out of this. An overriding dark cloud hung over the market. Lightning everywhere. Thunder clapping off in the distance. The thunder rolls and the lightning strikes. Another love grows cold on a sleepless night. As this is taking too long. Indeed. Oh, that's a cool emoji. All right, we gotta let this load. There we go. Okay. Let's zoom into July 5th. Okay. May 30th, we got the sell signal. And it ran all the way through June. And then July 5th still had a sell signal. Only until July 11th was it till we got a buy signal. So that one detail right there set me out for the worst trade of the year. Right, so that hit my account by 4.10%. 43% loss in the trade. But you would think, hey, look, all is looking good. But all of the data wasn't in alignment. That's really, really cool. Mahesh, number of stocks in an uptrend going up and going down, and downtrend was going up for that sector. Ooh. So this is, look up here in this section right here. When I go through, you'll notice we have on the very far right, if I move my mouse, it goes away. If you look right up there, it says date, May 7th, XLB, price, all that stuff. Look all the way at the far right, and you'll see a +3 and a -3. What that means is how many stocks were going with uptrends versus downtrends on that day. So if we go to July 3rd, there were 11 stocks in an uptrend and 56 stocks in a downtrend just in that sector, which is pretty crazy. So that's something Mahesh says that he looks at as well. Yeah, I mean, you can see just how many stocks right here had that downtrend. And then let's look at the best trade of the year. That's what I want to see. We looked at the worst. Let's look at the best. Could be that one. Well, duh, Chris, you got filters right there. Best trade of the year was JCI in May 13th. Coincidentally, not knowing about the master key at that time, because we didn't know about it until July, when I was doing lots of backtesting, and Leo made the suggestion of, why don't you look at the sector breadth? Leo came through so clutch with that. Leo, I will give you credit till the day I die, because you planted that seed for me. All right, so JCI coincidentally was set up on the master key, which if we go to the master key portfolio here, you'll see JCI was the 5th one for the whole year, which is pretty bad. The 5th one for the whole year that had the master key set up. Take a look at JCI in the industrial sector. That was a 55% gain for me and a 5.63% portfolio impact. So let's go look to JCI on, I forgot the date, May 13th. In the industrial sector. Oh, we'll keep the SPY up. We'll need that. Okay, JCI, May 13th, right? May 13th. here. Now, you can see why it was a good trade. That was a really good one. But let's not get ahead of ourselves, right? Because we don't know what's going to happen on the right-hand side of the chart. We can only see the left-hand side of the chart. We don't know what's going to happen on the right-hand side. So we've got our 10/20, price over the 50, May 13th. So that looks brilliant. Let's go to Synex. Not Synex, clearly not Synex. SPY, May 13th. Here, May 13th. So that looks good. 10, 20, 50. Go back to JCI. That was right here. So it was 1 day into the green uptrend overlay. 1 day into there. Heat map was at G0. Market breadth on May 13th. Okay, this is something that I wanted to discuss as well. I'm glad this happened. So this is one of my rules. If it goes over 75, only enter if breadth is still moving up on that day. So some people would take a look at this and say, oh, that's a whole lot. I'm not sure about on that breadth. But on May 13th, so let's see, May 10th, you can see up here where it says bull list percent. It went from 76.88, 77.41 on May 13th. So it was still going up. 77.51 on the 14th, 77.83 on the 15th, 78.73 on the 16th, and then only on the 17th did the breadth start coming down. So once it gets up here, I'm okay as long as it's moving up specifically on that date. Once it stops going up on that date, cut it. So that was good. Let's go to the breadth for JCI, which is industrials on May 13th. So best trade of the year and market breadth was like super high. Okay. That's what I want you to keep in mind. May 13th here, it was at 75.17. So it went, let's just count the days before, 69.93, 73.08, and then 75.17. So breadth was moving up strong, continued to move up strong. So I don't want you to get shied away when breadth is really high, because it can still result in great trades, like specifically the best trade of the year for me, 55% return on this. And then you can see just rocket shipped off that. What date did we get out? 5/13. Well, clearly that date was wrong. Hang on. Let's look in the Discord, because I have everything here in the Discord. Oh, Sebastian made some good money on JCI. Goran was talking about JCI the 17th. Right? Close JCI calls on the 17th. Right there. 57.86% win, 5.63% portfolio impact. Heat map hit the target of G13. Let me update my notes while I'm here. So this is what I'm so excited about. Now that we know the master key, how crazy the returns have been, how awesome this is, like how blessed I feel to be a part of this, and blessed that I feel that I can share this with you, right? Since knowing the master key, not a single losing month in real money, and then, you know, master key results only for the whole year, not a single losing month. That is so rare. But also part of OVTLYR. I'm crazy stoked. Sebastian said he missed the chat on that one, and he got another day in JCI, made even more money. So that was what I wanted to do today. I wanted to go through my portfolio, show you just how awesome things have gone since figuring out the master key, where we put all the OVTLYR data together, not just a buy signal, not just a sell signal, but holistically speaking, what does all this data tell us and what can we learn from it? We can learn that there are crazy, crazy, crazy win rates, crazy high win rates, crazy returns with this. And this is 2 years of data that I've got so far. So it's not a one-off. So man, am I stoked. Am I so stoked. Right. So I want to say personally, thank you so much for being an outlier. We literally could not do this without you. And we want to pay you back every single day by helping you save time, make money, start winning with less risk together as a team. Don't forget, you can get 45% off your annual plan. It makes it only 90 cents a day. If you haven't already got the annual plan, you really need to do so. Let us know if you need anything from us at all in the Discord. And the first rule of Outlier, as you know, is you tell everyone about Outlier. And go ahead and hit the like button to tell YouTube to tell everybody about Outlier too. Thank you so much for coming today. I will see you tomorrow. Don't forget, I'll be giving out a $10 Amazon gift card. All you got to do is drop your personal stories in the Share Your Big Win section, and you might just be lucky. Have a fantastic afternoon. Talk soon. I was really spending some time working on the portfolio data because I love me some data. And I found some really cool stuff. So these are all the trades. You know, we talked about this on Friday, like the year-to-date returns. So these are all the trades that I've put on this year, and you've put on this year if you've been following me, that have had the master key set up. Everything right here has the master key set up. 81 and almost 82% win rate. Absolutely unbelievable returns. Not a single losing month when everything is set up with the master key. And, you know, I talked last week about position sizing, and Mark and I went back several times on Friday and over the weekend. And Mark was basically like, Chris, where you're at right now, that 7% is pretty much where you need to be. Don't go any higher than that. He's like, the main reason here is because you're really limiting your opportunities, right? If you're going bigger, then you may only have 1, 2, 3, 4 potential trades on at a time. And you're really setting a lot of importance on those trades and not taking opportunities that could be coming your way. So he's like, listen, where you're at right now, that's as high as you really need to go. So I'm going to stick at 7%. Hey, Peter, good to see you. But there's some really, really, really good information to glean on this. So I wanted to go through this. So I went through all of the trades that were set up for the master key, and I added in the close reason, which you can follow along. Every single thing in here is right here in the 10-minute trading Discord channel here. I went through and I found all the heat map opens and all the heat map closes. And I was just looking at it, right? What exactly happened to these stocks? So there's not really all that many things, right? Only 9 different things have happened so far. A close below a half ATR is basically, you know what? It just didn't work out. It's a loss. 3 out of 4 were losers there. WPM is a perfect example, right? This is the one where we got in just a couple of weeks ago. It immediately sold off and it's gone down ever since then. Honestly, it wasn't a great pick. And occasionally that does happen. But then there's these close below half ATR from the rolls. Now, if you remember, these are the ones where they were doing great. Awesome. We rolled them up and then the stock pulled back. So let's take a couple looks at these, like AEM. I have to go back to here. Right. So we got in on July 10th. July 10th, got out on July 18th. July 18th right here. You can see I left my notes on here, so I didn't change any of this. So this is where we got in. The next day, it looks like we rolled it up. And then it went up. Looks like, yeah, that's right. I couldn't roll it a second time because there wasn't liquidity there. I do remember that. And then it closed at the half ATR after our second rolling point. Like I say, I didn't get to roll it up because of liquidity, but that's where it would have been. So it closed right there. And as you can see, that was honestly a really good move because for the next, I don't know how many days that was. For the next 3 weeks, it traded sideways to down. Only after that point did it start with another big move. So we got out of that as much as we possibly could have. BAC was one I was actually really stoked to talk about. So if you remember BAC, I put this one on and I didn't know earnings were coming. I legit was not intending to trade earnings, 0%. But I believe it was Leo mentioned, hey, there's earnings. And I was like, wait, what? Totally missed that. We got ultra lucky. The trading gods smiled down upon us. But one thing I noticed here when I was looking at it today was I was like, wait a minute, there's an order block right there. But I didn't get out until the 18th. Why did that happen? And I was like, huh, wait, didn't we just add the second order blocks, right? I've always had the 50 order blocks, but we recently were looking at this on the live stream together and looked at it and we're like, oh, wait a minute, the 28s actually have some legs to it. So now I have both the 50s and the 28 order blocks. Look at that. That 28 order block would have actually allowed me to get into this and day trade out of it because these are my rules. If a stock has an order block in that direction of the trend and moves into the order block, so imagine we're in here, that day of earnings, you know, we're along for the ride, let's go for it, goes up into this order block here, we could have traded out of it if there were a 5-minute crossover. So closing at the end of the day, which still that would have been higher than where I got out. So I got out here versus here, right? That would have been 5.65% gain versus a 2.82% gain. So twice as much gain, honestly. So if the 5 period and 10 period don't cross on the 5-minute chart, just hold it and then close it at the end of the day. If they do cross, like this one shows here, that's the exit point. Most likely they would have crossed. I mean, you can see the tip of it, the wick of it right there. But still, that was cool. That was worth the time just on that one trade to see, oh, you know what? Adding that 28 order block really was worth doing. Let's look at NEM. This one here. What did I say was going on here? Close below half ATR from roll in July. I don't have my notes on this one. I must have deleted it at one point. But it looks like we got in, it went up 1 ATR, and then we closed it right as it came down. But also, that was a great time because it went sideways for another month or so before it took off again. So it's all about timing on this, right? And it's really cool. Let's go to another reason for exiting. Because one of these, I was like, holy moly, that was so good. Heat map stall, I think. Let's look at Jeff, J-E-F. All right, so this one here, we got out for a heat map stall, got in on May 8th, out on May 10th, just a couple days later. And, you know, didn't hit the top on this one, but still got a nice little gain out of it. The next one, CLS. When was this one? July 15th. Oh, yeah. This is the one I wanted to show you. Look at this. Look at this. Got in July 15th, got out July 16th. You can find it in the Discord. Like it legit happened. Got in on the 15th, got out on the 16th of July. It started at G31. The next day was G31. In fact, let's go to that real quick. This one right here. Got in on G31. The next day was also G31. So that's my rule, is to get out when the heat map stalls. Okay. Look at this. We caught the top. We caught the top. We caught the actual top. And then it went down after that point. So I was so stoked to see the heat map stall right there and why that proved out, right? The heat map measures how fearful and greedy people are. When it, you know, look, it's one of the things we talk about, right? It measures how fearful and irrational people are and by how much, right? If we've determined that they are G31 greedy, and tomorrow they're still G31 greedy, they're not getting greedier. That's what I want to see. I always want to see, if I'm long a stock, people getting more greedy on the stock. Isn't that cool? Man, that makes me so happy. Let's go to the next one. FI. Now we traded FI twice recently. We traded into FI and I immediately got back out because the heat map was actually stalled on the day that I got in. And you know what? That one actually took off, right? That would have been one. Had I kept it on, it would have been great. But then again, I had to follow my rules. It is what it is. But I did make some money earlier in the year on that. On August 20th, went from G32 to G36. Here, and just like a easy breezy trade. These are the kind of trades that I just love making, where you put it on, you don't have to do anything, you make money, you take it off, right? You hit a target, your heat map stalls, and you just get out. Let's go to Regions Financial. This was a losing trade. And this one here has so many order blocks on it. And it makes me wonder, did I miss that at the time? Because it's unlikely I would have traded into an order block that's it's 40 cents off. So I'm not sure. This was on the 50 order block. If I take out the 28, you can see it really was. Click the wrong button there. It was the 50 order block, so I would have seen that. I just don't know why I took that trade. To be very honest, I don't know why I took that trade. It was a small loser. Only 1% loser. G20, I'm sorry, August 26th, August 28th. So I got in on August 28th, got out, or August 26th, got out on August 28th. I mean, it was like 10 cents, 15 cents off from where I got in. And like I say, just a teensy-weensy loser. In theory, if the heat map hadn't have stalled, I could have traded up into that order block again, like we talked about on Bank of America, and got out of it. But that's okay. And let's do DD. And listen, I hope this is interesting to you. I hope this is useful to you. I don't want it to be boring, but reviewing your portfolio is one of those important things to do. Okay. Looking at what you did, why you did it make sense? Could you have learned from it? Is incredibly important. And what better time to do that when you don't have any trades on, right? When you have time to spare, when you have nothing in the market to cloud your judgment, to just sit there and objectively look, does this make sense? Should I have changed up my rule some? Was there a different thing I should have looked at? Or maybe, one thing or another that we could learn from it for the next time we trade. So this is what pro traders do. That's why I'm doing it with you. Okay. So got in August 28th, got out immediately August 29th, was R4, and again R4 the next day on double D. And we almost nailed the top of that move too in just one single day. And then it came down, and then a bigger move came through a little bit more recently. Oh, hey, Tug. Tug says, very valuable information. Continues to validate the strategy. Yeah, thanks, dude. So yeah, I love seeing this right here, where we almost nail, and occasionally we do nail the exact top before a little sell-off, before a bigger move happens. Like, that is super cool to me. So very, very stoked about that. All right, so let's move on. We've done heat map stall, close below the other things. Heat map target hit. This is the one where we actually make a bit more money, right? Average returns on these are huge. Average is 27% returns. Average. Except for the one loser. That makes it 24% returns on average. The first one was a loser on IFF. So let's go there. You can see my notes. I left my notes on there. I remember this one. So it had a big move post earnings, right? You can see the move down here leading into earnings, which is why I like to trade into earnings. I do. I really do, because you can have some really solid moves right up into earnings. So it was around 85, hit 88 on the day of earnings, and then rocketed up to 97. So it had basically a $10 move almost right there in those 3 days. And then it went sideways, and then it went sideways, popped up a minute, and then it went sideways for a while. Like, look at this. It went sideways for months, like legit months. Didn't really break out of that range until August, and we put on that trade in May, early May. So what happened with IFF? Heat map target was hit. Got in at G17. It went up to G27 during that time, but nothing really happened on the price. I mean, we're a couple days off from seeing a little bit of a move, but overall, you know, just take the loss and move on. It was only a 4% loss. Who cares? JCI, this was my biggest trade of the year. I talked about this one on Friday. I mean, it was my biggest trade of the year, and I didn't even hit the top. Didn't even get close to the top. Biggest trade of the year, and it still had more than twice the move that I left off, unfortunately. So JCI, let's take a look at that one. It went from G2 to G13, right? That's, where's that at? That was my exit criteria. G2 fits right in here for a 10-point spread. So from G2 to G13, so it skipped over G12. It was in May, right there. That was that trade right there. Now, I was looking at this earlier, and I did make a note to myself that, you know what? I actually, oh, where's my note? There it is. I was looking at this, and I was like, should we maybe amend instead of G13 to G15? And then I wrote on there, actually, I put it on a Monday, but the signal came on Friday. The signal came the day before. So all I had to do was just enter on the day the signal came, and I would have made more money. What do I mean by that? The signal came on this candle, on this Friday. And so that Monday, I came in. I'm sure we could go watch the video together. That Monday, I came in and said, hey, you know what? Let's take a look at today's picks. And we don't see all that much. Let's include Friday's picks too. Would have made a couple extra bucks off that, right? Not a whole lot, but a little bit. 5.2% winner versus a 4.5% winner. So I could have made a little bit more out of that. So moral of the story is just take the trades on the day that they come, basically. Take the signals on the day that they come is what it told me. And then it got up. The highest point was on May 24th, which was G29. So basically holding it from G0 to G29, which is very unlikely. Like it doesn't always move a 30-point swing like that. So just something that I thought was interesting. Let's go to the next one, NRG. Now, we traded NRG twice this year and have made good money on NRG. In fact, I believe, look at my dollars earned. CIEN, CIEN is the most I've made this year on, and NRG is the second most I've made this year on. I ain't mad about that. Ain't mad about that. Let's take a look at NRG. That's Alex's old company, right, Alex? NRG. Now let's take a look at both of these times we traded it. First time we traded it, May 14th. Got out on May 16th. And we only gave it a 5-point spread because it started at G27. Started at G27, so I only gave it a 5-point spread on the heat map. So it didn't do all that much. Got a little bit, 85 cents out of it. That was a decent move. What was my return on that one? A 12% return on a 1% stock return. Dude, that's why we trade options. Okay, that's why we do it. But the second time we traded it recently on September 25th was a much better story. And look at it continue to go. Continue to go. These outlier picks are awesome. Got in on the 25th. When it's G14, got out on October 1st at G24. One of those really easy moves. And a 29% gain on that. Thank you very much. Easy. Go to Walmart. Again, look at that. They don't all happen this way. Boy, do I wish they do. Where you put on a trade, every day is a green candle till you get your target, and then you're out, right? Oh man, if every trade I put on was like that, I would have no gray hairs for the rest of my life. But Walmart had this huge move after earnings. Look at this. It went from around 68 to $74. 6% move by the end of the day, 8% move at the highs. Just a huge move. And then we got the buy signal, right? So don't be scared of these gap ups, okay? Don't be scared, because in trend following, right? If it's above the trend, let it be above the trend and go as far as it can. You just don't have to be scared of those big gaps. You can see right there, that was that big gap I'm talking about. And then we got the buy signal 2 days later on August 19th, right here. So took that trade and watched it just stair step its way up. And then you can see it actually continued on. And this high right here came on September 16th. So it went from G13 on the heat map to G42, which is so deep in the greed before it finally got that sell signal a couple days later. So pretty cool. Let's go to the next one here. Let's go to XLF. Now, ETFs generally don't move all that much. ETFs are more boring, right? ETFs are what you want to do when you're not so interested in a particular name, but you want to get exposure to the sector. XLF is the financial sector. So you're talking about like Bank of America, Wells Fargo, all the big name banks, JP Morgan Chase, all those, they fall into the XLF sector. So if you're not keen on trading a certain name or a certain stock, right, you can trade the whole sector by trading XLF. And because of that, it's more boring. It's way more boring. And generally the moves are a lot less dramatic, right? The moves are not as pronounced. However, XLF was a pretty dang good move right there, right? Almost all green candles all the way. We had one red candle there, but it was still up on the day. Got in when XLF was at G7. It went up to G17, so a 10-point swing on that. And the heat map target was hit. Went up for a couple days, and then it's gone sideways ever since then. Sideways. So we caught 80% of that move up right there. So very, very good. Let's switch gears a little bit. Heat map target hit and change to talk about heat map stall. Let's do market sell-off. You're gonna like this. Holy moly. Mahesh has even completely changed his trading style, specifically around my market sell-off criteria. Hang on a second. So my market sell-off criteria, I didn't come up with it. It came from Steve Burns. Where's that? Here. No, here. Yeah, here. If it closes under the 20 EMA, wait to put on new trades until it closes above the 10 EMA again. Talk about the SPY. When the SPY closes under the black line, wait until it closes above the green line to even consider, above the blue line to even consider putting on new trades, right? So I marked a couple times on here when we have been following that, right? So July 18th, it was right below there. We got out that day. But by the end of the day, it had closed slightly above. But then you saw that big sell-off happen, and we were in cash. Thank you very much. Got back into trading here when everything else lined back up. Traded for about 2 weeks. The market was sideways, but we made money. Closed under the 20. Back to cash. Didn't do anything. So here, it was only 7 trading days. I don't know if you picked that up. 7 trading days. Yet we made money. And then, right now, back to cash for me. Now, I didn't close under the 20 this time. But I want to show you some of these results because they're awesome. So AFL got in July 15th. July 15th. Here. And then got out. It looks like we rolled. If we didn't roll, I set a new half ATR from where we should have rolled at right there. Yet there was a market sell-off on July 18th. What was that? Actually, give me 2 seconds here. I'm going to pop a second window open. And that should allow me to do this. Yes, okay. July 18th. Was this candle here. I was just talking about a minute ago, right? We closed everything because it right around the time of trading room, it had been below the 20 EMA, but it closed slightly above at the end of the day. But on that date, we closed a whole buttload. We closed more than that. Well, that's all I got on that one. But on September 3rd, which we'll look at in just a moment, we did that too. So we managed to take the profits out of that right there as it actually continued on up. And oh my gosh, look at this move. Look at that outlier move. Oh my gosh, look at that outlier move right there. Look at that outlier move right there. That is a crazy move. Got your buy signal July 15th. And then where was the actual sell signal? I want to know that. July 18th. The sell signal came all the way to September 4th. So like literally the top candle was the sell signal in Outlier. Oh my gosh, that's so funny. Look at that move. Is that not the coolest thing? Does that not make you excited about being an outlier? Right there. Yeah, that is sick. Okay. So anyway, we caught a couple bucks out of that, got out on the market sell-off. Let's go to the next one here. INSI. Remember when we had INSI and INFI at the same time? That was annoying. INSI. Apparently I said on alert. Oh, that's right. That day, if you remember, it was on a tear. And early that morning, I even went in the Discord. I'll find it real quick. For those following the INSI trade, we might need to day trade out of it. Looks like it might hit an order block. Look, it was moving up hard and fast, and that's where that order block bottom was, right there. So that's where that expired alert's from. But we managed to take a good few dollars out of it. And then on September 3rd, here, got out of it. And look at this. Got out of it on September 3rd, and then it sold off freaking hard, right? We took our money. We made, let's round it to 7% on that trade. And then goodbye. Down 7% on the stock. That's a brutal move. Down a $5 move on the stock. But we caught the high candle before that sell-off. How did we do that? By following the market sell-off rule, right? By following the market sell-off rule, we managed to keep a nice winner and avoid a huge loser. Isn't that cool? That's why my hash was like, whoa, Chris is onto something here. I know. Let's go to INFI. Now, we didn't make money on INFI, but that's okay. This one went sideways during that time. And then again, same reason of getting out. But then again, I mean, it was a 5% loss on the trade, whereas it literally went sideways and has been going sideways since that point. So that was a smart move on that. US Bank, USB. Look at this. Caught the rocket ship, but unfortunately didn't catch the top candle. Got the one out. I got out after that one, right? Rolled up, closed below the half ATR from the roll, and then all hell broke loose. Look at that. Look at that sell off there. So after we got out, it went down another 5.5%, 6%. So we took our gains. The market sell off happened. Got out on that day. I was gone. Now I believe when I was looking at this, I made a note. I guess I didn't. Okay, I thought I did. Because I was thinking, how could I have gotten out on this candle versus that candle? So let's take a look at that together. Got in on the 28th, which is this candle. G10, 11, 14, 16. That was the candle we got out on. So it only went up by 4, which clearly I didn't want to limit it there. I just don't think that there was any, I don't think that we could have had a better exit, right? Yeah, of course, I'd like to say, because we have on others, that I call the top candle, but unfortunately it was the day after the top candle. But still, was pretty dang sweet. Let's go change reasons here. Trading error, that was FI. We talked about that one. This one, we'll end on this one. Market and sector breadth sell-off on TMUS, which I still feel was like the absolute right move to make. TMUS has gone up a little bit. It's, what is it right now? 20 cents off where we got in. So We got really, really close to the highs. I'm not sure what's going to do next. Definitely is trending higher. But the market breadth and the sector breadth both turn negative. And because of that, I did add that as a rule here recently. So if we're in a trade and that sector turns negative, as well as the market turns negative on the sector, we're losing steam here, right? We're losing. Imagine like a cheerleading pyramid, okay? Imagine your stock is at the top of the cheerleading pyramid. On the bottom, you got all the bases, all the big girls and all the guys, right? And they're holding everybody up, okay? And that's your market. Well, then a couple of people just bounce. They're like, you know what? I need to go get a hot dog. I'm thirsty. I need a Coke. And so your base of 10 now just turned into a base of like 6, okay? That's the market selling off. That's the market selling off on this. That's your market starting to turn south. So your base just went from 10 people to 6 people. Now your second level, right? These are the girls that are strong enough to hold up the lightest ones, but not too heavy for the whole standard, right? So that would be like your sector, which this was the communications. And that was on this date here, September 27th. Prove me wrong. I was wrong. October 2nd. This is date here. Sorry. This date here. I thought we were crossing down. So those girls, those are, your base went from 10 girls to 6 girls and guys. And then your middle level, right? The 4 that left took 3 with them. Okay. So now your bottom base is 60% of what it was. Your middle base is 40% of what it was. And you've got a whole lot less people holding on to the one girl on top. That's very fragile up there. Okay. Super fragile, as you would like to say in the Christmas story. It's a very, very, what does he call it? Major award. It is a major award to have a leg lamp. It is a major award to stand on top of there and beat the trade. And if the market's falling, if the sector's falling, you're losing the strength underneath holding that up. So to me, that is a new exit signal. So that I did add onto here. So we covered quite a lot, right? Are there any trades that you want to take a look at that we put on this year that we could dissect maybe? Winner or loser, I'm here for you, always here for you. I want to make sure that every trade you trade with us has a positive outcome, whether it be we make money or whether it be we found something that can improve upon it for the next time, right? Not every trade is going to be a winner, as you've seen, but a lot of them can be by following the strategy. So let me know in the comments. If not today, maybe tomorrow, because I don't think we'll be trading the rest of this week. In fact, Wednesday, I have a personal issue. I'm going to be out, so there won't be a trading room on Wednesday. But these are what the things you need to do during downtimes, right? When you're not trading, how can I improve my trading? Where can I improve? What did I see that I could have improved upon? I added a new rule, right? We saw something on the indicator on BAC that we hadn't seen before. So these are the type of things, this is the time to make yourself better, study up, and be ready for the next time we get busy, right? Because like, as you've seen, the times we're busy, it can be really small. The last time we were busy was 7 days, 7 trading days. From here to here, 6 trading days. 1, 2, 3, 4, 5, 6, 7. Wait, 1, 2, 3, 4, 5, 6, 7. Either I can't count or TrendSpider can't count. One of us can't count because this says 6 bars. I'm going to say they can't. It's probably this bar plus 6. Either way. So 7 trading days there. 10, let's call it 11 trading days there. And I didn't have market right there. So we go hard, we go fast, right? And in that time where we had 11 trading days, August 19th to September 3rd, look at my real money portfolio real quick. Go to my real money portfolio. August 19th to September 3rd. That was where I went from basically flat on the year to up 12%. Basically flat on the year to up 12%. And the next time I traded, I went from up 12% to up 20%. 12% to up 20%. So there's nothing wrong when sitting and waiting when you can reliably put up big numbers, right? When you can see how this works. So again, I hope this wasn't too boring, but then again, these are the type of things you need to do in the off season. It's currently an off season. Don't push anything. Don't go against anything. Just continue to follow your plans. Okay. And thanks so much for being an outlier. We couldn't do this without you. And we want to pay you back every single day by helping you save time, make money, start winning with less risk together as a team. Now, don't forget, you can get the annual plan for just $3.29. That's only 90 cents a day. Highly would encourage you to do that if you don't already have it. And let us know if you need anything in the Discord, because as you know, the first rule of Outlier is to tell everybody about Outlier and to hit the like button. That way, YouTube tells everybody about Outlier too, and it's free. Thanks very much for being an outlier. Thanks so much for coming to today's trading room. See you right back here tomorrow. Talk soon. Let's go to the options chain and let's talk about why I personally like to go this route versus buying out of the money options. But before I do that, I need to log into Tasty Trade, Tasty Works, whatever the hell it's called these days. Give me a moment here. You might see me with the new broker at some point. I'm just saying, I'm not giving any details away, but you just might. You just might. We'll see. Now, there's no reason that you have to use this one. I've just used them since the day they were opened. And I know many of their leadership people personally. But that doesn't mean you have to use them as well. So let's go to, who is this? A-Rock. A-Rock. So for me personally, I start with the option chains right here, right? So you got a 10-day, a 38-day, 73, 136, 220, and 437. I like only the monthlies. You can add in the weeklies. Let's do something with weeklies. Let's go like Apple. So you can add in weeklies. I personally just like to stick with the monthlies, and you can see that it makes a lot less choices. But it also gives you more liquidity in those stocks or in those expirations, right? So every one of these will expire. Now, I'll go into a little bit of detail on that. Like I say, if you don't understand what options are, go check out that video. But every option has a finite term, right? And this is really important in the way that all of us trade, because the best example I can give is when I blew up my account in the 2016 election. I've told this story several times recently, but I'll do it again. That was on a Tuesday night, of course. The market was lock limit down that night. I'd never seen it lock limit down before, so I was super interested. This particular trade that I had put on was called a call ratio back spread, where it would make a little bit of money if stocks went down, but it'd make way more money if stocks went up. So I went to bed thinking, cool, I'll make some money, no big deal. The next morning, stocks went up and didn't go down basically for the entire Trump term. And I actually managed to lose a buttload of money. Like, I remember watching my account just evaporating by the minute and thinking, why? I was right. Why am I losing money? That's because I didn't understand the expiration cycles here, right? I put the trade on Tuesday. The trade expired on Friday. It hadn't moved as much as I needed to by Friday. So why would you want to limit yourself, right? Why do you want to cap yourself? Why do you want to say, oh, you know what? I'm gonna give it 3 days. If it didn't work out in 3 days, whatever, I don't care, right? No, you don't want to be the Wall Street bets type people, right? Where it's Lambos or food stamps. No. You want to be smart about this, okay? This is your money. You don't actually want to lose it like those fools do on those message boards, right? So I personally like to go 21 days is where I start. Now, this is a great example because I don't have a 21 day here, right? I just don't. 21 days is generally the amount of time that I'm in a trade at a max. In fact, if you look over here in the performance summary, it'll tell you the average holding period on this is only 13 days. Only 13 days. So you don't want to put anything that's too tight, but you also don't want to go anything too long where you're paying for more extrinsic value than you have to. So that's why I say generally I start at 21 days. Now I don't have that here, and I'm not going to go 10 days. So I would stick with this one right here, the November 15th. And if I open this, I don't know how much liquidity there will be here. This will be a surprise for me. So not a whole lot. Let's break this down. So you understand why we look for 21 days, right? We want to be able to let the trade work without being cut off, right? You can always roll it out, but that's extra steps. It's more to do. Rather just put it on the right place to begin with. But you don't want to buy it too far out in the future because then you're paying a lot more in extrinsic value, which we'll cover in a little bit. I want to have at least 250 on the open interest. I heard somebody say one time that you want to have open interest to be at least 4 times as big as your trades, right? And so at the time when I found that, I was like, 250 divided by 4. So I could buy 60 contracts and be fine. So that's just been my rule, right? I don't always necessarily find something with 250. Sometimes it's 200. Sometimes it's more, right? Sometimes it's in the many thousands. But 250 is where I start with. And that can comfortably buy you 60 contracts without having really any issues. And so here, when I look at this, I always want to make sure that my option chain has the following: delta, open interest, extrinsic, your bid, which is when you're selling it, and your ask, which is you're buying it, right? This is the bid-ask spread. We'll talk about that more in a minute. So here, looking at open interest, I have 1. I'm in the calls. Like you could look at the same on the puts if you're going short. So I'm not doing 1, not zeros, not 24, not 54. This one's okay at 295, but it's out of the money. Now, and out of the money at 295 is not how I trade. You might, but I don't. Why would I not do that? Because I want to pay less than 20% or less in extrinsic value. What is extrinsic value? An option is comprised of 2 parts of value. One of them is intrinsic. One of them is extrinsic. Intrinsic is how much moneyness it has, right? So I'm looking around my desk to see what I can use as an example. Use this. This is my Discover card. That is in the shape of a Texas flag, right? No surprise there. So imagine that this is the total cost of your option. Imagine this is $1, right? Now, 2/3 of the option is, the bars here, and you could call that the intrinsic value. So that is how much it's in the money. Okay. Then you've got this much here. This is the extrinsic value. This is the time value, and this will go to 0. Imagine the blue part of the card here shrinking and shrinking and shrinking until at some point it goes away. All option contracts have extrinsic value. All extrinsic value goes to 0 at expiration. Let me repeat that. All options have extrinsic value. All extrinsic value goes to 0. Okay? Now, if all extrinsic goes to 0, why in the world would you want to buy it? How much extrinsic value do you want to buy if you know it goes to 0? This dude, these 10 fingers pointing at this guy will tell you, I want to pay as little extrinsic value as possible. The further out in time you go, the more extrinsic value there will be on the same option contract. So let's look at the 22.5. Let's look at extrinsic value here. So midpoint is 62. Coincidentally, exactly the same as your extrinsic value. That's because it has no moneyness. It has 0 moneyness. If the option expired this very moment, this option is worth nothing. Picking up a penny off the ground is worth more than this option is. It will be absolutely worthless. And it's because it's out of the money. Now, conversely, let's find something with more liquidity. Let's go to Ford Motor Company. I don't know. right? So you've got thousands on your open interest here. That's a big difference, right? So let's look at these, right? So this one here is 35 cents is the extrinsic value. 35 cents is mid price. So this is out of the money. It's currently at $10.51. So this 11 strike option will be worth absolutely nothing once it expires. Now, if we go up just to the 10, right? We move up to the 10. This one, the current price is 85 cents, but the extrinsic value is 34 cents. The difference in these two is how much in the moneyness it has, how much moneyness it has. So let's just use round numbers here. 85 cents, okay? 85 cents is the price of the option. It has 35 cents of extrinsic value. It's currently trading at 10.50, give or take. So you take the current price, so let's say 10.50 minus the strike here, $10. That's how much moneyness it has. So it has 50 cents of moneyness. That's your intrinsic value. But it's not priced at 50 cents, is it? It's priced at 85 cents. The additional 30 cents is everything else built into it. That's your Vega, that is the volatility pricing, and most of it is the time pricing, your theta. Now, the deal is that, as I said, all extrinsic value goes to zero on every stock, period, at expiration. Some people will tell you the best trading, and I subscribe to this for a long time, but it's just not true. The best trading is when you sell that option because, hey, it's going to go to zero. And so if I sell it, I'm going to collect the 12 cents and it's going to go to zero. I'm here to tell you, please don't ever do that. Just look to buy it. Okay, look to buy it, but pay as little as you can on the extrinsic value. How do we do that? You just move up the chain. Just move up the chain, right? So this is 35 cents. This is 18 cents. This is 1. Okay, let's go to something else. Let's go to Tesla. All right, we went from Ford over to Tesla. You can see the extrinsic value on these is huge, right? So here is 100% extrinsic value. If it expired right now, the 250 strike is worth nothing. The best example I can give you is literally the change I have on my table right here. I just found an American penny made in 2024, in fact. This brand new shiny penny is worth more than the 250 strike option if it were to expire right now at 244.96. And then we talked about how to calculate the extrinsic value. So we'll do that one more time as an example. We'll go to the 200 strike. $50. That is so expensive. So let's say mid price, or we're going to have to lock it down. Let's just say mid price is $50. $50. So 200 minus 50. I'm sorry, no. Current price, 244, whatever. Let's just run it 245. 245 minus the strike, 200, equals $45. So it has roughly $45 of moneyness to it, but it's not priced at $45. It's priced at $50. So the additional $5 there is the extrinsic value. And this is what I was saying. The deeper you go into the chain, the deeper up you go with options, or the deeper down you go with calls and with puts, the less extrinsic value you pay. Okay. And that's what we want to do. We want to minimize the extrinsic value. And so when we get down to here, we can see the extrinsic value of this, let's call it $5 over $50 is how much? What is that percent? 5 divided by 50, it's 10%, obviously. So that means that this particular option is 90% moneyness. 90% moneyness. Okay, now we're talking. That is a valuable option versus 0% moneyness here, out of the money. So for me, I'm always looking in the money. I'm always looking deep in the money. Now, a couple other notes is, for example, let's find the 80 delta right here. Let's just consider that the 80 delta. Let's find the 20 delta. Dave and I had this conversation. One 80 delta option is worth so much more to me than 4 20 delta options. What is delta? What does delta mean? Delta is the amount the option price changes for $1 change in the stock. So at a 20 delta, you would imagine that for every $1 it goes up, this gains 20 cents. And for an 80 delta, you would imagine every $1 change in the stock, this goes up 80 cents. Now, I know you're thinking to yourself, Chris, you said that 4 of these, which would be equivalent to an 80 delta, how are they not worth the same value to you? To exactly why. Because this goes to 0. This is worth nothing to me. This is worth absolutely nothing. There is no moneyness to this, right? It's like you put on your nice name brand Versace coat, right? Your nice Versace suit. And then you look inside and you realize, wait a minute, Versace's not made at JCPenney. What? I just paid thousands of dollars for this jacket that I put on, and yet I could have got the same thing for like $80, right? There's no moneyness to it. I don't want anything that has no moneyness to it. And then on top of that, only 10% of my option, give or take, only 10% of my option is not moneyness, right? Only 10% of it is subject to going to 0. That point I made earlier. Every option has extrinsic value that will go to 0 at expiration. Only 10% of my option here is. 100% of it is here, okay? So while this one can sit, nothing can happen, the most that I can lose, theoretically, if nothing changes, is the extrinsic value, right? So I still have 90% of my money left. This one here, I have nothing. And the time decay works on a daily basis, right? At 38 days, you've got 38 days until the moneyness of this needs to be either in the money or it's worth nothing. So that's why I focus on extrinsic value. Like I say, I don't want to pay very much for it. So if I go to the, let's go to the 250 strike here. No. Let's do it in the money. The 200 strike. I can see that I've got $5 of extrinsic in November. The 200 strike here in October, I've got 87 cents of extrinsic value. So that sounds cool, right? One of the reasons I like to go shorter than longer. And then if we look in December, the 200 strike has $9 of extrinsic value. So if I go to December, I'm going to pay $9 of my option in extrinsic value. If I go to November, I'm going to pay $5 in extrinsic value. And if I go to October, I'm going to pay 88 cents. Big differences, right? That's the time value, right? I mean, you can see right here, all things equal, that $9, when this option gets, or this expiration gets 10 days out, will be worth 80 cents. Do you want to give up $9 and watch it just go down to 80 cents? I certainly don't. No way, Jose. So when I do the math, that really, honestly, most of the time puts me at 80 delta, which is why I would say it's around 80 delta. And when I do my option pricing, I always just do like 80, because it's really, really close always to 80 delta. It's just how the math works out. But one thing I don't want to forget is the bid-ask spread. So the bid-ask spread is a very easy gauge of liquidity. So there's tons and tons of options here, right? You've got 4,000, 4,000, 10,000, a couple of strikes with just a few hundred. But overall, you know this is super liquid, because even on a giant stock, a $200 and something stock, and all the options are $30, $40, $50, this is still like 30 cents wide. You're only going to have to give up 30 cents to get in and get out. You're only going to have to give up 20 cents to get in and get out. And let's go to, it was AMOC that we looked at earlier. That's not it. AROC. We go to AROC. And this is 20 cents. We go to a different one. Tell me your favorite stock. Ready to go. Any stock. I don't care what it is. I just need some examples. Let's go to J&J. This one here. That's 70 cents wide. 75 cents wide. Only 7 on open interest. 75 cents wide here. 75 cents wide means that if you want to get in and get out, you lose 75 cents. It's 15 cents here, which means this is way more liquid. Brian says Lockheed Martin. This is $1.20 wide. It still shows 509 open interest, which should be plenty of liquidity. But if I have to give up $1.20 at this point, how much am I giving up? So $1.20 on $39 is 3%. So I have to lose 3% to get in and out of this. That's not so bad, but let's find something that's small yet illiquid. What about GM? What I'm trying to do is find one that's got a really wide spread, but it's not super expensive. So the percent of that spread is huge. Striking out here. GE, General Electric. Let's look at this. DJT. Oh, DJT. That's Donald Trump stock. That's not so bad. It's quite a lot of liquidity, actually. ANIP, ANIP. That'll do. Okay. If you wanted to trade the 50 strike on ANIP, it goes from 650 to 920. All right. Now, think about this. If I wanted to buy it, I'd have to pay 920. And let's say I want to get out of it right away, just for example. I can only sell it back for 650. So 920 minus 650 is $2.70. But what did I pay for it? Right? What did I pay for it? 920. That means it's a 30% loss. 30% loss between buying it and selling it. That sucks. Brand says it's way cheaper to burn cash. Yeah. I mean, legitimately, if I wanted to buy this and then sell it back, that is the price I'd have to pay. Right? I don't want to lose 30% just for the fun of it. That would be the equivalent of going to Six Flags, going on the Mr. Freeze ride. It cost you $9 to get into the Mr. Freeze ride, and at the end of it, they give you $6.50. They're like, "Hey, was it a great ride?" And you're like, "Where's my $9?" They're like, "Well, that was the cost for the ride. Did you enjoy the ride?" And you're like, "Yeah, but like, where's my money?" Well, that was the cost for the ride. Now, there's nothing you can do about that, right? That is part of the market, okay? The market takes its vig. The market takes its cost out of you, okay? That's what it's going to cost to play the game. But you don't have to pay as much as that, right? And that's why I say the very most I will spend is 50 cents. And even if it gets to that limit, sometimes I'm like, it's not worth a 50-cent spread to me. But this is what I look at when I look at options, and why I look at those things when I look at options, right? Of course, you can go for those 20 delta calls. You can go for those 20 delta options. But you're losing a lot of extrinsic value that will go to zero by doing so. Or you go on the other end of the scale, right, where the pro traders are, instead of the novices, right? Instead of the amateurs who don't know what they're doing, buying all these out of the money calls, The pro traders are on the other end of the fence, buying the in the money calls. I didn't make this up. I learned this directly from Larry Hite, one of the original market wizards. Larry Hite was the very first billion-dollar hedge fund manager. And so I had the immeasurable opportunity to work with Larry Hite. And this is one of the things he specifically set me down. He's like, Chris, this is like trading futures on every single product out there. Like, the leverage here is amazing. And it works more in your favor when you're right and less in your favor when you're wrong. Meaning it helps you when you're right and it doesn't hurt you as bad when you're wrong, which is really cool, right? Like, who would have thought it'd be awesome like that? So that's where my head is at. I wanted to take a few minutes to explain why I choose these options, and I want you to understand why we choose these options too, because in all reality, if you're following along, and hopefully you are, you're making great money right now, or you're sitting on the sidelines right now because there's just nothing to take, right? Now, keep in mind, not every day is a trading day, nor it should be a trading day, but every day you need to have a plan. The plan is awesome because I get to share it with you. So thank you so much for being an outlier. We literally couldn't do this without you, and I want to pay you back every single day by helping you save time, make money, and start winning with less risk together as a team. Now, Mahesh mentioned this earlier. We actually are raising prices at the end of the month. So you can save 75 or 45% on the annual plan right now, which is literally 80 or 90 cents a day. So if you don't already have the annual plan, you definitely need to get it. Let us know if you need anything in the Discord. We're always there, always taking care of everything that we can for you. And don't forget, the first rule of Outlier is telling everybody about Outlier. And Peter, you're super welcome. The explanations are extra values to Outlier. Very, very cool. I appreciate your feedback on that. Make sure you hit the like button and tell everyone else on YouTube how much you enjoy Outlier as well, because it's free. And I'll see you. I actually won't be online tomorrow. I will be online Thursday. I have a family conflict tomorrow. So I will not see you tomorrow, but we'll see you on Thursday. But let's talk about rolling trades. So I actually prepared for this one. Normally I go by the seat of my pants, but I prepared for this one. So first thing we need to understand when we're rolling trades is, what is delta? So every option has what's called Greeks, and Greeks are the mathematical underpinnings, the mathematical ways that the option price is calculated. Now, one time I was in the office and this guy who so full of himself was like, hey, if you think you're so smart with trading options, why don't you tell me the Black-Scholes option pricing formula? And I'll never forget, because I didn't like this guy. And the fact that he tried to intimidate me or make me feel dumb because I didn't know it off the top of my head, I shot back at him and I said, you know what? I don't know what it is off the top of my head, and I don't need to know, but I do know how it makes money. And that's what I care about. And that's what I want you to know about, okay? Doesn't matter what the Black-Scholes options pricing formula is. You just need to know how to make money with it, okay? Don't let anybody try and talk you out of that. So we're going to look at SPY. And this is the area, at least on Tastyworks, where you can change different things, right? You've got delta, theta, gamma, vega, open interest, volume, intrinsic, extrinsic, theoretical, etc. The only one that I care about is delta. Now, theta, we talked about just yesterday, where or the day before, is that your extrinsic value always goes to 0. Always. Now, if your extrinsic value always goes to 0, you want to minimize that, okay? And a lot of that is with theta. And if you're buying something out of the money or buying something in the money, either one is going to be depreciating by the amount of the theta each day, the time decay each day. And I would rather buy something that has 20% or less of time decay versus 100% of time decay. Just saying. And Tug, well said, outliers cannot be intimidated. No, why would we? We're the ones making money. Ha ha ha. So back to this. Let's go to delta. Now, like I say, delta is one of the option Greeks, and you don't have to know all the details of it, but what does it mean to you? The delta is the dollar change for every $1 change in the stock. So a 20 delta means a 20-cent change as the price of the stock goes up by $1. And 80 delta means an 80-cent change for every $1 change in the stock price. So let's go to example. So here, a 49 delta means that as SPY goes from 575.50 up to 576.50, this option will go up by 50 cents. So the price of the stock goes up by $1, my option goes up by 50 cents. And if we go to the 80 delta here, this says, as the price of SPY goes up by $1, my option will go up by 80 cents. And then you could go to the 20 delta. If the price of the stock goes up by $1, the price of my option goes up by 20 cents. Okay, that's what delta means. Now, some people look at it as in the money, out of the money. So one way to look at it is at expiration, your 20 delta option has a 20% chance of being in the money, of being profitable at expiration. I don't look at it that way. I don't really care about it that way because I'm only focusing on how deep in the money can I get and pay as little as possible for that extrinsic value, because I want as much leverage as I can with as little cost associated with it as I can. Some people use it like that. I don't. If you sell options, that's something you may be interested in. I did that in a previous life, and I would never do it again in this life. Just saying. So we've understood. We've expressed what the delta is and why it matters. If you have a question, please let me know in the chat. I can't see when you raise your hand, so it would be great if you would interrupt me by putting your questions in the chat. I would appreciate that. So, for example, let's say I bought a 90 strike call. Okay, let's say I bought the 90 strike call, and it had an 80 delta. Okay, and the stock is trading at 100 right now. So we're $10 in the money with that. And let's say I paid $3 for it. And let's say the stock goes up to 105. So if I paid $3 for the option, the stock goes up to 105. The option price now is worth $7 because I'm going to get 80% of that $5, right? So 80 delta call means $5 times 0.8. And that's $3. Chris doesn't understand math, obviously. I'm looking at this and I had a total typo. Option price goes from $3, adds $3, and is now $6. There we go. That makes sense. If anybody's not following, just let me know in the chat. But now my option is at the 90 delta. So, for example, we bought this option. It went up $10, and now I have a 90 delta option. Okay, it's moved in the direction that I want to see, and as it goes more into the money, my delta grows. As it goes more into the money, my delta grows. As it goes out of the money, my delta shrinks. Okay, so if I bought this option and it goes deeper in the money, which is what I want, my 80 delta now theoretically goes up to a 90. So it works more for you when you're right and less for you when you're wrong. Meaning it's getting more profitable as it goes deep into the money because it's going up, right? From 80 cents on the dollar to 90 cents on the dollar. And when it goes the other direction, it's actually working against you less, right? From 80 down to like 68 or whatever. So you're losing less money as it goes toward at the money, while you're gaining more money while it goes deeper in the money. So the delta is pretty awesome for you. Now, when we roll the trade, okay, this is my slide for this. And I only do this when it moves one ATR in our direction. We're at one standard, not standard standard deviation, one average true range in our direction. So if we look at SPY as our example, I can find the button to push. There we go. The current SPY ATR is $5.83. So if I get in right here, I add 583, that gets me to 581.61. So I would hang tight until I got to 581.61, give or take. You know, you can round it if you need to. Once it reaches there, that's when I go into action. Once it reaches up there, that's where I get busy, right? That is where, as Sebastian just noticed, yeah, Leo sent that GIF one day. I was like, that's so funny. Roll up you will. And I told him I would steal them and use that from now on. Yes, Roll up you will at that point. But don't do it before then, right? You don't have to. There's no need to. Nothing's actually happened until it moves one ATR. Once it moves one ATR, you're establishing a new range. Can you roll up and out for a credit? This is key. If you can't roll up for a credit, now follow me when I say this. You paid a debit to buy the option, right? That's a fact. You cannot buy an option for a credit. So I'm taking money out of my wallet and I'm buying it, right? Let's see. Pro tip for you, since it's Halloween time. Go to Spirit Halloween and get some of these. These are the most realistic counterfeit $100 bills I've ever seen. And you can get them by the bulk of 10,000 for like $6 or something. These are great. I mean, they are so good. You would think that these are legit. Anyway, they're like 20% big, but other than that, they're right. So let's take a look at Benjamin Franklin here. I paid you for the option, right? Now, if I roll for a debit, that means I'm paying you again for the same option. You don't want to do that. There's no reason to do that. You're actually adding risk to the trade. So don't do that. If you can't roll for a credit, do not roll, period. Hands down, full stop, don't do it. There's no reason to do that, okay? But if you can roll for a credit, things change. If you can roll for a credit, life gets way easier, okay? If you can roll it for a credit, sell to close the original position as one order, right? And you've seen me do this. We do it all the time when things are working great. So let's say I sell to close my 90 delta because I'm already in the 90 delta. And then I'm going to buy to open the 80 delta. Okay. So in this case, that gives me $13 of credit. That's 548 minus 562. That's $14 wide. That's important. Hang on to that for a minute. So in this case, I can take in $13 in credit, which means when I bought the option, remember, I paid for it. Now I'm getting money back. Now I'm getting money back. When I roll for a credit, I now have money back. What can I do with that money? Right? I can keep the trade alive for first, you know, and now I have money to trade with again. I'm taking partial profits right now, and I can reinvest that into something else. So let's say, for example, we roll the 90 strike up to the 95. Remember, our stock has gone from $100 up to 105. Okay, stock goes up to 105. Now I'm rolling my 90 strike up to 95. When I do that, I'm going to take in $4, right? That's awesome. Gimme. Here's a note. You need to know this. You will never be able to roll for more than that spread. So when I mentioned a minute ago, this is $14 wide, and I could take in $13.29 in credit. That I'll never get $14.01. You can't do that. In fact, your broker, I've tried, will say that's wider than the spread. We're not going to execute this trade. You're never going to get more than that. But the closer you can get to it, the better, of course. Now, when I've rolled from the 90 delta up to the 95, my option delta, no, I'm sorry, 90 strike up to the 95 strike, dollar strike, my delta has actually gone down, right? So my delta went from 90 back to 80. Now remember, we bought the 90 strikes. That was an 80 delta at the time. The stock went up $5. We've rolled from the 90 strike up to the 95 strike. And now we're going backward on the deltas. Okay. Jean-Louis says, would you recommend buying more contracts with the credit if the stock goes your way? I used to do that. And in fact, in the Complete Turtle Trader book, that is one thing that they would tell you to do, is when it moves one ATR in your direction, double your size. And then again, and again, and again, until you get to five units. I don't do that anymore. I'll show you exactly why in just a moment. But there was a point in time where I was getting so frustrated because the trades were going in my direction. I was rolling, and yet I was losing money hand over fist because it went my direction and it would reverse. And then the new strike that I just doubled up at would be working against me twice as hard as when I was going up with one and I'm going down with two. Does that make sense? going up with, 10 contracts and coming down with 20 contracts, that hurts a hell of a lot more. So I used to do that. I do not anymore. And I'm going to cover that in just a second here. But very good question. So it keeps the trade alive when you roll, and it gives you back $4 in credit in this example that you can now trade with, right? You've got $4, you've got 4 Benjamins back, and you're like, okay, let's go find a new trade. And yet your existing trade stays on the books. And you absolutely can. I've yet to do it yet this year, but you can roll it up enough times to where your risk in the trade is practically zero. And in theory, you've got a nearly free trade that you could just let it run forever if you choose to. So rolling is really cool. Now it gets even better. Remember, we started at the 80 delta, okay? The 90 strike was the 80 delta. The stock went up, and our delta also went up to 90, and then we rolled back down to the 80 delta. If the stock turns around, Jean-Louis, this is what I was getting at here. If the stock turns around and goes from 105 back to 100, right? Let's say it round trips, goes from 100 up to 105, you rolled, and it's back down to 100. We actually lose less than if we had just held the original position. What? We lose less than if we had held the original position. Because first, we're taking partial profits now, right? If I bought it for 400 and it goes up and I take 300 in credit in, I think I got that backwards. I bought it for $3. It went up to 7. I've rolled. I got $4 in credit back in my hands, right? My amount of risk just decreased by the amount of credit that I took in. So when it comes back down, I no longer have the entire trade at risk. I may have 50% of it. I may have 30% of it. I may have 30% of my original trade in cash at risk at this point, which that's really cool, right? So we lose less by rolling. So the $5 move down from 105 back to 100 on the original 90 strike would be a loss of 450. But by roll, okay, 90 call strike. In fact, let me add a couple notes here. 90 call strike would be a loss of 450 because it had a delta of 90 at that time, okay? Because it had a delta of 90 at the time. Now, when I rolled it up from 90 to 95 strike, and I then went from a 90 delta to an 80 delta, our loss is only $4. Right? It's still the same $5 move on the stock. Okay. Still $5 move on the stock, but my deltas were smaller. So my loss is smaller. My loss is smaller. And I've already taken partial profits. So we lose less, a lot less by doing that. Peter says, if in the future you watch this video and it's got 10,000 views, it was me. Very good. I'm glad. I'm glad that it's worth that to you, my friend. Okay, so let's talk more through this, right? One of Minvervini, he's one of my mentors. Had incredible opportunity to work with him. In fact, dude lives near Myrtle Beach. I need to text him and see how he's doing with the hurricane. It's been crazy lately. But one of his number 5 rules, never let a good sized gain turn into a loss. This is how you do that. Rolling your option does exactly this for you. It lets you keep that gain. It lets you take those partial profits. It lets you keep the trade alive, which you cannot do with stocks. And when things turn around, which happens, right? We can't always say it's going to go up, but if they do turn around, you lose less. So let's look at a few real examples that we did this year. Real examples with real money. Let's go to AEM first. AEM. Now, I didn't keep my notes on all of them, but I did on this one. So AEM. In early July, it went from roughly $65 or so, and then jumped up, and we got our buy signal in OVTLYR on July 10th. right there. That was the buy signal, okay? And that's the trade that I took. Over the course of a handful of days, stock went from 73.08 where I got in. It bounced up. We rolled. We tried to roll a second time, but I remember we were out of liquidity. So let's just put this up here somewhere. So we couldn't actually roll it a second time, but we did in spirit. And by doing so, we raised our half ATR. Our half ATR stop loss point, I moved from way down here up to up here when it crossed at this point here. And I moved it again when it crossed over the second ATR, okay? And then it reached that point on that half ATR on July 18th. So I held it from July 10th to July 18th. July 19th, it round tripped. July 19th, they went all the way back up, all the way down. Let me show you what I mean. It went all the way back up and all the way back down. And then it did it again. And then it did it again, right? Now, if you own stock, you probably would have been frustrated because really nothing's going on. But if you rolled your options, right, you locked in gains, right? I locked in gains right there. And then here, I rolled it up in spirit. Like I say, it didn't have the liquidity to roll it again, but that's okay. I still did it in spirit by raising my, let me change colors here. By raising my half ATR stop from down here to here and then to here. So then I got out. And then it round tripped, right? It doesn't always happen, clearly. Of course it doesn't. But by being defensive and offensive at the same time, by rolling the options, we're out. We're done. We're moved on from the trade where other people are frustrated during this move. Okay? Let's do another one. BAC. Now, I will tell you, we were looked down upon very favorably from the trading gods because I had not planned to hold into earnings. That was zero my intentions, but I was able to, right? I was able to make money on it. It just worked out for me. BAC got in. It went up. We rolled. I got out here. I believe that was my note. And then it round tripped again. It round tripped again. So we're able to get our profits. We're able to roll it up. And as soon as it starts turning around, right? As soon as it starts turning around, you've already got the reasoning to get out of the trade. Because you know there's a lot of people who sat there and took that entire round trip. There's a lot of people. This is such a great example. There's a lot of people in GameStop who took the round trips. There's a lot of people in AMC who took the round trips. Oh my gosh, these reverse splits are awful. And you don't have to do that. You don't. There's no reason to. Let's go to the next one. NEM. Again. Got in. It moved up. I rolled here. I moved up my half ATR stop. Came back down. I got out. It round tripped even lower. This round trip right here, it sucks, of course. Now the outlier signal was right because I mean it obviously went on. But in the short term, these round trips, you don't have to trade along with them. Like you actually don't. You can get out and you can take partial profits all the way up. And then when it turns around, you can say, okay, that's it, I'm out. So you sell to close the original position, buy closer to the money, same liquidity standards we always talk about. But the key that I was trying to get across there is you move your half ATR stop to that point, right? Wherever you rolled it, move your half ATR down from there, okay? And you don't have to round trip anything. So the pros of rolling is you take partial profits now. It keeps the trade alive, right? You actually can stay in the trade. You cannot do that with option or with stock. The only way to do that's with options. It frees up new capital. You can now get back to trading something else, and you keep that first trade on. It lessens the impact of when the stock turns around, which we just saw 3 examples of that. And it can make a trade profitable when it would have been a loser elsewise, right? You can have it round trip all the way back up and down. And if you hadn't rolled, that original position may be at a loss, where your rolled up point may still be at a winner. But there is one con. You make a tiny bit less than if you had not rolled it, right? Because if we're rolling it down, or I'm sorry, if we're rolling down the delta, so like from 90, let's say if we're rolling down from the 90 delta to the 80 delta, you're right. If it continues on up, you're going to make a little bit less. You might make 10% less than you would overall. But you're still locking up that capital, right? You're still not taking any partial profits. You're still at the mercy of the market coming back against you, right? Everything that's a positive of rolling, you have that can be a negative by holding the original trade. And in my opinion, the pros of that outweigh the cons hellaciously. So much so. So that's why I look to roll. That's how I roll. And that's what the point of rolling is to do, right? It is an offensive and defensive move at the same time. Now, let's go to this slide here. So 1 week before expiration, all options will expire. That is the function of an option, right? It's basically a coupon that says, hey, I want to buy this stock at this price, and I've got up to this date to decide if I want to do that. We don't actually do it that way, right? Because you can make tons of money elsewise, getting in and out. But in theory, if you really wanted to buy the stock, you could do that. But like I say, once we see an expiration point coming up, you need to ask yourself this first question. It's paramount to everything. Are you already profitable in the trade, right? If it's going to expire on Friday, are you already up money? If no, you should just close it now. There's no sense, right? The move isn't gonna happen for you. Just take your money off the table. Take the risk off the table. Just move on. If yes, first question is, can you roll up and out for a credit? So we just talked about rolling up. You can roll up in duration as well. Now, if you roll same strike, most likely you're going to pay a debit. Let's go to one that has less options for simplicity's sake. Let's go to J&J. Let's go to Johnson & Johnson. Let's go to Coke. Coke is my default boring stock. But still a million options on here. Okay, hang on. I want to do 10 strikes. 12 strikes is fine. Normally, when you roll out, right? Let's say I have something, it expires next Friday, and I am profitable, but I want to keep it on, right? It seems like everything's working. I just need to give it a few more days to work out. If you cannot roll it for a credit, don't roll it. Okay, so what do I mean? Let's say I bought the 70s. I need to now sell them, right? So we're going to change that to sell. And then I want to buy the future 70s. Well, I'm still going to pay $1.03, right? I'm now paying $1 to keep that trade alive. That doesn't work for me. No, thank you. But let's say I'm rolling up from the 67s to the 70s. Now I'm taking in a credit. Now I'm rolling up and out. Up meaning closer to the money. Out meaning out in duration. So we're going from October to November, and I can take a credit. When I take a credit, remember, you're reducing your risk in the trade. It is a fact. You paid a debit to get in. You're taking a credit right now. You keep the trade alive, and you have less exposure. Okay? That's important. But if you can't roll up and out for a credit, close now. And then, of course, this one order, sell to close and buy closer to the money, same liquidity standards. And again, it can take partial profits now, keeps the capital alive, and keeps the trade, frees up capital and keeps the trade alive. So that's how I look at it. But number one above all, if I'm not already profitable, I don't need to roll. Just a fact. It's not working out. Move on, Joe. Well, that'd be great too. Joe Biden and Kamala can hit the dust. Leading into earnings. All right. Now, we talked about rolling at ATRs. We talked about expirations. Leading into earnings. This is what I should have done. I had a trading error in Bank of America and BAC, but it worked out. Right. I'll be the first to tell you, I had 100% all luck on that one, because I didn't know earnings were happening on that day. I believe it was Leo who mentioned it during the trading room that there was earnings, and it was too late for me to close it. It was after the bell. And it's too late for me to open this again, apparently. TrendSpider has died. Yep, it's dead. Okay. So the question you got to ask yourself when you're going into a trade, into earnings, like I'm just talking about, same question we did before. Am I already profitable? Am I already making money on the trade? If no, I need to close it. But if yes, does the expected move break the trend line I'm following? I'm always following the 10. You might follow a different one, but that's my criteria, is the 10 EMA. So what in the world is the expected move, and how do I calculate that? It's not that hard, actually. Not that hard at all. Looked like Mahesh booted me. So that's what I was saying. If you're running up into earnings and you're already profitable, yeah, let's go to the next step here. Does it break the trend line? Well, let's go to BAC and let's calculate this together. The way that you do the expected move is really simple. Let's say earnings are happening on October 19th. You go to the strike closest to the expiration that has the earnings, okay? If you do it before, it doesn't necessarily do anything. If you do it after, the earnings will be included within that, okay? So, for example, if earnings were on October 15th, they would be included in this cycle, okay? Because it expires on October 18th. Now, the way you do this is you go at the money. So 30, close price on this is $39.97. So I'll go at the 40 strikes. You would buy the call and buy the put, okay, at the money. And this is going to give you a number. This is an at the money straddle. That's what that's called. Don't ever trade these. And that says that if you want to buy this trade, it'll cost you $2.03. The expected move is 85% of that. I believe 85% is one standard deviation. So you take the 203 times 0.85 and you get $1.72. Now this is $1.72 up or $1.72 down. That's your expected move. In fact, that's your expected move anytime you want. Until October 18th, it's saying that there is a $1.72 of expected move between now and then. So if we go to BAC and we go to right now, we could say there's a $1.72 up. Oh, there's earnings coming up in just the same number of days. A $1.72 up or a $1.72 down. That's your expected move, which is pretty huge on this stock because the ATR is only 71 cents. The expected move is more than 2 ATR. That's a big expected move. Now, looking at this, my criteria is, does that expected move break my trend line I'm following, the 10 EMA? We don't need to look at my settings. Does it break the 10 EMA? Close that, but there we go. Well, yeah, clearly it does. Right? The 10 EMA is like 10 cents off of this, 20 cents off of this. And this is like stupid down. And this is stupid up. Yeah, it's definitely going to break the expected move. So if it is going to break your expected move, go ahead and close. But if not, then that is the only criterias I will allow to hold through earnings. If it doesn't fit that, close before earnings. Earnings are risky. You know that. I know that, right? Earnings are something that nobody can expect. You can have blowout numbers and the stock can drop. You could have the worst report ever, and for some reason, the next day it shoots up, right? There's no way to predict earnings. It is a crapshoot. It is a gamble. And if you trade around it, you need to at least buy yourself some room. You need to have at least given yourself some profit cushion. So if you don't have that profit cushion, you're just asking for losses. But if you have that profit cushion and it's not expected to break your trend line, then you know what? Mathematically speaking, seems like you got something working for you. So that's what I want to cover today. I know it was a lot. I know we went kind of long, but I wanted to really break down rolling trades. I wanted to break down expirations, and I wanted to talk about earnings and what that does, or how I would trade around those. So if you have any questions, reach out to us in the Discord. Don't forget, the first rule of OVTLYR is you tell everybody about OVTLYR. And I'll see you right back here tomorrow on Friday. Have a great afternoon, and we'll talk soon.
10 over 20 over 50.